everybody. Thanks for coming. My name is Jeff Gibby. I'm going to kick us off today. Welcome to the Online Trader Summit, our very first one for this year. It's good to see you. You look fabulous. Let me go ahead and read the legal disclaimer. We'll kind of kick everything off. We've got a great lineup of, as always, of guests. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The specific indicators and the information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation should be construed as an investment advice or the solicitation to buy a security. So I hope you enjoyed that. You should be able to hear me. If you can, let me know. That helps a great deal. And thank you for being here. We have pretty good people already coming in, ready to go. Good morning, Maverick. It's good to see you. Thanks for saying hi. All right, as we get started, I want to say thank you to our sponsors. We've got some great sponsors today, Stocks and Commodities Magazine. They've been sponsoring the events that we've been doing since we started doing them. And I think we've been doing them now for like 15 years, 16 years maybe. We really appreciate the support that they have for the Online Trader Summits, the conferences, all that kind of good stuff. If you are watching us on YouTube and you haven't registered yet, you could register because you can get a lot of really, really good prizes, including a free issue of the Stocks and Commodities Magazine. So you can register at www.metastock.com/traders-summit. Scott, good to see you. Thanks for saying hello. All right. If you haven't yet, you should join the Online Traders Forum. Traders Forum is a great area where we actually go in, have markets, we have guest speakers come in, we do podcasts, we do lessons, we learn about indicators, we talk about what we're interested in. It's a great little community that we've been growing, and I think we're up to about 1,400 members as well. But you can join for free at thetradersforum.com, and there's some really, really good traders that hang out in there. So we are, of course, Metastock. Metastock's been the highest rated software in its price category by the readers of Stocks and Commodities Magazine for 32 years in a row. Pretty soon, I think it's going to say 33 years in a row because it's a new year. So we're going to have some specials that we're going to talk about all day. For Metastock, I love it. I love the ability to do the scanning, find those opportunities in the market whenever they exist. You can use it to test trading ideas, get feedback on the market. It's just a great platform, and you should use it because of scanning and the other things that are in there. It does a really good job, though. We'll be talking about Metastock, as I said, all day long. We do have a special trial where if you buy a month, you can get a second and third month for free. You can get that at metastock.com/summit deal. So that's really all I wanted to say as we kick things off today. The first person we have kind of speaking with us today is a gentleman by the name of Jeffrey Scott. Jeffrey Scott is going to talk about his top-down and bottom-up way of looking at stocks in the marketplace. We just spent some time designing a really robust methodology inside of Metastock for him. It looks really, really good. Jeff, let's go ahead and get you started. There you are.
All right. You hear me okay?
I can, yeah. Let me go ahead. Let me see. Let me go ahead and make you the presenter real quick. This is really easy for you. It'll just say, hey, do you want to share your screen? And that's all.
Good, because I'm looking, it's not Zoom, so I'm lost. All right, show my screen. Perfect.
See, it was that easy. I can hear you. I can see you. I can see your screen.
You can see my screen. Oh, okay, that's because this. So maybe so you can see my deck underneath.
Yep. Mm-hmm.
All right, perfect.
That's a perfect cue for me to get out of the way. It's your turn.
Okay. All right. Well, thank you to Metastock. Thanks, Jeff. I've been a user of Metastock since the DOS days, and there's a lot of things I like about Metastock, but it's the access to data outside the U.S. and as Jeff pointed out, the scanning. And plus, there's a lot of smart people who have put their things, indicators and sets into Metastock. And as you're going to see, I'm probably unlike a lot of them in that I'm more like you than I am like the professional that's going to be online talking about his tools and only his tools. And let's go ahead and get kicked off. So my name is Jeffrey Scott. My website's marketmripro.com. I have a Google group called Top Down Trader, which you're welcome to join. It's free. When I stop working my day job, eventually, I'll move it to Discord. I tried that before, and Discord was too much work because people expected to be expected interaction. And email address is marketmripro@gmail.com. And I'm going to talk about something that I put together over, gosh, decades of being in the market and what has worked for me as especially someone who works full time. And I'm actually out in San Francisco at the JP Morgan Healthcare Conference. I won't be on TV with Kramer, unfortunately. But I'm an executive and founder of a large healthcare tech company. So I really do have a real job. And fortunately, I have enough time to do what I really love. And my passion is the markets. So thanks for being here this morning. You've already seen a disclaimer, so I won't spend any time on this except to say that if I talk about any individual stocks or option trades, remember this is education here. I'm not your investment advisor. I don't know your current scenario, your net worth, your goals for the market. So I couldn't even answer any specific question about a stock or about a trade that you're in. And on the options front, there's a lot of really great options educators out there, and you can find out a lot on the Options Industry Council. One thing that I told Jeff as when we talked about doing this is that I'm going to give away to all the attendees, and it'll probably take about a week to come out, but I do some options trading. It's very limited to the types of trades that I take. I'm a position trader. I'm trading whether I'm long or short. I'm looking for a move in the market. I am not somebody who is somebody who's looking to take a little premium out of the market in a sideways market. That's not my style. So I limit it to the types of trades that I do to support the rest of my education and my tools. As I mentioned, the Top Down Trader group, I post videos every night on YouTube. At least once a month, I'll do some type of event where I will spend a couple hours online with people that own my products or folks that just are interested in what I'm doing. And I typically do my invites through the Top Down Trader. I don't keep a mailing list. I probably should keep a mailing list, but like I said, this isn't my full-time job. This is my passion, and you're welcome to join that. I've been putting videos on YouTube for 20 years, so they're all over the place, and you just look for my name, which is Jeffrey, Jeffrey, Scott, Scott, and Stocks, and you'll find where I am in a much younger picture than I am today, which I should probably change. So my real world, I'm a medical oncologist, so I'm a cancer doctor, which is why I'm out here at JP Morgan. I've been trading since the 90s. I actually quit my practice in 2001 for a lot of reasons, including I was kind of fed up with a lot of things about the healthcare system, and I wanted to change them. So I left practice, and I've had a string of healthcare startups. I've sold companies to Syncora, Cardinal Health, among others. So I've had some success, I guess you could say. And because of my day job, I developed a style of trading that can be implemented even if I'm not at the screen all day. And as I said, I've been teaching people for a long time. Just a point in that on the 31st of January, I'm going to do a mentoring section for the folks, again, that have my tools, whatever platform they might be in, or if they just have an interest in trading the way I trade. And I will be sending out invites into the Top Down Trader Google group for people to participate. I still love what I do for my day job, which is why I'm still doing it. And I get to do things that matter, and This was a publication that I did, and again, it's got nothing to do with trading, but it's sort of who I am. This was published last year or 2 years ago now, and it made it to the best of the Journal of Clinical Oncology Practice. And what all that means to me is it means I got published in a prestigious journal at this point in my career, and the publication was so important as I actually got put into the best of edition. So I met a smart guy in the 90s. His name was Ian Woodward. And Ian really created the approach to trading that I have today. And I give him all the credit. And Ian was a British guy. He was an older guy when I met him. And he retired from Xerox. And his basic story was, I retired from Xerox. I had a nice nest egg. This is Ian. And I was doing fine until someday somebody told him that he was making a big mistake because 100% of his nest egg was in Xerox. And think about Xerox, it's still around and it's had some runs, but it's not much different than it was when he retired. And so he spent a lot of time, I think he grasped William O'Neill, from the CanSlim leader, and took CanSlim, How to Make Money in Stocks, is O'Neill's pivotal book, and he made it his own. And by making it his own, he put some funny names that exist today in my trading. But more importantly, I think he improved CanSlim. So over the years, on the foundation of CanSlim, made better by Ian, I found some really great educators, traders, indicator creators. And again, my brand is what I'm doing after I finish this video. I am going back to the JP Morgan meeting. I got a company to sell. But my passion, as I said, is trading. And so I'm willing to have an expanded brand. I'm willing to recognize that there are a lot of smart people out there, and I use their stuff as well. So whether it was people like Steve Bigelow or David Elliott, who kind of gave me the idea of having a plethora of online education for free to support people, because that's what they did. John Person, who, gosh, I bought his first indicators from him in like 2010, 2011. I think his son must have just graduated college. Now his son's got kids in college, and he was the salesman who I bought the tools from. Become friends with him, but a lot of the things that I do, I learned from him as well. And there's a number of names I could list: Gil Morales, Chris Catcher, and others. So my trading style is really, I'm a mutt. It's from what I learned from 30 years in the markets and from really smart people. So I've built a series of tools that help me, I think, do okay in the market. We don't talk about our performance on these. If you want to know performance, I think there's a YouTube video that reviews my performance from last year. I share my my balance from my trading account with the folks on my videos from time to time, mostly to show that I actually am trading real money and to see how I've done. I'm a top-down trader, and that's probably the most important thing I learned from Ian and from O'Neill's CanSlim approach. I swing to position. What that means, when I buy something, I hope I'm in it for a few weeks to a few months, or even better, I buy something that keeps going and I'm in it for a long time. So I'm not going to look at at hourly charts or minute charts. I use daily and weekly charts. Indicators and scans, you'll find I use several, but I use them to draw my attention to an equity. When I think about all the indicators and scans out there, there's only 3 or 4 variables. It's price and change of price, volume, and it's time. And how many derivatives can you take of price, volume, and time? So there's a lot of confluence where one of my friends, and I'm going to actually show you one of his tools I use, his name's Sagar Nandi from superiorprofit.co. He's got some great tools on Metastock. And Sagar and I will often find the exact same stock to trade, but we get there in a totally different way, except it's time, volume, and price. My favorite trade, and one of the other folks that I followed for a long time, is Alexander Elder. And I went to one of his live meetings, and it was the first time. And I used to be shy, not shy anymore, but I was shy. And he said, oh, everybody has to go up and tell us what their A trade is. And it's like, what's an A trade? Well, fortunately, I wasn't first. And the A trade was, what's the trade that you look for and how do you find it? Well, my A trade is stocks in a longer term uptrend. It pulls back to support. I buy it on momentum off of support, rules-based position sizing and stop management. So I know how many shares I'm going to buy before the trade is done. I know what the price is that I'm willing to pay before I make the trade, and I also know where I'm going to get out. So I typically have a target price where I'll take off a percentage, and then I have a stop. I don't ever enter a trade without knowing where I'm buying it, how many shares I'm buying, what's my target one, and what's my stop. And that's not something I learned in the beginning. I learned the hard way. And I'll show you a slide that shows you why I have targets and I take money off. And I like seasonality. I've been complaining on my videos that my best seasonality trade every year is buying Netflix right around Q1 earnings. And I've been complaining in my videos that I wouldn't touch it with a 10-foot pole this year because of its fight with Paramount over Warner Brothers. But seasonality is something I like as well. I developed tools. I think you can do it in 30 minutes a night. And although I continue to learn and make fine additions to what I do, I haven't really changed my approach in 30 years. I think it gets a little bit better, but basically it's the same. Now, this is a really old slide, but to me, it really defines what happened to me last year and why I trade from a top-down perspective. When Ian was around, and Ian's been passed now for a decade, and I really started amping up my spending time online and helping people sort of in homage, paying homage to Ian, who meant so much to me and many others. He would put this slide up. And I got to go to the live meetings where this data came from time to time. And what those meetings would happen, you'd have 20, 25 people. At the time I was younger and really didn't have perhaps the trading skills that I have today, but they would sit in a room and they'd identify a handful of stocks and talk about the markets and some of their best trades. And they'd have somebody who would keep tab. And then after a 2-year period, they decided to go back and look at their performance. Now, it's much easier to define a strong or a weak market retrospectively than prospectively. We are either right now in a strong up market. Are we in a mixed strong? Is it actually turning down? Are we in a mixed weak? I think we would know if we were in a weak market. My guess is we're probably somewhere between mixed strong and strong. But if I had the tincture of time and I could make that decision retrospectively, it's easy. So what they found was these really, I'll say, and I was there, so me too, that some really good stock pickers in a strong market could find stocks that doubled in 20 days, which is 1 month. And in a weak market, the same people, knowing that what the market's doing, were awful. So there's a lot of common things I could say about that. The first thing is, when the wind's at your back, when the markets are strong, in Ian's words, he would say you attack. And if you like to trade and you like to go long, there's a time to really be all in, and that's when you've got that really strong market. But when the market is weak, you got to be careful. And because the same people that were really good at taking great trades in a strong market, excuse my French, really sucked when the market was bad. The other thing you'll see, and why I take money off the top when we have a big move, is what happens over the next month. Is in both a strong market and a mixed strong market, you have a reversion to the mean. So you pull back a little bit. So take some of that initial profit. Now, the worst part about this slide to me is in a bad market, and many of you are probably have been trading less than me time-wise. You may not have been through the great financial crisis in 8 and 9, the dot-com thing in 2000, 2001. COVID in 2020, and even March and April this past year were really tough markets. And in a really tough market, and we didn't have a recession this past year, but if you have a recession in a bad market, it can get a whole lot worse before it gets better. So reversion to the mean doesn't occur all the time in a bad bear. The Google group is called Top Down Trader. So that was one of the questions. So why did this matter last year? Somewhere around April 7th, actually on April 7th, I did a video. And on my video, I titled the video, "The Bottom is In." So the best time to make money, if you're a top-down person, is not buying the best when the markets run 20, 30, 40, 50% and it's getting tired. It's when the market starts its run. So I am constantly looking at the market. And that's why I do my videos, because I think people like that. And I call the bottom. I did it on YouTube. It's published out there. Everybody could see. And literally, I showed them how this 100% per month is possible. And the performance between the beginning of October and April 7th would have gotten to that point of a return. I'm not talking annualized. So again, it's out there for everybody to see. So that's why I can mention it and feel it's okay to talk about it. And there's other things that matter in life to me, although I better change the picture in the lower left. I'm not a youngster. I'm certainly from a work career, hopefully near the end, because I'm done. That's why I'm out here. We're meeting with a lot of potential acquirers and things like that. But there are things that are important to me. I got some great friends. I love boating. I live in South Florida, so it's nice to have a boat. I got a great wife of 40 years. I got grandkids, and I love Michigan football. Now he's gone with disgrace, but I had a health issue about 18 months ago, and I flew up to New York for a meeting on Wednesday and a dinner Wednesday night, and I had major surgery on Friday. And my wife was thinking, well, thinking is a nice word. She was screaming at me that I was a whack job. Why would I go on a work dinner? Because I'm committed. All right, maybe I should be committed on Wednesday night before major surgery on Friday. So I'm sitting at Teterboro, which is the private airport that we use in New York. And again, I am all maize and blue. I'm all about Michigan. And the new Michigan coach at the time, Sharon Moore, walked in. He sat down next to me, and I don't know why, I told him what was going on. And he gave me the pep talk he does in the locker room. And I really thought, for me, it made a big difference. So I still, even though he's been disgraced, it's still somebody that mattered to me. And I want to have more time for what matters. So just to summarize what I learned, and we're going to go into charts and things like that in a few moments. My favorite way to trade is top down. Market direction determines most of what's going to happen today. All right, we woke up, the futures were negative. Now the market's been strong and they have a tendency to get better before the end of the day. We'll see if that happens. Then I want to find the leading industry groups and then the best stocks in the leading industry groups. I make my biggest money by holding things over a longer period of time. How many day traders do you know that are as old as I am who have made money consistently in the markets? And it's tough to find them. A lot of us like to sell stuff, and I think it's attractive for day trading if you're starting out and you don't have a lot of capital, because the margin opportunity is phenomenal if you close your accounts. And I know they're going to get rid of some of the requirements, the day trading rules, that may make it even better. But you make money, I think, holding stocks over a period of time. And I like to trade options. I should tell you that I'm not a forever holder. Now, markets are never wrong. I may be wrong from time to time, probably more than I want to admit, because I'm just looking at the evidence and saying what I think is going to happen. And whenever you feel yourself saying that it's different this time, it's time to change whatever you're doing, because it is never different this time. And I didn't skip this intentionally, I mentioned it before, but money management is very important. And, again, paying homage to Ian, who was British. I don't think this would fly in the US, but instead of playing chutes and ladders as a little kid, they played snakes and ladders. And if you remember back to when you were a child, maybe you were playing chutes and ladders and you landed on 28. Imagine this is your retirement money. And you won the lottery because you went right up to 84. And if you get to 100, you're comfortable that you can retire, you've made your nest egg. Well, guess what? Then you roll a 3, you hit the snake head and you come down. That's a bear market. And you do not want to play snakes and ladders or chutes and ladders with your retirement money. And that's why money management, but also understanding the market, to me, is so important, and preservation of capital. So 50% of what happens is going to be the stock market, 20 to 30% industries, and about, at most 20 to 30% is stock picking. So I let the market determine my stance. Am I long, short, or do I step aside? I want my favorite setup in the top industries. I want to look bottoms up for shorts and longs. And bottoms up means I'm just going to look at the whole market. I want to find the best setups. I don't care about the industry group. Now, why do I like tops down better? Because it works better, but it doesn't mean you can't find great stocks that are in a out of favor industry. Just you're walking uphill instead of downhill. And I use different tools to gauge what's working. So now I'm going to go into Metastock. And the funny thing today, you may have noticed, you would have gotten a bunch of emails from Metastock talking today about, let me see if the Metastock shut down. Talking today about having an update. Now I didn't update it, so let me load it here. I had it loaded, but you know what happens when you're doing a PowerPoint or you're doing a presentation, things don't always behave. So we're going to open up Metastock here. But I did not do the update because I didn't want to fall victim to the gods of the computer wars and end up having a problem. But I'm going to update it right away. I've been using 20 pretty much ever since it came out. We were working on building my app, and I didn't want to go, not know how to use 20. One of the things they said they're going to do with the current version or the new update is that there's going to be some performance improvements, and I find that to be exciting. Those that were using it early on when they switched the downloader probably saw that it slowed down a bit. While it's loading, I'm going to do talk a little bit. And that they fixed that problem. Not that it was a problem. I think it was mostly just as they were building out the product. So it's loading, I suspect, but let's just talk a little bit about what I'm going to show you. I actually did snapshots last night because I'm on a hotel internet, and you never know what's going to happen in a hotel. So these are all the same things I would show you in the program, and hopefully I'll go through a couple of these, and then I'll go back and my computer's cooperating. I start with the question, what is the market doing? And I want something that does not repaint, meaning it doesn't change tomorrow from what it showed today. And I want something, I'll go back one slide, that has, for me has worked, and it's objective. So this is as objective as I can make it. I built a timing model from the things I learned from Ian Woodward, and then there is a book about stages in the market that I found to be incredibly helpful. And I combined what I learned from Ian, and the author of the book is escaping my mind. Oh, Stan. It'll come to me before I finish. And I created a timing model. So the first thing I do is I go to my timing model chart. And I have created all the layouts that I'm going to show you during this presentation are available to you as part of Metastock. And Jeff has a copy of them, and I gave them to the salesperson I work with, and hopefully he shared them with everybody. But this is my weekly timing layout, and this determines 100% of what I think the market is, not 100, 90% of what the market's doing. Now, my goal was to create a timing model, one that would be, again, objective, doesn't repaint. Now, the repainting is a bit of a fib. If I'm showing you a weekly timing model, that bar is not finished until Friday at 4 o'clock. Give it a few minutes for the final data to run through. So it's not really repainting in that it's just not finished yet. And it will show you during the day, it'll turn yellow if it's going to make a signal. And then when the market shuts down, then it'll fix to green or red. So if you see, this happens to be April 7th, the big reversal day. It wasn't rocket science. I have a lot of tools that help me make that decision. It took a few days for the weekly to fire. And you'll notice, and I have up here the spider, the diamonds, the Qs, and the Russell, and they all fired in about the same period of time. And you'll also notice they're still in a buy signal. You'll notice that the red line here showed that somewhere up at the top, where you can see the arrow here, we fired a short signal. Now, I don't take the first signal all the time if I'm long. I'm going to look at the daily. I'm also going to look at some of my other signals that I like to look at. But I'm certainly going to start resetting my approach. When the weekly is green and the daily is green, I'm not shorting. I'm pretty committed to the market. What you'll see from time to time is the weekly may be green and the daily, well, they're all green right now, but the daily may go red. Now, you'll notice, well, Jeff, the dailies flip all the time. Absolutely. I don't want to wait for a weekly signal to make all my decisions. So my main view of the market is determined by the weekly, but the daily will determine some of my, how convicted I am. So I'll start talking on my program, my videos, about what percent of cash I'm allocated. And I will spin up and spin down my cash in my account, meaning liquidating stocks, based upon that number. When the weekly goes red, I don't know if it's going to be a short-term pullback. I don't know if it's going to be a long-term pullback. But when that weekly is red, I'm going to start liquidating my positions. And again, I may not go 100% the first day. A lot depends on what the daily does. If the daily turns red and then turns green right away, well, again, my conviction of going negative is less. But when the weekly is green and the daily is green, I'm long and I stay long as that signal is still green. When the weekly is green, the daily is red, I cut back on my position size, I raise some cash. When they both go red, I'm out of equities unless I'm in contra ETFs or I'm short. That's how I've traded the market for a long time. I don't care about taxes. No poor people pay taxes. My goal is capital preservation and building my nest egg for my family so we can all retire and retire in a nice way. Frankly, I could probably do that already, but I have too much fun trading. So my timing model is built in. Let's see. I want to show you this. This is from a different platform, and unfortunately, it doesn't give you the signal. You have to look at price versus the WMA, and then this is the other part of the indicators. Let me tell you about this other indicator, which is on the bottom here and on the top up here. It's called the bongo. Now, I actually was one of the folks that created it. A lot of the things I use, I've learned from other people. As I said, I'm a mutt. I've learned from smart people. If somebody has a long career of success, why wouldn't I want to learn from them and adopt things that worked? The bongo is a trending indicator. There was 5 of us. Ian told us to go make a timing model for the market. One of them was a professional money manager, and he ended up using the weekly model for trading ETFs with other people's money. So to me, it starts with the trending indicator, and then Stan Weinstein is the Stan. I knew it would come to me. Sometimes it sits in the back of my head and I can't pull it out. He's the one that talked about stages. He used the 30-period WMA. So for you to change from a buy to a sell, two things have to happen. Your trending indicator has to turn red from green, and you have to close below the WMA, and that will trigger a sell signal. So I've used this for a long time, and I'll share this PowerPoint to anybody that wants it, and I'll post it in the Top Down Trader group. But if you go back, you'll find that you look at, for example, 2002 to 2003. You probably didn't want to be long this market for a long time. And you'll get whipsawed in any market in a chop period of time. But I was out of the market predominantly or short. 2008 or 9, it kept me short. Remember, it's not just the trending, it's the trending and being above the moving average. 2018 and 19, that happened quick. But boy, 2020, it was spot on. So I have found that this is simple, simple, simple. I got that on the cursor, okay. It's a simple timing model and one that's been effective for me. Now, I use a number of breath tools, and I've already started talking with Jeff and others to put them into the program. I mentioned a guy named Sagar. He actually learned them from me, and I learned them from Ian, and Sagar's actually incorporated. So there are a number of other breath tools. And why are these important? These will help me move earlier. When that daily has gone from short to long, and that weekly still red, but I start to see signals that tell me we're bottoming. And these are things I'll teach you at the mentoring session next week, or 2.5 weeks. These will be things that help me get in and out either before the signal or help to validate the signal that I'm seeing. I could be very effective as a trader just living in the weekly signals. You can see this, and if your goal is to stay long when the market's your friend, skip the pullbacks. The weekly is enough, and that's why one of us, the ones that created it, used it as their timing model. But I can do better. I can do better by incorporating the shorter time signals to get out earlier and get in sooner, and then these other mumbo jumbo, and that's Ian's words. Here are the different signals that I'll teach you and show you how to create them for yourselves. And so there are a number of things that make me better. Let's see if the program loaded for me. And it did. Awesome. Now, of course, last night I had all my layouts loaded. So let me open up a couple and show you. So just to open up the weekly, and again, all of the things that I've created, I share. Doesn't do you any good to have the layouts without the add-in, because ultimately you need the indicators. All right, so that's loaded up. So it turns out, you teach an old dog new tricks. Tabbed is a much better way of looking. And so you could see in the program, let me just make it a little bit. It fires for you automatically. And this is just my weekly timing model that we showed. And I can look at, this happens to be the Q. And even the Q, which is underperforming now, is in a buy signal. The spiders, all-time highs. Obviously, today's going to be a different day. We don't know where it closes. Great day for companies like Walmart. Some of the rare earth metals did all right, at least to start. Diamonds, these are all green. Doesn't take me long to tell the difference between red and green. I can open up the daily. Again, all of these layouts, I'm not going to show you anything today that you would not have access to if you buy the add-on. It's possible that I may have, that they're not all included, but Metastock has them, and they're all shareable. And again, I'll look at the daily, and no question, the daily flip-flops a lot more. And I wanted to, because I don't want to be relying just on a weekly signal. But again, when the daily fires and the weekly is long, it tells me I want to be long. And when the daily goes red, because we're green all the way in here, and the weekly is still long, I don't know if we're in the beginning of a deeper pullback or it's a pause to refresh. Pauses to refresh are very healthy. I'm going to be looking for that other mumbo jumbo, things like Hindenburg omens and some of the other breadth indicators I follow. 13-week new high, new lows is at extremes. And all of these are easy to build. And hopefully we'll be adding them to my add-on soon. But I put the weight of the evidence together, and this helps me to understand, is it time to get out, or do I just want to lighten a position? But when that daily flips to green and the bongo is green, I'm going to look to, is it time to add? So I'll be filtering it with some of those other indicators I mentioned. Now, do I look at regular charts? Absolutely, I look at regular charts. So I will then go and I will look typically at the daily market ETFs. Over the weekend, I'll spend a lot of time looking at the weekly charts as well. And I got to find out where it opened. I think I have a tendency of getting to a place where I have too many things that open on my computer. I don't see it opening yet. Let me see what's up here. That'll bring it up. In the meantime, I'll pull back up the PowerPoint. I have it sitting right there. Go to the current slide, switch the view. So I will, and I like to look at moving averages. So I use a 1750 and a 200. If you're a fan of investors.com and they like the 21-day EMA, the funny thing is the 17-day simple and the 21-day EMA are almost the exact same. And the thing that's even more ironic to me is that the 21-day EMA, the 17-day simple, and the 30-period WMA are almost all superimposable. Something that I never realized before. So I'll look at the markets again, Spider, Qs, Diamonds, Russell, the dollar and volatility. I like commodities, so I look at gold and silver, and boy, have they been on fire. And gold was something that we talked about on YouTube video in one of my live sessions, and gold just gave the mother of all buy signals right in here as it took out multiple tops. It had an earlier one, and it's one that we've been long for quite some time, as I hope many of you are as well. And then I have my charts for the stocks. I want to spend the rest of the time talking a little bit about that and some of my scans, and then answer any questions that I need to. So you're going to see a lot of squiggles and dots on my charts. Here's the derivation. When I was an internist, and you have to be an internist, internal medicine doc, before you can be an oncologist, I got to rotate through cardiology. And I always thought it was fascinating that we could put these things on your chest, your arm, and your legs and get an electrical current that would tell me what your heart was doing. And I could look at that electrical current and it would tell me if you were having a heart attack, what your heart rhythm was doing. Did I have to put you in the hospital? Do I need to take you to a cardiac catheterization? And we were able to judge so much by this stupid little strip of paper with a very low intensity electrical current. Well, I want an EKG for stocks. So that's what my chart is. And I'll go back to the chart in a moment. At the top is the bongo, and that bongo is my trending indicator. The green being, the top being daily, the bottom weekly, and green is when it says to be long, red is the dominant trend. So what you had here is just a downtrend, and you could see red, and now we have a retracement and probably a new uptrend. So that would mean that I'd expect CRDO potentially to flip the weekly to green. Weekly is slow, daily is fast. What I'm going to look for is this pattern, okay? And really I'm going to look for when it starts to come up. So I developed it so I could scan for the weekly bongo is green, saying I'm in a nice uptrend. and the daily bongo went red. So I know I'm pulling back. And I'm going to look for the day the daily bongo turns green again. So I could scan for this stock right here. And that's why I like the bongo. This is math applied to the concept of extension. Ian taught us the high jump. And I thought, well, gosh, if stocks could be extended to the upside, maybe they could be extended to the downside. So I came up with the low jump. And I combined them with an oscillator. And if that oscillator is reading 95 or higher, that tells me that this is the most extended the stock is for the last year. Well, if you're the most extended you've been, you might get more extended, but odds are you're going to revert to the mean. And if you're below minus 95 on the high-low oscillator, you're the most extended to the downside that you've been in the past year. And what do you think is going to happen? You're going to revert to the mean. I'm a glutton for the 1750 and 200 simple. Why? Because that's what Ian used. And I just I can't stop. This thing here is just a long-term trend line, so it's not one of my indicators, but it's one of the things that are built into Metastock. I have a number of dots. Metastock applies lines to them. 0 is not my dot. It's not a dot. 1 is a green candle low. Red is a red candle high. Those are single candle reversal signals. And I'll teach you on January 31st how I use them. Number 2 isn't even mine at all. It's a Wilder PSAR. Why do I have it there? Because there are people all over the world that use his trading signal, the PSAR, parabolic, stop, and reverse signal. So if it's green, it tells me his peeps are long. If it's red, they're short. That's the only reason I have it there, confirmation. Bar number 3 or dot number 3 is the squeeze. Famous. He applied Bollinger Bands contracting into the Keltner channel and then put a rate of change indicator on it. I just want to know when those Bollinger Bands are contracting. But you know what? I don't care about when it's going sideways. I want to know when it comes out. So I've added the release, which are those 3 dots after a squeeze. Why? Because I want to find these stocks when they're starting to move, not when they're pinching. And so I can scan for that. The next are 4 simple things. Don't overthink them. The first one is momentum, number 4. The 5th one is breakout that was brought to us by David Elliott called a MOBO breakout, which is a breakout from CHOP. The 5th one is I got the right one. Let's see, 1, 2, 3, 4, 5. So 5 is the breakout. 6 is a big value. 7, which you have to go all the way over here to find, is what's called the big gap up. And that's, you had a big gap that closed in the upper part of the range, and it meets certain criteria by how big of a gap is compared to the average trading range, and the volume on that day needs to be higher than the last X days. So there's my EKG right here. So I can just look, I'm looking at the price bars and see I've got a stock here that the PSAR flipped, it's in a squeeze, it has momentum and a breakout, and this last thing, maize and blue is buy, yellow is sell, and this is just a very short-term buy-sell indicator I have. So I will look at the constellation of these to find what's working and what's not. Then something that was introduced to me by another trader at one of the Ian meetings 20 years ago. His name was Chris Wilson. I messed up my Chris. And Chris said, look, Jeff, I take my daily chart and I put a weekly indicator on it, which is the relative strength of whatever I'm looking at versus the spider and a moving average. And when that weekly crosses over the moving average, the daily starts a big run. And I want to always find that. So well, that makes a lot of sense. And so I played around with it. And one of the great things about Metastock is on a daily chart here, I am able to plot both the weekly and the daily and the weekly of the relative strength of whatever I'm looking at versus the spider. I want to buy what's working. I want to buy things that are outperforming the market. So a lot of my scans require that relative strength is versus the spider is above the moving average. And then lastly, down here is on balance volume, which is one of the volume things that I learned over the years. John Person used to talk a lot about it. Great guy. And it stuck. He's got better volume tools today, but I get used to something and I'm married to it. And I like the on balance volume. So there's a lot there, but not really. The best supporting actors I talked about, the relative strength versus the spider and the OBV. I had to do a support call with someone recently. Happy to do that. Went over what I do. And we couldn't get the chart to work. And then we figured it out. And I didn't know this. There are two versions. Let's see if we can get out of this right now. There are two versions, at least, of my basic chart. You have the let's see, open. It's not the one I wanted. File, new chart. Well, the two versions, before I go finding and taking up time, you have one that's called the basic MRI and one that's called basic MRI with weekly relative strength. If you don't have real-time data and you open up the weekly one, it's not going to play. Apparently that needs the real-time data to calculate the weekly RSI. So you just want the basic, the one that doesn't have the weekly RSI. Now, I wish I had more time to spend an hours, but Jeff talked about the scans, and there is no question to me, one of the best things about Metastock is the explorations. So you'll notice in my package, I come with a number of different scans, and these scans can be run during the day or end of day. Based upon my type of trading, you can probably figure out I do these end of day, and they give me things to look at. If you're running my product, I use 1200. You're probably okay anywhere between 800 and 1200. If you hit minimum records, you're going to be calling up Metastock and saying the scans don't work. All right. Make sure you're using the right day. So I probably would uncheck this if I was running yesterday's data now, and I put yesterday in, which I'm not going to do. I run my scans, and what you get is a nice report. Let's take a look at the report and talk a little bit about what I scan for. So I like buying things that are, give me trading signals. So the long-term downtrend, this would mean a stock's been going down. We know we don't have a lot of those who've been in a big market. So let's look at a long-term uptrend. And a long-term uptrend, you would expect that the market is going higher, and I want to find the stock that is pulled back to the moving average, and it could have either bounced off that moving average, which means it's going higher, or it could have broken down from that moving average and going lower. Now, if I'm looking at a downtrend, you have to flip that. So if I wanted to look at one, and let's just blindly pick one, which one do I think I want to look at? Let's just look at Abbott. Come on, Abbott, vote for me. I might just cheat because, oh, there it goes. I have a bad habit of impatience. So I've already looked at this, I'm not interested. The reason why I wasn't interested is I guess this is the long-term time uptrend, and it bounced off of it, traded down and bounced, but you got a short-term up here that's blocking it. But I might go through the different stocks in the list and see and I'm clicking on the right. Now this is one that looks interesting to me, a pullback and a bounce. All right, and I would just flip through those little arrows and go through the different stocks, looking for one that has my criteria. Also on Hotel Internet, which by the way isn't the same as being at home. What I did do in the PowerPoint, which I will share with everybody, is let me pull that up here. Give me 1 second. It is from current slide. Perfect. And let's go display settings. Swap. All right, I did include definitions of my dots. You use this slide here, it tells you where they are because you got the numbers, it makes it much easier. It tells you what the different dots do. I actually give you the calculation for my high-low oscillator. I think it's a great way of knowing extension. I used to love it. People on CNBC, the Stokes extended. What the heck does that mean? And then these are the explorations that I have. I run it against a very big list every night. And for each of them, I've identified, all right, this one here is a dual momentum bullish. This is the one that I cheat on. Why do I cheat on it? Because this signal is so good, I don't necessarily look at just those in the best industry groups. And so this is a stock here. We're looking at XERS, which is a biotech. And you could see that it's in a pullback. Here is the long-term trend. It actually pulled and bounced. But what triggered the signal are these two momentum dots in a row. That's why I call it dual momentum. And I have found that over a long time of using these signals, that's actually unusual. And when I saw those two dots coming out of a squeeze with relative strength breaking above the moving average and OBV strong, the only thing it's missing is the weekly. Now the weekly is going to come in later. That's, for all I know, the stock's down 20% today. But this would have been a decent setup. Now, how do I deal with this in the setting of a bad market? And I'm going to have to stop at this point. I suspect I don't buy it unless it takes out the prior high. So I hope you could see that there are a wealth of great stuff inside Metastock. I use all day long these different scans, but I run a big number at night. You could see here was the 800 loaded, and it's over 2,000 stocks, and it takes about 40 minutes to run. But I will share this with Jeff. It has all the different layouts that I use. Jeff has the layouts if anybody has any questions. And I think there, let me just sum it up and say, join the top-down trading group. I do quarterly training events for people online. Frankly, I'm not good at screening. I don't care who comes. If I help people, I help people. I do 2 live seminars. The first 2 things are free. The live seminars are not. I do a cheap one, $300 to $400 a person for 3 days in Orange County. That's the low budget. In Palm Beach, I do one. That's a little bit more money, but I feed you and water you the whole day. And the later part of the year, if you have any questions, just please email me. I'll share my layouts. Again, they don't do you any good unless you got the ad in. And at this point, Jeff, sorry I went so long. Let me turn it back over to you.
You're okay. You did great. I just have one point of clarification for you.
Yes.
With your customer that was having a problem loading the weekly templates, they don't need the real-time version. They just need to pay like a small exchange fee to get the data needed to load.
Oh, okay. Well, that's good. I couldn't tell that because we were trying to load them, and it sort of was frustrating because it works on mine. I don't get it, and you did everything, installed it correctly, and then we switched templates and it worked on.
Like $4 or $5. It's not too much. So
okay.
If you run into that issue, the exchanges a few years ago decided they wanted to charge money, so they did. And so it's just a few bucks to get real-time data for the stuff that's needed. Jeff, thank you very much. I do want to talk a little bit about those tools, so I'm going to jump into there. But Jeff, thank you for spending some time talking to us about it today.
Thank you. Thanks, everybody.
All right. Jeff does such a great job. There was a comment I wanted to actually read to him, but I'll read it anyway. Michael in the chat says, no problem. I have a lot of Jeff's tools. He's an awesome teacher. And I think there's a total of like 5 explanation points there. So Michael, thanks for sharing your experience with them. He does a great job. Trading Profitably says, thanks, Dr. Jeffrey, for another great session. I always like to join your sessions and I always learn from them. So Trading Profitably, I know that's you, Cigar. Good to see you. Thanks for being here. All right. Let's talk a little bit about the add-on. Jeff did a really good job of talking about his top-down or bottom-up analysis, how that works, how to kind of go through it. It does include the Bigo timing model, the dots indicator, the high jump, the relative strength versus the SPY, and then the timing signal. So all of those are actually included. All the explorations are actually included, so you can go in and run your explorations. And For one, I mean, like, why would you want to run a scan? Well, because it allows you to take a big list of stocks and focus on the opportunities. And I do that every day. I've got one running right now. I'm going to be looking at the results in just a second here. But with that, you've got the explorations. It'll kind of go through. They'll kind of identify the buy and sell signals. You've got 3 expert advisors, a system test, professional templates that are put together, the layouts, everything you need to go ahead and get started. And one of the things that's available for you instantly as soon as you sign up is training videos. So, Jeff did a really good job of actually going through, creating some very, very good looking videos. And you can kind of see his style, his temperament, how he kind of goes through things. For me, when he talks about things, I very much understand what he's saying, and that makes him a good teacher. So in any case, the normal price on this, the methodologies, the market MRI is $9.97 as a retail price. Here, as part of the summit, we're going to do $6.97. This is brand new add-on that just kind of came out late last year. We do include it, of course, with a 30-day money-back guarantee, so you can try it. You can see how well it works for you. Great risk reward. If you like it, you keep it. If you don't like it, if it's not helpful, no real reward, or no real risk, no real reward. That's true, but you are going to like it. It's going to be something that you like. It's going to help you find those signals, and that's why we come back with a money-back guarantee. So if you don't have MetaStock, we'll talk about MetaStock right after our next speaker. MetaStock's been rated the highest software, the highest ranked software in this price category by the readers of Stocks and Commodities magazine. We'll throw in a free copy of MetaStock so you can evaluate it totally risk-free. You can do that at metastock.com/marketmri. If you have any questions, you can give us a call, 800-882-3040. And you can go to metastock.com/sales-chat, and all of that information is linked into the chat right now already. So, so there you go. Give it a go. See if you like it. I myself, you're going to enjoy the ability to go in and scan and find the signals and the opportunities that sit there in the market. So, we are going to have a number of people that are going to go through their methodologies and kind of their systems. And we'll talk about this in a second, but we have some really, really good people coming in. All of the speakers are great. But you got Jeffrey Scott's Market MRI. If you want to get all of the offers on today, you can get Jeffrey Scott's Market MRI, Greg Capra's Master Trader Method, JBXC, the Velocity add-on by Rahul Arora, Oscar Carboni's Trend Lines and Toolkits, 3 months of Learn MetaStock. Normally that would be $63.86, but we're really slashing prices. We want to kick this year off strong, $27.88. So you can do that by dialing us at 800-882-3040 or metastock.com/sales-chat. So very, very good. As we move on to our next speaker, I do want to say thank you to you for being here. I want to thank all of our guests and our speakers. They do such a great job and they come and spend time with us. Also want to thank our sponsor, Stocks and Commodities Magazine. Stocks and Commodities Magazine has been sponsoring us for over a decade now. They sponsor all of the events that we do online. And if you haven't yet, you can go register metastock.com/traders-summit. You can sign up for a lot of really cool courses, prizes, and a free month of Stocks and Commodities. So let's go ahead and move on. We're only just a few minutes behind. I do want to welcome our next guest. Our next guest is Martha Stokes. Martha has one of the best salmon recipes that I've ever had. I've had the chance and the pleasure to go and tour the training area that she's got. We called it the TechnoTrader Compound. I don't think that's really the name of it, but she's got a beautiful property up in northern Washington. And one of the things I like about Martha is Martha does a really, really good job of looking at the stocks and identifying what the dark pools and the insiders are doing. She does a really good job. She also does a really good job of teaching. TechnoTrader as a company has been rated an A+ every time I've checked, which albeit is a lot. But it's an A+ rating by the Better Business Bureau, and we love having Martha on. So let me go ahead and kind of get her started. Martha, can you hear me?
Yes, I can hear you. Can you hear me?
Perfect. Yeah, I love it when technology works the first time. Let me go ahead and make you the presenter. We'll make sure that part works too.
Okay.
I can see your
Yes.
screen. Did you
Oh,
want to share your camera today?
I'm sorry?
Did you want to share your camera today?
Yes, I did. Let me get that set up quick.
Okay.
The webcam, let's see, where is that?
I can actually send you a prompt.
Yeah, why don't you? Because I'm share my webcam. That would be awesome. There. Thanks.
There you go.
I'm
Perfect.
spoiled.
I can see you. I can
Everybody
hear
always
you.
wants to take care of me. So, and
Yeah.
I'm a hurricane. I'm chaos. So buckle up, guys, because we have a lot to cover, and we're going to cover a lot of information today. Why AI trading versus human insight, why structure still wins in today's markets. We are an educational company. I retired real early because I started my first business at the age of 9. So I was all done with all that stuff when I was 39. And Howard convinced me to be an educator for the stock market. And I resisted for years and then finally gave in. AI and retail trading. We're getting a lot of information about this. This is the most important webinar I have taught in over a decade. It's important. So listen carefully. Please take notes. AI is totally misunderstood by the retail side. Current efforts to create an AI-based trading system are seriously flawed, and many have discovered that the hard way by losing a lot of money. The most common AI trading system based on red light, green light signal created in 1998 that used MACD crossovers. We have a millisecond trading environment. That means 60,000 transactions per second. We have penny-based spreads. You can't wait for a price time crossover. Other AI trading systems are simply flawed as it becomes a herd mentality with everyone trading the same way. Bad idea, because everything on the retail side is visible to everyone on the professional side, but you can't see any of the professional side. Some of you say, oh, well, I know about whales, and I say, okay, how large are the lots that they're showing you that are the big dark pools or whatever? Oh, 50,000, 100,000, 200,000. This is so exciting. I'm going, you're chasing small funds managers with less than 5 billion assets under management, which are no longer classified as professionals. Using AI as a group sets everyone up in the group for an HFT front run, and hundreds of thousands of professionals, independent traders, they all follow you. They go, oh, yeah, we can front run these guys because we're on the millisecond. You're on the minute. AI providing you with information. The problem with challenges of AI for information and analysis is not AI, but the flaw in communication between AI and you. There are ways to use it, but you will learn a lot more about how the professionals are using it. Example, a retail trader may attempt to ask the AI to look at the Dow stock chart and tell him how the stock market will open the next day. Well, the AI isn't sophisticated enough yet to really do the analysis. So the AI will not use the Dow chart, but will use the search systems it has in its neural net to retrieve the information from the retail side news and data, because that's all it has access to. The professional side already has this information as they transact on the millisecond or the 1 minute rather than the minute scale, which you do. So it's very important for you to pay attention to this. Risk factors of new automated trading. The new AI automated systems increase your risk. Why? Because the automated sets up for organized group structures. Even if you are trading anonymously, which is not true, your retail broker is required to light your order. HFTs, hedge funds, professional independent traders can see all of your broker orders before they are filled on the millisecond. Milliseconds ahead of the market opens, HFTs fill the queues with small orders to become the maker takers of the market. That's what they're supposed to do. The exchanges are illiquid all day long. There's very low activity going on in the public exchanges. So they ask the HFTs to fill the queues. So they do it in the morning and the evening. And you can see these cluster orders that are forming, cluster orders, rather than independent orders. When you have independent orders and you're trading for yourself and trading what is useful to you, then you avoid the cluster orders, which cause HFTs to gap down or gap up the stock and cause you a loss of money. HFTs and cluster orders, dependency and autonomy, over-reliance on AI. There's a risk of becoming overly dependent on AI systems for trading decisions, potentially diminishing human judgment and oversight. It's a neural net. It is not as intelligent as a human, and I'll explain why. So when you have cluster orders, it signals, and of course a neural net is zeros and ones. It's zeros and ones. So cluster orders and HFTs can pick these out of the huge mass activity that's going on. Don't you just love my AI images? They're really cool, aren't they? I asked my AI to create these images of what I was asking for. Market routing systems. Millisecond routing is essential to the market as billions and billions of orders, mostly small lots, are transacted every day with the complex computer systems of the stock exchanges to the clearinghouses. It sort of looks like this, okay? So you have giant dark pools that transact off of the exchanges, but also go to the clearinghouses at the end of the day. They don't show their hand at all anywhere, so they're hiding it. And then we have all these little small lot orders. They're based on price, time, and quantity, and they just kind of funnel down on the millisecond scale, transacted as all the brokers, the retail brokers, shove your orders first to lights, so the payment for order flow from the market makers of the market, which are older banks that have now gone to full-time market making. It's a struggle for the retail, for the professional side. Everything in the professional side costs money. Everything outside of it in the retail, or most of it, is considered something that you should get for free. And the professionals don't particularly respect that attitude. So risk of overdependence on AI. Autonomous decision makings. As AI systems become more autonomous, questions arise about the accountability for decisions made by these systems, especially in scenarios where they might have an unintended consequences. So unintended consequences are always to the downside. Nobody objects to the fact that if the AI is shoving something up, that's not a problem. It's always the downside, because you can cause flash crashes, which cause avoidant buyers the first day and the next day, panic selling, a stampede, herd mentality of everybody trying to get out of the market on the retail side. And the dark pools are going, not again, have to support this. This creates a systemic risk. We had a May 10th, 2010 flash crash, and it was just like, I'm just watching them going, wow, because everything lost a huge amount of money, really crashed. And it was just a fundamental trader accidentally pushed a volume weighted price order rather than a time weighted price. And he lost his job. His company was fined millions and millions of dollars, and everything was put right very quickly. Market volatility. The widespread use of AI by retail trading could lead to increased systemic risks, including the potential for AI-driven market volatility. Volatility is not what anybody wants. It is not good. Flash crash risks increase exponentially when there is market volatility, because the retail side gets nervous. The retail side is very emotional. There's only one reason why they're so emotional. Why is everybody trying to get the psychology and trying to say, okay, well, I got to control my emotions? You're not controlling your emotions because you're not consistently successful. Professional traders don't have to worry about controlling their emotions or psychology, because they're consistently making high profits, and the smaller profits are not something they worry about. So we have to be careful, because we may have automated algorithms that increase flash crash risk. Okay? Relational technical analysis and pattern recognition are crucial, and I will explain this in a little bit because it's a flaw in the AI that we have right now. You need to learn how to trade like a professional in an AI trading environment. You need a comprehensive understanding of the inner workings of the market structure, which is what this course is about today, the webinar. AI is just a tool like you have tools in your meta stock charting software that are awesome, okay? It's just a tool. The market structure is continually changing at an accelerated pace in the past few years as AI started in corporations and in the market way back before way back before we had the pandemic. To understand the complexity of the financial markets, you need to understand first how the market participant groups are currently using AI. It is not what you have been told on retail news. I get all this retail news and I'm going, oh, I got to do something about this because this is so wrong. It's just wrong. So this is usually what I present to you if any of you have been here with my analysis before. And I think I'm just not getting this through to people and they're not really understanding it. 20% of all the market activity is on the retail side of public exchanges. HFTs and hedge funds do trade on the public exchanges. And pro traders will also step up and move in and trade on the public exchanges when it suits them. Most of the time, the professional traders are in early in the morning before the market opens or at the end of the day. And if you look at your charts intraday, you will see these huge spikes of volume and then nothing in the middle because they're not there during the day. You're fighting each other during the day if you're day trading or swing trading really short term. Buy-side institutions and everything are what control the market. So I'm not getting through to you guys, some of you. So I'm going to do it this way. Buy-side institutions, also known as dark pools, are the monster dominance of the market. They control vast quantities. Yes, they have floor traders. They do not use AI. Professional traders that are independent are growing in number more and more. Floor traders are finding out that they can leave their floor trading jobs and make more money on independently. And I have a whole bunch of semi-professional traders who are my students who are trading as a business, and they're really happy campers right now. They've had a great year. Sell-side institutions are greatly diminished. It used to be that sell sides were the biggest on the bottom rung, but not more. So don't believe that the money center banks and financial services, which is basically Goldman Sachs, that's the only one that's left, are the huge influence on the market. They're not. They're reporting this week, and who cares? Only the people that have positioned themselves for their reports or long term. Corporations are heavy into the market structure. They do huge amounts of buybacks. Almost all of the Fortune 500 corporations have buybacks going on. Why is their stocks moving up when there's all kinds of crazy and bad news? Because they're supporting their own stock. And they're investing in AI for the private corporations and different things. And they are investing in small private companies because we have 20 new technologies coming to market all at once, emerging fast. And you're not ready for it because you're behind the scenes thinking about different things on the retail side, but it's moving rapidly and it's going to accelerate. We're not in a bear market, folks. We're in a great bull market that is young and vibrant, and it's growing and growing like crazy. High-frequency traders and hedge funds are a smaller group. A whole lot of them were programmers that tried to do it and got lost in translation during the pandemic. And then there's you. And you are in these groups, and you all trade against you and the HFTs and the professional traders who are in ahead of you. So you need to be aware of where this is. So now we're going to go into buy-side institutions and AI. How much is the buy-side institutions using AI? Well, buy-side institutions use AI 3 to 5% of their entire business activity in 2025. AI is used mostly for quantitative analysis. Buy-side institutions send out their staff and they all visit all of the 4,000 or 5,000 companies that they have money in. They've accumulated them. They hold that in, and so they send their quants out there, and they go and analyze, talk to the CFO, get to see the open books and everything. Very, very efficient. 2 months or a month and a half into the third quarter or the fourth quarter, whatever, they already know what that's going to be. They already know. Their floor traders do not use AI for trades. Floor traders use AI for routing and for tracking retail activity. Everybody's watching you. Everything you do is visible. You can't see the trader. You can't see the buy side. If somebody tells you you can see buy side institutions, they're not telling you accurately. They're telling you that smaller funds are what he's tracking. So be careful. Sell side institutions and banks and financial services has greatly diminished. The big money center banks have huge trading floors still. Their floor traders do not use AI except for routing orders. Oh, you were told that they were using AI, right? This is straight from the banks. Banks have used AI a mere 3% in 2025 and may boost to 6% in 2026. Banks use AI to replace traditional bank tellers, human beings that are low income. Very low income tellers get no money at all. Robo-advisors that have been around for a long time, an online chatbot based on banking access. Money center banks act as market makers and do the corporate buybacks. They also trade heavily. They love when you panic and you start selling. They love flash crashes. They make a ton of money. They make more money selling short than they do with the buybacks or anything else. So when you're in panic mode or in herd mentality mode, and you've not been prepared that this was going to happen, that the flash crash was going to happen or had potentially happened, then you panic. HFTs. High frequency trading companies have been using AI for several years and use it extensively. They have had to modify their use due to the flash crashes that occurred in many stocks in recent years and in the indexes on April of 2025. HFTs use AI primarily to track retail activity to front run as the market opens, and professionals use AI at the end of the day as the market closes. So everybody is watching you. That's why they're using AI, because it can go out and it can gobble up all this information all over the internet. Google Gemini is really great for finding all kinds of gossip, or social medias, chat rooms, anything that's live and open that anybody can access, they can see. And AI can manipulate that information in a matter of seconds and tell all these guys what you're doing, what you're planning, what you're going to do. Hedge funds. Hedge funds use AI similarly to HFTs and the sell side banks. The goal is to be contrarian, selling short, to take advantage of the sudden retail induced void of buyers, which is followed the next day by retail panic selling. So you have all these new young investors and millennials and all these people, and they have their ETFs because they know they can sell that ETF anytime they want. They're not going to suffer like their parents did and have mutual funds where the redemptions of 2008 were held off for months and months, and their parents lost a lot of money. They're not going to do that. They have ETFs. Yeah, they're just doing that. That's just great. And they know that they have control. They get home at night and they turn on the TV or the radio, or whatever, Alexis or whatever, and they listen to the news. And they hear that the market has been down, and it's down huge, a whole bunch of, it's 400 points on the Dow. It's like, are you kidding me? That's not huge. But that's what they're saying. And so the next morning, they panic and they wait and they hear about it. So either the next day or the day after, as it's going down a little bit more each day, they get scared and they sell all their ETFs. Flash crash. Flash crashes are instigated by retail groups. Corporations. Corporations have been using AI for several years. AI is customized specifically for each corporation. They don't have the AI that you have. They have one that has been customized, and it was started in 2018, 2019 that they were customizing these. This is a private AI that has no contact with consumer AI. So you don't know what the corporations are doing with their AI. They're using it mostly for hyper-automation of the IT departments. It is a common use of AI. Hyper-automation is being able to streamline an IT department from having 100 or 200 programmers down to a handful. And that's happened on all the major corporations, all of them. That wonder why IBM is doing so well? Hyper-automation. Also, more and more corporations are buying AI integrated robots. This robot can even replace its own battery. Take it out, put a new battery in. Okay, so Why would they do that? Well, first of all, we still have 7.1 million job openings. The average is 3 to 4 million historically. Okay, so we have a huge number of job openings. They're all high end, they're all high pay. So in order to pay for those high pays and compete for those university kids that are coming out of school that are top of their class, because they go to the universities to pull them out, they need to get rid of some of the low wage earners and replace them with robots. A low wage earner on average for an average wage on assembly line or something is about $50 by the time you figure in all the benefits, the 401ks, the sick pay, the L&I, the taxes, on and on and on. The employee may only make $20 an hour, but it's costing the corporation 50. Guess how much after it's set up, a robot costs? 8 cents an hour. Yeah, there's no contest here. And the government has told them that we can just write off all of the expenses in 1 year rather than depreciate. And the corporation's going, yes, we're going to save taxes. We're going to lower our low-end employee costs. We're going to get rid of all that benefits and everything. We're going to put robots here, and they can work 24/7. Yeah, really. Summary. The professional side of the market, which controls 80% of all the activity, every day doesn't use AI to choose stocks to trade, nor should you. AI is used to track retail traders, retail investors, and small funds activity, trading their clients' money badly. No matter what AI you choose to use, the professionals know every detail, every decision, every mistake. Yeah. They react on the millisecond time frame, which is 60,000 transactions in 1 second. Learn to trade with the professionals is more important now than ever. That's what my whole focus is. You can learn all kinds of, everything you've learned is useful. Everything you've heard in webinars and everything you do on Metastock is useful. But if you want to become semi-professional or professional and make the 6 to 7 digit income that they're making, you have to advance yourself. It's not for everybody. A lot of people are just happy dabbling in what IRS calls a hobby trader, and that's fine. But those of you who have a passion and a desire to be financially secure, consider what I have to offer. What is the hardest thing for AI to learn? Is there anybody out there? Jeff, do you know what is the hardest thing for the AI to learn? Anybody? No? Okay. Language. There's no language in AI. It's no neural net. It's all zeros and ones. So it's alien to it. An 8-year study by Microsoft, which started the whole thing in the 1980s, they go, we should do an AI. We should have artificial intelligence. And so they started that way back then. They did a study from 2014 to 2022, proved that language was a barrier that thwarted integration of AI in business, financial markets, and so on. AI did learn during that period at an extremely slower pace than a human. Why? Because language is not natural to AI neural nets. It is as hard to understand and apply as it is for you to understand the inherent hidden risk factors of using AI. It all sounds so easy. Just let an AI do this, or AI can figure this stuff out. But it's struggling to understand what you want. This creates even more risk for retail trading using AI exclusively. It's a tool. Add it to your Metastock stuff. You know, use it in your Excel program to take, I'll show you that later, to help analyze things. But don't ask it to do all of the work for you. The stock market and financial markets have their own unique language that AI has not fully learned, nor knows how to interpret accurately, because there's a lot of linguists, there's a lot of metaphors, there's a ton of little cliches and things, and it's going, it can't disseminate it. Therefore, all AI technology offered to retail traders is flawed often inaccurate and subject to AI misinterpreting the market language. It hasn't learned it yet, and it will be a long time. That's why nobody is using it for trading. It's like, oh, are you out of your mind? How well you continue how well you communicate to the AI will create entirely different results. This increases your risk exponentially when you become so dependent upon AI to make decisions for you. It can't make decisions. It's a tool. Metastock has tons of tools. Those tools can't make decisions for you. You have to, because your brilliant mind has a complexity that AI isn't even nearly close to at all. So this is a candlestick chart. The candlestick charts are a language. Every single one of these candlesticks is a piece of language. It is like music or whatever. And if you say to the AI, go out and find in my Metastock charting software, go find all of the engulfing whites that appeared today, it's going to cough up a whole bunch of them. But you can't say, okay, now trade these. You have to go through and you have to say, is it really an engulfing white? Is it an extended long exhaustion pattern engulfing white? Is it an engulfing white that was preceded by a black candle sandwich? So it's just the little pop before the next black candle sandwich and it goes down. Is it related to, is it a long candle and it's running up speculatively and it's hitting a resistance level? It can't tell you this. Your indicators are supporting tools as well, which help you define the language, and you know this language. And my students learn pole vaults and hurdles and nesting candles and all the new candles that are forming in our market that aren't in the traditional candlestick books, because they are more important. There's a lot of little tiny dojis that form nowadays, and everybody takes them for granted. They're the most important signals. They're the most important thing about language. And with the hybrid leading indicators that I teach and I created for Metastock, it helps confirm, yeah, that's an entry, but it doesn't look like one. It doesn't look like one. TechniTrader and Metastock. AI is a tool, and it's a great tool, and it can help you. It is not going to fix what is wrong with your trading. Are you an emotional trader? Do you need to be in a group and everybody agrees to trade this stock? Do you hesitate? Have you made chronic losses and now you're a little uncertain and your self-esteem has gone down? Money tells us what we're worth in our society. When we lose money, our self-esteem and self-confidence goes down. You have to get rid of that, and the only way to get rid of that is to have a consistent profitability. TechniTrader tools for Metastock are set up precisely for streamlining your stock analysis. Ta-da! We have tools in there already that act like AI. They're not AI, but they act like them. This makes integration simple if you want to use some AI. The most common flaw of using AI is to choose stocks for you to trade. It is not caused by the AI. So if you have an AI choose a stock for you and you lose money, it's not the AI, it's that it can't understand what you want. Miscommunication from the person is the #1 problem, and it's not going away anytime soon. Retail activity using AI improperly has created market anomalies. The April 2025 flash crash of the entire stock market, all the indexes just went because we had an event that wasn't a real event, it was a non-event. There was a void of buyers. Everybody says, oh my gosh, we have this and it's going to destroy everything. And so everybody stopped buying. And then the next day, HFTs were set and they gapped it down and ran it down. And yeah, it was great. It was amazing. And if you got in early, it was a ton of money. AI and market anomalies are very common. We can see it start to build where there's an equal more buyers than sellers. And then all of a sudden it starts turning to more sellers than buyers. So we have this flash crash potential building up. And it's something that you can watch in your charts and in your market condition reports and all the things that I give to my students. So the market anomaly, this is from a professional trader. And so flash crashes are becoming more common. What is a flash crash? A flash crash is sudden, huge gap in a stock chart, and then it runs down even further. And then the next day or the following day, all of a sudden it moves right back up to the first tier level. It's a common thing that happens in stocks. We've had a lot of them in recent years around earnings, and we're just starting an earnings season right now. Are you ready for it? Because you may be buying in on a pre-earnings run and think, oh, I'll just wait until earnings says they're going to have a great earnings release, and suddenly HFTs have crashed that stock down with a huge amount of sell orders because of some teeny tiny tweaky bad news that came out on the retail side. And the corporations then go, oh, okay, we have to support our stock, so they start buybacks, or buy side institutions go, wait a minute, this is a bargain stock, so we're going to buy it and push it back up. AI impact. It is called the K economy. New word, same old, has happened many times in history. I checked it. The K economy creates a much larger divide between the wealthy and the desperately poor. AI is replacing thousands of human workers in 2026, and this will continue. And you say, well, how can we have a strong economy if all these people are being laid off? Because they're the lowest paid workers. So they don't have a lot of extra money to invest in the stock market, and they don't have a lot of money to buy a lot of consumer products or expensive products or leisures or cruises. They don't have it. The huge corporate growth moves more and more wealth into the stock market. The robots being incorporated into corporations is a huge boom. It's lowering their payroll costs, and they can afford to pay higher end, really elite of the elite university kids that are coming out, and they're going to go into business, and they're going to be hired by all the major corporations. Are fighting over these young people who have financial services degrees or other degrees in technologies that they desperately need. They can lay off 10 or 20 lower income and pay a higher wage to their university grad, or their master degree grad, or the doctorate degree grad, and they can save money because it's 1 over 10 or 20. So they're going to do it, and it's not going to hurt the economy. It's going to make the economy prosper. Those who learn to generate monthly income will ensure their financial security. So what I do is I teach you how to generate monthly income as well as invest long-term. You need to do both. High income earners will make even more money because we're reducing the cost of payroll for the corporations. Low wage earners will lose jobs and struggle even more than they are right now. And we know they're struggling. People are struggling. So the lost jobs. Corporations are replacing lower income employees with robots, robotics, and AI. This means the upper middle class to wealthy will prosper and have plenty of investment and trading income to have huge gains as this great bull market continues and grows and expands. It's just my opinion, and it's a humble opinion. It's not a prediction, but with 20 new technologies coming to market, all emerging very close to each other, back to back every few years, that this bull market will be one of the longest in histories. The prior longest one was between 1987 and 1999, 2000. The lower middle class of America will drop into poverty because they're right on the cusp of it right now, and they will lose their jobs. The middle class of America has choices to make. You may or may not be in this category. The choices are drop into low middle class and struggle, or start learning to trade with TechnoTrader. Because what I teach is trading as a business. So you have a small business that has huge benefits. If you're American and internationals, they offer this trading as a business because they have to be equal to all of the people who pay taxes. So it's just an opportunity. What pro traders know that retail traders do not know? And this is a common screen layout. Again, I asked my AI to show me, and it did a nice job. What is market condition? Market condition is the cycle of the bull market or bear market. Bull markets have lasted as long as 13 to 15 years. Bear markets last 1.2 to 1.3 years. So the cycle of the bull is longer and has more complexities to it. And the bear market is pretty straightforward, down, down, down. The bottoming market is controlled by the dark bulls. Always, they make the bottoms. So why aren't you focusing more on bottoming market conditions and bottoming stocks? Because that's where the pro traders are putting nudges and hunting for the dark bull, because often they can't see it if they're on the outside a little bit. If they're not in the dark pools themselves, they can't see the activity, but they see it on their candlesticks. They see it in their hybrid leading indicators. And those are the signals that tell them, okay, we've got it. Platform market conditions, retail side and smaller funds are still scared to death that the bear market isn't over. They're still trying to get out of stocks while the bottoming has developed and the platform is controlled by dark pools. Moderately trending or downtrending now takes over. The dark pools have got all of the shares that they want to hold for a period of time with those two market conditions. Now they're going for the moderately uptrending. They let everyone know, just like retail gurus, everybody that's famous investors, they let every kind of trickle it out that, well, we've been buying this, we've been accumulating this stock and this stock and this stock, and then boom, pro traders all over it. They're putting nudges and everything to hit the HFTs. The HFTs respond because they see this this activity that's going on from the professionals, and they start running the stock up. And then all of a sudden, retail small funds managers are chasing that stock upward. Moderately downtrending is much faster. Velocity up or down is when the pro traders sit back and go, all right, we got everybody excited and they're buying like crazy. And we're just going to sit back and ride this wave, but they're looking for resistance. They're looking for all-time resistance. They're looking for strong resistance. They're looking for previous fundamental resistance that might have gone down and that type of thing. So there's all kinds of resistance levels that they're monitoring. When they see a resistance level coming in, they're going to start quietly and very carefully selling against the buyers that are buying. And there's enough buyers to keep pushing it up while they're selling. They're not worried about getting out of the exact top. And so their candles form these little teeny tiny candles. These little resting days is what I call them, before another surge up oftentimes. But what happens at the last is a sudden huge collapse because there's a void of buyers. At some point, all the little guys run out of money and there's no big rush of buyers. And then it just collapses right down. So the next day you lose money. Topping market conditions start with the buy-side institutions bending and bending and bending the trend, and then pro traders and the sell side see what's going on. They go on. Trading ranges are very rare. They're common in individual stocks, but long-term, very, very rare. The last one was in the 70s. But they do form, and when there are trading ranges in a stock, it means that the buy-side institutions are not interested in that stock. They're not necessarily rotating out. They may be a little bit, but they're not interested. So that's something they know. My scans, how do you do this? Well, years ago, thanks to Metastock and everything, I said, okay, how many stocks are moving to the upside versus how many stocks are moving to the downside? That's the bias of the market today. I have my own AI already set in here. It just coughs it up every day for me. It's like, wow, that's so cool. It's not an AI, but the structure of the way the Metastock is that you get to use this. And then I say, how many stocks are being accumulated by institutions? Because I have hybrid leading indicators which reveal where they are. And it tells me, oh, well, they're accumulating pretty steadily. And I can watch this on my Excel sheet program that they're accumulating pretty steadily. And then I say, how many stocks are in consolidations or how many stocks are in bottoms? Because again, I know that the dark pools are the only ones that create bottoms. And so it tells me how many stocks are bottoming. Wow, I have my own AI here. And then I have consolidation scan, which I know that pro traders have gotten to this little teeny tiny candlestick patterns that are barely a couple of pennies wide. And so I want to see that. How many are in consolidation? And then I want to see overbought versus momentum sell, because overbought would be an indication that the market would be ready for a correction, either short-term, intermediate-term, long-term, tells me what that's going to be. And then I ask for strength. How strong is the price gains over the past so many days? And it's adjusted for each student based on your trading style. And then you can see how well that price improvement is being done. So these scans are all in Metastock. I designed them for Metastock. They're only found exclusively in Metastock. They're awesome. No, I don't let them out to people because I've tried that and they, just to buy the scans, but then I have to educate you because they're something you have to learn to use. Just like an AI tool, you have to learn to use it, but they're awesome. So market condition analysis tells me who's in control of price. Dark pools, retail, who? What technical patterns are prevalent and reliable? How will price behave at resistance and support? It'll be different for each one. What trading style works best for that particular market condition? Because it varies. What indicators to use? Does everybody know what a style is versus a strategy? Styles are your basic parameters for trading. What indicators to use or to tweak, because swing traders will tweak their indicators just a little bit tighter. Position traders will move them out a little bit wider, that type of thing. Day traders have to keep them really tight. The inherent risk and trading specific styles. So different market conditions have different risk factors, and you have to calculate that in so that you only trade the highest probabilities stocks and avoid the high risk stocks. What trend line patterns are common? You've learned uptrends, and you've learned downtrends, and you've learned neutral, and you've learned non-trending and volatility. But there are trend line patterns within all of those, and nobody teaches that, and I don't know why. Which entry and exit signals are most reliable? You have to use the modern leading indicators. There's Western candlesticks, I've mentioned some, that are completely different signals than what you learn. The Candlestick book by Steve Neeson is perfect. That's the perfect place to start learning candlesticks. But once you become proficient, you want to become a semi-professional, then you need to learn the signals of pro traders, dark pools, so on and so forth. The strength of the price volume patterns, how strong it's going to be, is it going to continue? Market condition analysis tells you how and when to trade, who is in control of price, what to expect in near-term price action, where to find excellent picks, how to enter, when to exit. Market condition analysis is your GPS AI, which market participants are actively trading, which are sidelined or waiting, and where we are in overall long-term, intermediate-term, and short-term trends, because you need to know that even if you're day trading. This provides the relational analysis needed to navigate the complex marketplace of today and beyond. Relational analysis was introduced as CMT in 2015, and lots of them use it, and people come to me to train for that from the CMT. So we have charts and layouts and scans. We already have scans looking in Metastock because it was already set up in a format that's very similar to AI. And it gives you a list of stocks that are moving with all these criteria. And the criteria is customized and you use specifically how you trade. You need to learn to trade independently. You need to not have to worry about trusting someone else to tell you what to do. That will only lead to disaster. So the technical trader difference, professional level education, relational analysis, hybrid leading indicators. Nobody else has. We have a professional style trading journal for all of you that are trading as a business or want to. It provides the written evidence of your trading activity for the IRS and also historical data to consider and compare over time. This is a great place to use an AI sort to study over a month's time how that market moved. It's a great place to add that tool. Your personal trade management planner that provides a clear plan for achieving annual, monthly, and weekly trading goals based on your capital, your number of trades you can do per period based on your capital, stock price range, and your profit potential and risk tolerance or allowance. So you have all kinds of information that you plug in here. You plug it in, and boom, it comes out, and it tells you exactly what you need to do for that month or that week. And my students go, but Martha, it's so few trades. Is this right? And it's like, yeah, that's right. Less is more in the stock market. The professional traders don't trade every day. The professional traders plan and strategize. They have their whole year laid out, their month laid out, their weekly laid out of everything, and they go on that knowing what's going on. And it's shocking for most of my new students to realize that they've been over trading, and that's what's causing all of the losses. Trade calculators were written by Howard Johnson, so was the trade management. awesome tools that streamline accuracy and execution. It just makes things easier. Plus, it does the one thing that causes most of the losses. It does the math for you. Awesome. Scan, sorts, and layouts and parameters are mine for your trading cycle and for your trading style and market conditions. And this is awesome too. I lay them out for myself and then we tweak them for our students. Trading simulator must be a real simulator, not a game simulator. Why? Because you have to get accustomed to the real market. If you're using a game simulator, it's going to have you win when you're losing. Market condition analysis scans are mine. I developed them. They're very important. Control bracketed order types designed to eliminate poor error fills. Howard Johnson did this, and it was amazing. I've told the story many times now. He talked to a market maker on the New York Stock Exchange at the time. The market maker was blown away, asked if he could use it on his floor. Howard, of course, said yes. And today they still use his order in various types on the professional side, buy side, and sell side. So you're learning something that professionals have. Morning market open reports and market condition reports are written every day. I use that on the market condition analysis that I do, and students learn how to do this and formulate it for their own. I trade AI with it. To summarize it, it was a disaster. My fault. Daily market indicator, discussion groups and communities within your fully online course at TechnoTrader. Our communities and discussions and our online training is all private. So nobody can get in to find out what we're doing. Nobody can front run my students. Tutoring of new students and answering all of your questions is an on-time thing. We even are doing it on the weekends. We're so committed. I just love teaching. My staff is totally dedicated and totally amazing. So I want you to test drive TechnoTrader. Now, I will tell you right now that we're not right for everybody. We are a niche. We are a very special boutique educational program. We are customized to professionals who come to me, people who want to become semi-professionals. I have a student that became a hedge fund manager, owned his own hedge fund, and so on and so forth. So we have the gamut. And wouldn't it be lovely if you could be in a discussion or community group where you have professionals who are commenting, we're commenting every day, and you're learning in this amazing environment. And HFTs and hedge funds and all the others that front run you can't see a darn thing. I love it. Anyway, if you're a brand new beginner, please test this out. This is a mini course. It will show you how we teach and show you how you can improve. If it's not right for you, you don't have to go any further. If you're an intermediate and you want to learn the professional trading plan, Howard teaches this one. And it's a mini course again, and it shows you how that works and why it works. And you'll get a lot of information. If that tickles your fancy and you want to become a student, then we move forward. If not, no big deal. A relational technical analysis is for my people who've been in the market 10 to 40 years and are still coming to webinars, trying to find that magic bullet, or because they learn something every time. Well, that's great and wonderful, but why aren't you making 6 or 7 digit incomes? If you've been in the market that long and you haven't made 6 or 7 digit incomes, my students have. Well, I had a student that said, Martha, I made more money. She's an MIT grad, stayed at home, raised her kids, and she made more money in the stock market position trading than her husband did at Boeing, and he was a top manager. So where does this fit into a complete trading process? Everything we've talked about today fits into a much larger decision-making framework, which is what you need. Tools like Metastock are incredibly powerful, but tools alone don't tell you when to trade, when not to trade, how to adjust when the market conditions change. That's where the Methodology Essentials courses comes in. It teaches a complete professional process. How to read the market condition first, how to interpret institutional pressure, and how to apply indicators correctly instead of reactively. If you've ever felt confident in your tools, but uncertain in your decisions, that gap is exactly what the Methodology Essentials is designed to close. So we have all these different things that are going on. So let's see what we have for you today. there's all the people that are saying, oh, Martha's great and wonderful, so is Technotrader, all the people. I have 50 pages. We've been in market going into our 27th year, and we have had an A+ rating all that time. Students are constantly telling us how great and wonderful we are. It's wonderful. So we have this market condition, and it's daily market educator. It includes the market condition for the day and a brief summary. And we're offering this to you. You have to sign up for 24 hours. Jeff can put this in the slot so we can have that. You get to read market conditions each day, how I analyze. You get to identify institutional liquidity draw and dark pool activity. So I'm telling you how it's working. You decide when not to put in a new order, because you should be having many orders, and there are days when you don't need to put in a new order. You're just riding the run. Adjust strategies and conditions as the market changes, and I tell you when the market is changing. This is the same process taught step by step in the Methodology Essentials training program. In fact, these studies are here, included 1 month of the course and simulated. We have all these things that are included in the course. It's massive. But it is, I hadn't had a student that said, Martha, even people who've been trading for 40 years, or a 96-year-old, or my 8-year-old, I loved her. She was so good because she just followed the rules. But she goes up. That they go, I have taken many courses, and this blows me away. And this is what my students say. So join up for the trial. And see if this is right for you, because you'll be working with me. I'll be talking to my students. Sometimes students have questions, and so I answer it in the DME. Some days I focus on a specific thing like biotechnologies or whatever. Other days I'm doing information on indicators. Every day is different. It's an ongoing educational subscription. And so you'll have 5 days of this to access, and you will find it a blast. Whether you become a student or not, you will love being part of this and experiencing this. So sign up. You got 24 hours to do so. Jeff, have you got it in?
I did. Absolutely did.
Okay.
I
we got
checked to make sure it worked. All right. Are you done, Martha?
Yep, I'm done.
Okay. 5 days to access that. You need to do it within 24 hours. The link, you just have to click on it in the chat. It'll sign you in. YouTube, just just click the link in the chat. Thank you so much, Martha. I appreciate it.
All right.
All right. And always great job.
Thanks.
Okay. We go ahead and do this. I'm going to go ahead and take over for a second. Let me make me the presenter. We're going to show my screen. Martha, as always, great job. We need to have you back in for another podcast.
Thanks.
All right. Thank you. All right. Okay. As always, we do really appreciate Martha, the work she does. She does such a great job. The tools that she's designed and put into Metastock do a great job. And so go ahead and sign up for that offer. It's a free 5-day trial. I did ask her when we did our podcast earlier what her favorite course was, because she's done, I think, hundreds of them. And it was the methodologies or the essentials course. So take advantage of that. Click on the link in the trial. Click on the link in the chat for the trial. I got it, and that'll get you there. So we're gonna go ahead and kind of move on today. We do have a great lineup, and we're off to a good start. And I'm next anyway. So I do want to remind you, if you do want to, we do have a package that includes all of the add-ons that we're selling here directly here at Metastock and the training, everything that we're going to talk about today. It includes Jeffrey Scott's MRI. He started us off today. Greg Capra's Master Trader Methodology, the JBXC Complete, Rahul Aurora's Velocity, the 3 months of the Technical Trend Lines of course, 3 months of Learn Metastock Premium. Normally, all of that would be $6,386, $2,788 if you do it today at the summit. So with any questions, if you have questions about Metastock or the event or the class, type them in. We do a pretty good job of keeping track of the questions, answering them, putting them into the chat and stuff like that. But I also want to let you know you're welcome to give us a call. You can call us at 800-882-3040, and you can go to metastock.com/sales chat. So hope you're enjoying the event today. As we move on, I do want to encourage you, if you haven't yet, I've talked about this before, we have a growing community of people that are traders, that are serious about technical analysis, that have some really good ideas about what's going on. We have a live market chat, tons of lessons, tons of different things that you can do. Totally join for free. Lots of resources up there, thetradersforum.com. If you come in, I hope you join us for kind of our indicator study lessons or our market reviews or just even our market chat, which is open all the time, thetradersforum.com. So there we go. Let's go ahead and kind of switch over to me. This is me. I hope everybody's doing well today. I hope you're enjoying the event. And I'm going to talk now. So I do normally kind of kick this off, and I'm supposed to, hold on just a second, with a little bit of a legal disclaimer, but I forgot to put a copy of it there. I do want to keep my lawyers happy. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse a purchase of a security, nor are they paid for the promotion of a security. No information contained in the event today should be construed as investment advice or the solicitation to buy a security. So I hope you enjoyed that. Let me go back to where I was here at the, let me just find my spot. Here we are. Let me go ahead and tell you a little bit about me. All right. So my name is Jeff Gibby. I've worked here at Metastock in next year. Well, I'll just say it's 29 years. Only 29 years in just about a month or so. Great company. I started in inside sales. I've used the software almost since the day I started. And I've been trading for decades now. Absolutely love it. When I started, I didn't really know what a stock was. I didn't know what a future was, and they did all the training and that kind of stuff. I started in inside sales, and for about a decade, I just helped people figure out why they weren't making money when they should be in the markets, what opportunities they were missing. And so I was in inside sales, a great role. It's always been a great product. We have a great support staff. We have a great collection of training videos, everything you need to get started. After that, I kind of moved over into our business development team, and I've had a chance in our business development team to work with some of the greatest minds in trading, Steve Bigelow, Dr. Alexander Elder, everybody that speaks here today, John Bollinger, you name it. The ability to work here at Metastock and use Metastock to help me with my own personal trading has been such a great time, and I really enjoy it. So I want to thank you for coming in. I want you to thank you for being part of the event today. I hope you learned something, and I hope I can teach you something in just a minute. So there we go. In terms of Metastock, I'm just going to talk a little bit about that. We'll kind of play with this software for the next hour or so, but more to teach you something. I do, and I am proud of, and I do want to say that Metastock has been rated the best software in its price category for 32 years in a row. So for those of you that have been using Metastock for decades and decades, thank you. We appreciate it. And thank you for voting for us year after year after year. It is something that I wouldn't trade without. I don't think I know how to. I love the ability to do that market scan and find those opportunities that kind of fit in to what I'm looking for, and ignore the ones that don't. So today I do want to teach you some stuff. We want to talk a little bit about, we're going to go down to the basics of technical analysis. We're going to talk about MACD, how MACD can help you with your trading. And I think, you know, I've been doing this for long enough. I've seen so many people come into the market, and maybe they inherit some money, maybe they've been saving some money, and they just want to start trading. They've heard that investing is a good idea, that people should invest and save, and that kind of stuff, but they don't come up with a plan on how to trade. And so a lot of people listen to kind of like what their uncle is saying and that kind of stuff. I always think it's important with any venture that you're doing, especially trading. If you're going to start a business, for example, are you going to go into business having an idea of what your product is? Of course you're going to know what your product is. Are you going to know what you're going to pay for it? Do you know what your margins are? Are you going to know what your cost is? Of course you're going to know about that. With trading, then you always know what your product is. But you can always go in and, like Martha was saying, simulate what you're doing to kind of make sure what you're doing works, that it works over time, that it's profitable, and that it's effective for you. So I want to talk a lot about the importance of building a trading plan. I'm going to tell you about one of the most popular indicators out there. We're going to kind of do a lesson on MACD, Gerald Appel's MACD. And after that, we'll talk about how you can kind of understand, is this an indicator that works? What does it work on? All that kind of stuff. And then I will talk about scanning a little bit as well. So that's where we're going. Let's go ahead and go to the next slide. I'm curious to know, and I am going to kind of sweeten the pot. If you get this, if you answer the question right, I am going to mail you a prize. Okay. So, but you have to be the first person to get it right. So the question is, and you can answer in the chat, you can answer in YouTube chat. The question is, what is the best profession for trading? Okay. And if you're the first person to get the right answer, the answers are teacher, educator, engineer, architect, psychologist or psychiatrist, pilot, performer, artist, musician. So A, B, C, D, E, F. If you're the first person to guess that, I will go to the mailbox. I will go to the post office, and I will mail you a prize. What prize are you going to get? Well, I got them right here. So we've got Steve Bigelow. I mentioned him a minute ago. Very, very good friend of mine. Passed a few years ago. Had a huge impact on the trading that I'm doing. But I'm going to send you his books. I'm going to send you 2 of his books, his second and third book. I'm going to send you a copy of Eliminating Emotions, and I'm going to send you a copy of High Profit Candlestick Patterns. So I do see a couple of votes coming in. What is the best profession of trading? I only see 1 vote. Got some really good books in here for you. Is it a teacher, educator, engineer, architect, psychologist, psychiatrist, pilot, performer, artist, musician? Kevin says F. I think that actually a musician might be, there's a little bit of a rhythm to the market that might make a lot of sense. Some other things that I might think actually makes a little bit of sense based on some of the people I've worked with is psychiatrist or psychologist. Dr. Alexander Elder is a very, very famous trader. He would come into my trading room trading for a living. He was a psychologist. Jake Bernstein, who's going to talk right after me, has a lot of really, really interesting stories about when he used to work as a psychiatrist. You could tell me that was a valid answer, and I believe you. Lee Sun says C. Michael says D. William says A. So we're getting a lot of answers. The actual answer, and the first person to get it right was John. John, congratulations. You're the very first person to type that in. The correct answer is pilot. So thank you for that, John. Appreciate it. A pilot. And I've kind of thought about that after I read the study. Why is that? I think it comes down to discipline. A pilot, that number one, they're very well prepared. They understand why they're going to trade. Number 2, they're very disciplined about what they're doing. When a pilot gets in a plane and they take off, they're going to have a very clear checklist of rules. Like, I'm going to pretend this is a checklist, and they're going to follow that checklist every single time that they take off, every time that they land. Discipline. And so there you go. Michael, you also had that answer, but I'm sorry you weren't fast. And William, thanks for guessing. Maverick says engineer. You could make that argument too. I do think discipline's a key part of trading. So this is Richard Dennis. If you're not familiar with Richard Dennis, he's got a very, very interesting backstory. He was actually called the Prince of the Pit. I think I have some notes in this slide. I might not. Okay, so yeah, we have a few notes that we can kind of just talk a little bit about who Bill Dennis was. He was one of the original turtle traders. He borrowed $1,600 from family and friends to start trading back in the, I think it was the 70s, early 80s. And he turned that $1,600 into a reported $350 million in 6 years. Very, very famous traders. He believed you could teach trading. He said it's something you can teach. All you need is a little bit of discipline. He brought in Bill Eckhart, which was a friend of his, who says, like, no, you can't really teach this. It takes a certain style of mindset. It's not something. So they had a little bit of a gentleman's agreement. They brought in a bunch of people. It was called the Turtle Traders. They taught him how to trade. It was, I think, 23 traders, 2 of which were female, 21 of them were male. They funded him with their own money. They taught him a trading methodology, and they made an aggregate profit of about $175 million over about 5 years. And that was called the Turtle Traders. What he said, the quote that I like from here, and why I put it in the chart, was, I always say you could publish my rules in a newspaper and nobody would follow them. The key to trading is consistency and discipline. And I think that's why it's Pilot. All right, we have some notes here. Maverick says, I have an engineering, I can't, I gotta move this out of the way real quick. Maverick says, I have an engineering aviation background and it helped immensely in the transition for trading. Jay, I'm sorry if there was an email that had the wrong information today. But if you email me, Jay, it looks like Jay got some information that said thing about long-term and short-term trades. Jay, email me, I'll send you that. I have plenty of copies of that one as well. So in any case, I'm prepped to do this one though. So very sorry if there was some information that went off that was incorrect for the title of the presentation today. We are going to talk about MACD though. I would be happy to mail you that presentation, and maybe I'll do it next time as well. Today we're going to talk about Gerald Appel. You might be curious as to why I want to talk about Gerald Appel. Gerald Appel, very, very famous technician. He died a few years ago. While he was alive, he wrote one of the most popular indicators called the MACD. As some background on him, he developed the MACD about 40 years ago. He wrote 17 books on investments and 5 books on photography. And he had a newsletter that published for over 46 years called Systems and Forecasts. Okay, let's talk a little bit about what I want from you now. Is if there's some symbols that you want to follow, put them in the chat and we'll open them up and we'll kind of talk about MACD with your symbols. So if there's anything that you want to particularly look at, put it in the chat. Otherwise, we'll go with something that I kind of want to look at. But I don't have anything particularly prepared. I think it's really easy as a presenter to go in and find really perfect examples, especially like with the technology today of what you're trying to show. And that's not something I want to do. Trading is messy. It involves wins, it involves losses. So give me any stock symbols you want to look at and we'll play with that. When we start to talk about MACD, there's some things that I would call advantages for it. One is the fact that the MACD is very objective. Technical analysis in general is pretty objective. And that's one thing that I really like about technical analysis as opposed to other forms of analysis. Everything that I show you when we start to talk about MACD is going to be geared around stuff that is measurable, stuff that's witnessable. We're not going to be looking at and trying to kind of guess what tariffs are going to impact the market or what the Fed interest rates are going to do to the market. A pure technician would always say that price is the reflection of all given information in the market at the current time. It's already discounted into the price. Another saying was from, and I'm going to paraphrase this because I'm kind of ad-libbing today, but Steve Bigelow would always say, the fundamentals of the market don't matter. It's how the market perceives those fundamentals. So the reason that I like technical analysis is this is objective and not subjective. We're not trying to kind of guess. What we're looking at is an objective way of looking at the thing. Okay, it's pretty easy to interpret it. I'm going to kind of talk a little bit about how it's calculated, 3 different ways that you could, the 3 very popular interpretations of it, and it helps you trade with trend and momentum. Okay, I want to sideways when you get into a sideways market or a sideways trends there that is prone to whipsaw. And because it's using moving averages, it's by definition going to be a lagging indicator. Okay. All right. I don't see any symbols. If you have some symbols you want to look at, let me know. I'm going to need them real quick. So, all right, let's talk a little bit about how to calculate the MACD. Okay. Now, when Gerald Appel created the MACD, he didn't use whole numbers. He used 0.75 as an exponential moving average and 0.15 as an exponential moving average. These don't exactly line up as whole numbers, but the closest and the ones that I'm going to use when we jump into Metastock and open up a chart is a 26 and the 12th period exponential moving average. Let's go ahead and get in there, and let's go ahead and let's see. Oh, well. Let me go ahead and start my Metastock real quick. Hold on. Okay. Let's go ahead and start Metastock. Again, if you have any symbols you want to look at, let me know. Nobody's typing in symbols, which means I'll show like maybe Roblox or something if you don't have anything for me. Or maybe we could do gold. Gold had a nice little gap this morning. MLI, thank you, Maverick. If you have more symbols, keep them coming. Okay, we'll give Metastock just a second to go ahead and get going. I had it running a few minutes ago. I must have accidentally exited out before we started the presentation. So yeah, there we go. That wasn't too bad. Okay, let's go ahead and open up a start. We will open up. Now I'm getting a few. Thank you, James, for OXY. Thank you, Kevin. How about APLD? Let's do all of those. Okay, just going to go ahead and clean this up a little bit. We're going to get to a point where we're looking at just a few charts. I don't want a lot of indicators on here initially. And let's just go ahead and open up a few blank charts. MLI. I can separate these with a spice. OXY. James, thank you. APLD. Okay, do a little space here too. Okay. I meant to make that as a smart chart. Oh, APLD. Oh, okay. We'll just start here. Okay. Pretty good looking chart. Let me go ahead and add a couple moving averages. We'll talk about how MACD is calculated. So I'm gonna go ahead and kind of come in here. This right here, where I'm at right now, is an indicator quick list. There's about 200-300 indicators in Metastock. And I just typed in moving average to kind of pull up the moving averages because that's where I want to go first. Okay. Everything that we've done would be easy to use. So everything's kind of drag and drop, click and pick, very much like other Windows applications. Let me go ahead and kind of move this out. I'm going to make a 26 period exponential moving average. I'm going to make this into a green line. And I'm going to make it a little bit thicker. Okay. All right. And then I'm going to do the same thing. I'm going to do this with a 12 period exponential moving average. Okay. 12 period exponential moving average. Let's make this one purplish violet. We'll go ahead and click on OK. Okay. And while I'm in here, we'll just come back into this indicator quickly. So I'm going to grab MACD. And there's actually a few. I like to use the one with a histogram. So I'm going to go ahead and throw this in here on the chart. I'll just drop it up here at the top. That's where it'll go for me. And we'll talk about, the first one I'm going to talk about right now is just the MACD line. Okay. The one I made a little bit thick. Okay. If I wanted to tell you how to calculate the red line, the MACD level, all you're going to do is you're going to take in this case, a shorter term moving average, a 12 period exponential. Remember, he used a point something, a 12 period exponential, and I'm going to subtract it from a 26 period exponential moving average. Okay. The difference is going to be the MACD line. Okay. So if you're familiar with like looking at moving averages, kind of understanding moving averages, it's the same thing. A moving average crossover is once you come up above your moving average, you're bullish. Once it comes down below. But since I'm comparing two moving averages, I can understand kind of like what we're looking at. And it's important to note that MACD is not simply a trend. indicator, it's also a momentum indicator. And I think that the fact that if you understand that you're looking at two moving averages helps understand that that's why you're looking at momentum. So for example, in applied here, applied digital, if we have if we're moving up, I'm going to say that we're moving up in this stock because we're not moving sideways here, right? If we're moving up, your shorter term moving average is going to kind of move and separate from your longer term moving average, okay? And that's what we're seeing in the MACD. Our MACD is starting to rise, just the line. Don't worry about the signal line. We'll talk about that in a second. The faster it moves out, the bigger the separation and the bigger your MACD. That's how you're looking at not only trend, but also momentum. If we're in a period of downward movement, I'm just going to kind of zoom out here a little bit here. I like how with Metastock you can do this. Right here, I call this a downward trend. Your MACD will start to go down because what's happening is the reverse. Your shorter term moving average is dropping down below your longer term, and the faster the decline, and we had quite a big decline here, the faster that decline, the more abrupt that movement will be, or the bigger your MACD levels are going to be. Okay, if we're kind of in a sideways area, I'm going to call this area right here from about right here to about right here sideways, because there's not a lot of movement up and down. You'll still have some separation. This is where it's going to be prone to whipsaw, one of your disadvantages, but you're going to have a much shallower MACD as you kind of get into those types of regions. So really, when you're looking at this MACD level, you're just looking at the difference between a longer term moving average and a shorter term moving average. That's it. Okay, very, very straightforward. Okay, what we've got here is we've got the signal line. Okay, that's this right here. It's also another moving average. I'm going to kind of just make it a little bit bigger. Okay, it's a dotted line. Gerald Appel called it a signal line. The reason he called it a signal line is you can use it as a signal. Okay, we'll talk a little bit about that. The signal line here, though, is a 9-period exponential moving average of the MACD. So right now we're looking at a comparison of two moving averages and its moving average. Okay. Before I talk about kind of the interpretation methods, I want to talk about this third level right here, and that's just the histogram. The histogram was not originally put together by Gerald Appel. It was put together by Thomas Asprey, I believe. Right, okay. And the only thing that it does is it takes the signal line and subtracts it from the MACD, or it takes the MACD and subtracts it from the signal line. So when you're looking at kind of the signal line, you're looking at the difference between the two, the MACD and its signal line, and that's it. Okay, so that's it. I'm going to recap really quickly for the purpose of just kind of doing a good job as a teacher. Okay, you've got your signal line. It's the difference between a shorter term and a longer term moving average. You've got your signal line. Gerald Appel called it a signal line because it's the primary way that you can get buy and sell signals from the MACD. And then you've got your histogram, which is the difference that was developed by Tom Asprey later on. It's the difference between your MACD and your signal line. Okay. Pretty straightforward. If you have questions, ask them. I keep looking over here, and every time I look over here, I'm just seeing if you have a question for me. You don't. So I'm going to go ahead and kind of keep moving. Let's talk about the 3 different implementations of the MACD. Again, the first one is you use the MACD and its relationship to the signal line. Okay. If we kind of take a look here, actually, let's take a look back. I don't know. Actually, what I'm going to do is I'm going to attach the expert advisor for MACD, and then we'll look at a couple of different spots on the line. The reason that Gerald Appel called this the signal line is because he would say that if your MACD is trading up above its signal line, so right here it comes up above the signal line, that means that the MACD is in a bullish phase. You see how it says bullish right there? That's just a trend ribbon. The expert advisor puts it there automatically. What it's reading is the fact that your MACD right here is trading up above its signal line. When it comes down below its signal line, you'll notice that it turns into bearish, bullish, bearish, bullish. Okay. All it's saying is that if you're up above your signal line, you're bullish. To simplify it even more, if we want to look at the histogram, if our histogram is up above 0, it's bullish. Okay, if it's down below 0, it's bearish. The reason that Gerald Appel called it a signal line is because if we kind of have a bearish interpretation, but then all of a sudden we cross our signal line and we're bullish, the logical move for us if we're bullish on a stock would be to buy the stock. Okay, and so when that MACD crosses up above its signal line, or when the histogram goes from below 0 to above 0, it's the same thing, you're going to get a buy signal on a chart. Okay, that's the primary methodology of what institutes a MACD buy signal. Give me just 1 second. I'm going to get my buddy here my coffee. And again, I love this because it's objective, right? I can see where the buy came in here. I can see where the sell came in here. Because, okay, well, if I bought here and I sold here, did that make money for me? If I sold here and bought here, did that make money for me? Probably not, right? But that was a break even at best. If I bought here and sold here, would that have made? Yeah, that would have been a really good trade. Okay, and I can do that. It's objective, right? I can understand exactly how that works. I can see it on the chart. And if I'm doing a proper job of explaining the MACD buy signal, you could do it as well. In other words, we should all be coming to the same conclusion. It's not subjective, it's objective. Okay, so that's the first way. That's the first interpretation of the MACD indicator created by Gerald Appel. Are we bullish or bearish? When it goes from bearish to bullish, we get a buy signal. When it goes from bearish to bullish, we get a sell signal. The second interpretation method that Gerald Appel used with the MACD is he would use it to find stocks that are overextended. Are they overbought or oversold? Okay. And there's a lot of examples about how the overbought or oversold works here. In this particular case, when Metastock detects that the MACD is overbought or oversold, it's going to start to highlight the color of the bars in this case. You can use candles. I usually do use candles. But it's going to start to highlight the overbought, oversold in these red areas. So you see right here where it's red, right here where it's red, right here where it's red. In that case, it's red because the MACD is overbought. Yes, overbought. Okay. It will also highlight them if it starts to detect that the MACD is oversold. Now, I've got a little bit of a bug in my throat. Give me just a sec. You want to be careful with overbought, oversold though, because it's a reversal indicator. Okay. I don't know if you've heard the saying or not, but the market can stay irrational for a lot longer than you can stay relevant or solvent is the actual term, not relevant, but for a lot longer than you can stay solvent. So you can use MACD as like an early warning indicator. However, I'd always wait for confirmation from price, another indicator, that kind of stuff. Because when you're looking at overbought, oversold, you want to compare overbought, oversold with other indicators. And I really like the way that they decided to kind of word that in the expert advisor commentary. So I'm going to go ahead and kind of open that up and kind of show it to you on the chart. Let me go ahead and go here to view expert commentary. And you'll notice that when I do that, we are actually in that overbought, oversold area right now. We had a buy signal here and it's kind of popped up. It's kind of testing this high that it set up back here in October. Okay, but you can see right here, we are red. That means it's overbought right now. Okay, and I like the way that it works. As soon as I open up the expert advisor commentary, you're going to notice this little triangle. This little triangle that means that it's looking at that day. Right now it's the 12th of January in the year of our Lord 2026. And so that's the day that we're currently looking at. This is going to kind of help us identify and kind of look at it, right? So right now, just to kind of break down our first condition, the MACD is bullish because it crossed above its signal line back here where we got our buy signal. Oops, I moved the commentary. Okay. Since it's trading above its signal line, the MACD crossed it 6 days ago. Since it crossed it, it's moved up about 35%. Great. That's a very, very good trade. And it's ranged from a high of 39 to a low of 24. Okay, so perfect. When that overbought, oversold happens, it's going to tell you. You can scan for that. Now it's going to give us a little bit warning about oversold. Right now, the MACD is in an overbought range. prices may continue to move higher for some time. Wait for prices to move lower before considering any short positions. And I think right there, that's where a lot of like reversion to the mean traders get it wrong, okay? Because have you ever looked at a stock and it just keeps going up and you're like, this doesn't make any sense, why is this still moving up? I think when you're looking at overbought, oversold, you should be looking for confirmation, and I love the way they worded this out. Wait for prices to move lower. So if I'm in a stock and I'm looking at it kind of going up, there's a couple of things that we could do. We could move up our stop. We could become a little bit more defensive. We could take a look at kind of maybe taking out some profits because we feel like there's going to be a reversion to the mean, but we should always wait for that to be confirmed. So the second way that you can use MACD is as an overbought, oversold indicator. And the third one is one that I really, really like, okay? Actually, I mentioned his name a little bit earlier, Dr. Alexander Elder. Dr. Elder, great friend of Metastock and somebody that I have a lot of respect for. I believe that if you want to trade, his book, Come Into My Trading Room, should be a book that's on your reading list if you haven't read it already. Okay, he says when he talks about MACD, or actually when he talks about, actually I have the quote exactly. Let me go to the quote exactly. Okay. In his book, The New Trading for a Living, Alexander states divergences are among the most powerful signals in all of technical analysis. Okay, that's what he says in his book. When prices make new highs and MACD fails to make new highs, this is called a bearish divergence signal. Okay, so let's kind of draw up, I'm just checking the time here to kind of see I'm actually doing pretty good in terms of relative time. Let's kind of draw up the way that Alexander Elder would find a divergence on a chart. So I'm going to kind of come back in here to the chart. Let's go ahead and make this extra. I'm going to kind of still leave it open here. I want to talk specifically about how Dr. Elder would look for a divergence. He's done a lot of webinars with us over the years, and he does really, really like the MACD divergence. He calls it the most powerful signal in all of technical analysis. I just talked about that. Okay, so what I'm going to do here is I'm going to kind of look at, he likes to use the histogram. You could use the peaks of the MACD oscillator as well, but he likes to use MACD histogram, okay? He likes to make sure that there's a little bit of a cross down below zero. I'm going to kind of just make this a little bit bigger. Again, I can just drag and drop. So if I wanted to kind of look at a spot where we crossed down below zero and we set another peak, we didn't quite cross down below zero here. I would say that we crossed down below zero here. Okay, so I'm going to look at this peak. I'm going to grab my little trend line tool here in Metastock. I'm going to make a line. I'm going to find the highest value in this little peak here. We crossed down below zero and we came up and we set a new peak right here. Okay, now those peaks are about the same level. In fact, there's just a little bit of a negative number here. Okay. If I was going to compare that to price, I'm going to go ahead and grab my trend line tool again. At about the same time, I can go to peak. There's a little bit. This is almost level. This is a little bit of a decline. I would say that that's not divergence. They're almost heading in the same direction. It's not divergence. Okay. Now, if I wanted to kind of, let's just say this came down below zero. So let's compare this peak. Just hypothetically, we're playing around here, right? If we come here, give me my trend line. Okay. This didn't fit one of his fundamental rules, so I'm being a little bit careful here, but like, let's kind of just take a look here. Okay. And here. Okay. Go to that peak. Okay. You notice those are both sloped up. Okay. In other words, they're pointed in the same direction. They're not divergent. Okay. If we had a scenario, and we don't have it here, but if we have a scenario where MACD kind of come up and set a high here, set a lower high here, while price was making a new high. So let's say that this is the same, but this is just slightly different in the fact that we've got this coming down, this coming up. Okay, right now in this particular made-up scenario, price is setting a new high that isn't confirmed by MACD in our hypothetical, right? When that happens, that's called a bearish divergence. Price is making a new high that isn't confirmed by MACD, and that's when Dr. Alexander calls that the most powerful signal in technical analysis. That's when he says that you're literally breaking the backs of the bulls. So you can kind of keep an eye on that on the chart. We don't really have that as an example here, but I want to be able to kind of show you how to find it on a chart. Okay, that's called a bearish divergence. That's the third way you can look at MACD. Kevin says, I guess that MACD is a lagging indicator and the movement shows after the price movement. So we still we can depend on MACD to get a buy and a sell signal. Yes, it's definitely a trend indicator. It's definitely a lagging indicator. It's definitely using MACD indicators. We're about to go to your question on how well does it work? How well does it work on applied or Oxy, which James wanted us to look at, or MLI? Because again, the objectiveness here is how does it work? We spent 30 minutes or so talking about MACD, understanding it, explaining it to you, but generally the real question is it effective? Okay, because it's objective, we can see where the buy and sells come in. Is it the most effective indicator we could be using? Should we be using something else? And that's where we're going to kind of go to next, because I like to focus on the things that work. So again, there's some divergence. Okay, that's the end of the prepared PowerPoint. I'm going way faster than I normally do, but that's okay, right? So the three ways that you can look at MACD, again, number one is when we cross above our signal line, that goes from bearish to bullish. It's bullish as long as it's trading above its signal line. That's a MACD buy signal. That's the first way, is a trend identification. The second is momentum. Are we getting overbought, oversold? If we're getting overbought or oversold, we want to wait till prices or another indicator confirms, or we could just use it as a defensive movement, maybe tighten our stop a little bit. Okay, so we do have a reversion to mean. The third is what Dr. Alexander Elder called the most powerful signal in all of technical analysis, and that's MACD divergence. And that's where we look for prices to make new highs while MACD is not making new highs, or the opposite if we're looking for a bullish divergence, okay, which we might be able to see actually on this chart, but I'm not going to kind of go into that. Kevin's real question is, how does it work? Like, how well does it work, right? Like, is it effective? Obviously, like, we can come in here and apply and say, okay, here we bought, here we sold. That was a really good trade, okay? If we would have went short and then bought here, that was a good trade too. This would have maybe been a break even. This would have maybe been a break even, and this would have been buy. And the reason that we can know whether it's effective or not, this looks pretty good on applied, so thank you for the symbol. The reason that we can know that it works and kind of say, okay, is because we can see that on the chart. We can see it because it's objective, okay? So how effective is it? Does it work with applied? It appears to work with applied. Does it also work with Oxy? Let's find out. Does it work with MLI? Is there better indicators that I could use that are going to give me better signals that have lower drawdowns? What is a drawdown, right? Because it's objective, we can go in here and kind of identify how well exactly it works and how, okay. And we can go back as long as we want. Well, actually, with the data that we get from the London Stock Exchange Group, you can go back to the 1980s on the US stocks, the 70s on the futures. You can really have all of the data that you need to know. But the question is like, okay, how well does it work? And how does it compare to some other ways to look at the stocks? Okay. And because everything is objective, we can very, very easily go in and we can kind of say, okay, well, let's find out how well it works. And that's what we're going to do now. We're going to kind of put together a system test. I'm going to have the software go in and say, every time I took this sell signal and this buy signal, how did that work out for me? And is it the best way to trade the stock? So we're going to use the stocks that you guys provided earlier. James, let's go ahead and do Oxy. Maverick, I'll put in MLI here. And then we do AP. Actually, I don't need to do uppercase. I don't know why. I actually kind of worried about that. We'll do APLD and I don't know, GEV. Actually, just GE. Okay. Oh, I need to put a .o here as well. And now, let's go ahead and kind of, actually, not only are we going to test MACD, let's test a whole bunch of different methodologies because there's 200 or 300 that are built into Metastock. So including these ones that were developed by John Ehlers, the ACT. I like those. They actually kind of test pretty well, so I'm going to use those. Let's go ahead and include the JCPRs. Those are new systems that we just included with 20. We'll do ETS trading system. I'm trying to make sure that I don't include anything that includes optimization because you can optimize variables, but takes a little bit longer. Oh, we can do Ichimoku too as well. Let's do MACD. That might be important. And then there's actually just, I'm just going to grab a whole bunch from the performance systems that are in Metastock. Okay. And that's it. Okay. What we're going to do is we're going to do a simulation. I'm going to take Oxy, MLI, APLD, and GE, and we're going to say, okay, if we went back, let's say 200 records, and we took every buy signal from these systems and every sell signal, how well would that have worked? What's our drawdowns? How does everything look? How does efficiency look? Any number that you really kind of want to know is probably going to be reported back in this test. Okay. For the purpose of the test, and I'm going to go back about 2 years, about 500 bars. Okay, on a daily basis. You can use in different time frames if you want. Okay. What I'm going to do for the test is I'm going to start with, well, let's start with just $10,000. And I'll have it trade a percentage of available equity. So let's have it trade 75% of the account. So every time it takes a position, it'll take 75%. It'll buy it. It'll sell it when it gets a sell signal, et cetera, et cetera, et cetera. I'm not going to put any brokerage commissions in here because generally that's a thing of the past. If our traders trade execution, I'm going to have it wait till the bar closes. We call this realistic. We're going to have to wait till the bar closes, make sure that it gets that buy signal on that bar. Since the bar is closed, it's going to enter on the beginning of the next trading bar or the open of the next trading bar. So I've got that all set. Let me pop this system tester back out. It's ready to go. I'm just going to start the system test now. Okay. It's going to calculate and go through 6,736 tests. Okay. That's a little bit more than I think I meant to do, but it's not, it's going pretty fast. So we'll kind of let it go through. I must have an optimized system in there. Okay. With an optimized system, like we've talked about the 12 and 26 period exponential moving average, it tests more indicators for us. Okay. While it's running, I'll take an opportunity to talk about our system tester. Okay. Our system tester, we're obviously doing multiple symbols. You can do as many as you want. Or you can do like the whole S&P 500. I don't do that in the purpose of a demo because obviously it's going to take a little bit of time to go through, right? But you can see how something works over just one security, a whole bunch of securities, and that kind of outperforms a lot of other system testers that are out there that'll just allow you to test one security at a time. This one allows you to kind of get a lot more information about how something would benchmark on average, okay? And then just to kind of talk a little bit more about what we're doing, we're taking a number of different methodologies and saying every time we get a buy signal on these stocks that we're testing, how well does that work out for us? Where does that buy sell come in? Where does that sell signal come in? So looking for some more questions. Again, it would be almost done, but I'm pretty sure I accidentally got an optimized system in here, so it's taking a little bit longer. But I ran out of things to say. So I can hum to you, I can tell you a joke, or I can just wait another few seconds because we're almost there. So when it's done, we're going to get a little bit of a report. I'm going to go ahead and view the report now. Okay. This is the amount of systems that we did. So we tested all these different methodologies. I'm going to make this full screen so you can see it a little bit better with me. And I can kind of sort this based on all of the systems over here made money over that 2-year period. Remember I said we're going back 500 bars. This went back 500 bars. Everything that's on the left-hand side of the screen made money. Everything that's a green bar. Everything that's on the right-hand side of the screen did not make money over on those 4 stocks. We're talking about averages because I threw 4 stocks in there. Okay, if we just had 1 stock in there, we'd just be looking at 1 stock. But because we're doing multiple stocks and you can do as many as you want, we're going to have average numbers. We're going to talk about average numbers, at least at first. Okay, our best performing system was a cycle progression system. Okay, over the last 2 years, it had an average percent gain of 191%. Its best profit was $55,601. Its worst profit was $43, so it made money on every system. I don't like it though because it traded 93 times in 2 years. That's a lot of trading. Okay, so I'd kick it out and I'd go more with what's called the pattern trading system number 4. Okay, it made 138%. The best performing was $40,000. The worst performing was $2,200. It only did 9 trades on average for the 4 securities we're looking at. Okay, its average trade gain versus loss was 4.8 to 4.5, but every time it lost $1 in the simulation, it got $6.71 back. So we'll take a look at that one. But those are kind of the things I pay attention to. How often am I trading? For me, I'm kind of busy. I get to work at a place where I can look at the market, but I also have a lot of responsibilities. So I don't want to necessarily be doing something where it's 93 trades. This other pattern trading system number 4 kind of fits what I want to do a little bit closer. All right, so let me go ahead and kind of take a look at that. Okay, here are the 4 stocks. Occidental Peat, it didn't work very well on. It did work well. Let me go ahead and kind of just sort this by the results on Applied, which we just looked at, right? Mueller Industries and then GE, which I just threw in there for fun. Okay, for Applied, had about a 403% gain over 2 years. In that 2 years, it did 12 trades, a 50-50 batting average, 6 wins, 6 loses. But for every loss that it had, it made about $9 on a gain. Okay, there's all kinds of metrics, and I do realize that I do need to go a little quicker now. So we won't spend a lot of time in this report, but it is going to kind of cover a lot of things that you want to know. Okay, like what was the average size of my profitable trade? 7,500. What was the average loss? 823. Okay, I had 3 winning trades in a row and 4 losing trades in a row. Okay, I can see what my buy and hold index is. We did barely outperform buy and hold, 5.93. I can see what my profit loss index is. That's a number that goes from plus 100 to minus 100. Plus 100 is perfect. Minus 100 is catastrophic. 89 is pretty good. Our risk reward index was 94. Again, that goes to 100 to minus 102. So you can kind of get an idea of kind of like what our trade timings look like, how often we're trading. And we can even see this on an equity graph. Excuse me. Let me take a look at the equity graph. You can kind of see this is a little bit choppy. I wouldn't like this. I'd probably look at another methodology simply because this is pretty choppy and I don't like to be choppy when I'm trading. But let's say we did like it because I don't want to go back in and start digging through. I want to give you the idea of how this can be helpful. Let me go ahead and kind of just throw this on a chart real quick. Okay. And here we've got Applied. This was thrown on a chart. We were pretty up and down here just because the momentum of the stock was very, very much. But our last buy signal would have been on May 19th, 2025. This was the pattern trading system number 4. If I want to understand a little bit more about why this works, or who it's from, or what's going into the mechanics of this, because I think when you go into trading, you should understand why you're trading. Right? You shouldn't just be taking a buy and sell signal because you get one and it worked well last 2 years. But if I want to understand why this works, what I can do is I'm going to come in here. I'm going to go back to that expert advisor tool. I'm going to put on the pattern trading system 4. We'll go ahead and click on attach. We'll go ahead and now we can kind of see where we had that big long buy signal at the end. We're going to zoom in on that. Okay, right here. Okay, right here is where we would have been initially given that buy signal. And I come in here. And if I, as a trader, want to understand where this came from, okay, I can come in here and I can read kind of what this is. This system works on a very simple pattern. It underlongs when a price closes above the high of 2 days ago, and it does 25 and does it on more than 75% of the monthly average volume. It closes a long position and enters a short position when the price closes below the low of 2 days with 75% volume or more. Okay, so it's just a pattern system. You're looking for a breakout of the high with confirming volume. Very, very simple. Okay, but now we understand exactly what they are. If this was a methodology that was created by Joe Pell or somebody else, it would give you more information about where that comes from, et cetera, et cetera, et cetera. Here's kind of where it comes in. Okay. In addition to that, if we do find something that we like, it's very, very easy for us to go in, and what I want to be able to do is I want to find stuff that's actionable now. If I like this pattern trading system number 4, this is the last time we had a buy signal. We haven't had a sell signal that was confirmed on volume since. If I wanted to kind of find that pattern on a chart, I can go in and run an exploration. And this is where Metastock, I think, can really help you with what you're doing. As I said just a second ago, I'm very, very busy. But if I wanted to find the PS pattern 4, we'll go ahead and kind of move this up a little bit. I can run as many scans as I want. But if I wanted to go in and find stocks that might be having a buy and sell signal today, I can come in here, I can run against all of the optional stocks. The thing I love about technology is the ability for us to ignore the noise and focus on what makes sense. Okay, so let me go ahead and focus on the opportunity and ignore the noise. Okay, let me go ahead in here. We'll just keep this really quick. I want to get a result back, but I don't want to spend too much time getting a result back, if you know what I'm saying. So I'm going to grab the NASDAQ 100 and then just the S&P 500. And what I'm going to do right now, because this will just make it a little bit quicker as well, is I'm going to look for a scan on Friday. Okay, so this is going to go through Friday's close bar, and it's going to say, hey, did any of these stocks, in these 517 stocks, did any of them have this exact pattern that I'm looking for? Now, this pattern that we're looking for is this trading system. I could be scanning for MACD buy signals if I wanted to. I could be scanning for gaps. There's a really cool gap identification system that's in Metastock. All this stuff I could be going through. I don't even think I'm going to let it stop or finish. But what I want to kind of stress is right now it's going through. We have found a result in the 130 that we've looked at. Okay. 150, we've had at least a result because it's only rejected 99%. But for me, what this allows me to do is it allows me to say, here are the stocks that I might have an interest in buying. How did they look? Okay. And I can ignore all the noise in the marketplace and just focus on the ones that have an opportunity. And isn't that valuable? I use it every day, sometimes twice a day. I was looking at the results of a scan that I ran over here on this machine just a second ago. So in any case, let me just kind of wrap up a little bit. We have okay, I looked at it, I saw the 3 as a 9. I might have a few minutes. Metastock, again, has been rated, and for those of you that have been using Metastock for decades, thank you. But it's been rated #1 in this price category 32 years in a row. We talked in terms of pricing, we have 2 different versions. We have a full Metastock real-time version. Metastock real-time actually comes with a institutional quality news feed and service that's provided. It was built at over a cost of $1 billion as a competitor to Bloomberg, which is like $27,000 a year. For that news feed and Metastock, we only charge about $210 per month. It's very, 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 very cost effective. We do have what we call the Metastock delayed charts. It's a 15-minute delay. You can use daily, weekly, higher. With that, it doesn't come with the news, but it's only $75 per month. Okay. And with that, what you're going to get is the software, the ability to test, the ability to scan. We have a really cool, I do a class on this, just the Ichimoku. I'll spend an hour talking about Goichi Hasada and the Ichimoku method and this very cool methodology that's built into that. It's just included. It was a $400 add-on that we just include. There's a gap identification system. Gaps are really big insight into the way investors and the way trading. A gap signifies a big change in investor sentiment, and there's a gap scanner that you can run in there. Michael Murmer's ETS is in there. There's some new indicators called Bernstein's expansion contraction. Just the indicator is included for free. I call it Jake's going to come in right in just a second to talk about JBXC, but the indicator is included with Metastock for free. So as part of your installation, we're going to go ahead and give you the white glove installation service. That means somebody will walk you through the program. They'll help make sure you understand how to run scans, explorations, all that kind of good stuff is just included. Okay, they'll spend up to a couple hours with you. And we do offer unlimited technical support. So you get unlimited access to our support team by phone, by email, by chat, all that stuff's included. They do a great job. One of the things that I'm pretty proud of is we always have more people in our sales staff than we keep in our support staff than we keep in sales and marketing together combined. I'm getting over a little bit of had a pretty bad stomach flu that started on Friday, and so if I'm misspoking things and things like that, bear with me a little. Okay, but you get unlimited access to them. If you have questions, you can call them, you can chat with them, you can send them an email. If you send them a letter, we haven't gotten a letter for a few decades, but if you send them a letter, they'll respond to your question by a letter as well. So they do a really good job. In fact, there's a lot of times where they get 100% on all the surveys. So if you call them with a question, you'll get a survey. They get 100% on metrics many times. It's really, really cool. I think one of the best things that you get when you work with Metastock is you get the people here. So here's how it works. If we're going to do a special offer for you today, if you buy Metastock, if you subscribe to it for a month, remember the DC version is only $75. If you pay for a month, we'll give you the second and third month for free. We're going to throw in all of the hundreds of systems that are in there. We're going to throw in unlimited access to our support, all the data that you need. That $75 is actually a global data feed everywhere in the world. So for $75, if you pay for that $75, if you pay for that month, you'll get the second and third month for free. That means that you'll be running Metastock until April 12th. During that time period, you'll be able to kind of set the software through its paces, see if it works for you. It's going to, and it's only really going to cost you $25 a month. If at the end of that 3 months, you feel like it's helpful, you feel like you're getting better trades, obviously you're just going to keep it, right? But there's no commitment to keep it. You can cancel at any time. But I hope you use it for decades, like most of our customers, like I have been. So to do that, give us a call. You can call us at 800-882-3040. You can go to metastock.com/saleschat, or you can go to metastock.com/summitdeal. And we'll be happy to kind of get that set up for you, get that one-on-one appointment that's booked. Give it a go. Because again, it's only $75. That's $25 per month. If it helps you identify better trades on a daily basis, a better strategy on a daily basis, wouldn't that be a good thing for you? 800-882-3040, metastock.com/summitchat or sales chat, and metastock.com/summitdeal. I'm going to type all that stuff in the chat.
I wonder what you're like when you're drunk, Jeff.
What's that? I was looking at the question. Kevin said, "Oh, how do I get the scanner?" And then I got it. Jake, it's good to have you, man. I talked about you earlier. We were talking about the best profession for trading. And one of those answers was, is it a psychologist or a psychiatrist? And I said, I know a great trader that's a psychologist or a psychiatrist. And I mentioned your name. So there you go. All the offers that we're going to do today are available here at metastock.com as a special offer. So if you want to do a bundle pack, you get Jeffrey Scott's MRI, you'll get Greg Capra's Master Trader, the JBXC, which Jake is about to talk about, the Velocity, some training from Oscar Carboni, and 3 months of Learn Metastock. All of that would normally be $6,386, but $2,000, $788 today. You can't do this online. You can call us at 800-882-3040 or metastock.com/ sales chat. So again, big thanks for coming. I hope that was helpful. I hope we learned a little bit about BACD today. That was one of my goals. And I hope I inspired you to try Metastock. I don't think you're going to regret it. In fact, I know you're not going to. And if you do, there's no commitment to keep it. So give us a call, 800-882-3040, metastock.com/sales chat. Again, a big thank you for Stocks and Commodities for sponsoring the events today. We appreciate all the work that they've done with us over the years, sponsored every single one of these things. So big thank you to those. And then I've already talked ad nauseum about Metastock. Let's get over to Jake. Jake is a good friend of mine. I used to live maybe 20 minutes from his house. Jake traded his first trade in the 1960s. He's written, and I always would get embarrassed because I'd try and give a number out. I'd be like, hey, Jake's written at least like 25 books, and it's like hundreds. Jake has written a prolific number of books on trading. He's been trading for an extremely, since the 1960s. His most popular book was How to Day Trade. I love the fact that all of Jake's methodologies that set up follow a very specific formula. We talked about discipline a few minutes ago. He looks for a setup, he looks for a trigger, and then he looks for follow through. Jake's somebody that's had a huge impact on my trading, and him and Brian Lotta, which is this other guy right here. Brian actually kind of helped him really kind of create what I call the Swiss Army knives of all indicators. So Jake, Brian, let's go ahead and get you started. How are you guys doing today?
Well, thank you, Jeff. Good to see you. Happy New Year.
Happy New Year to you guys. And Brian, I can see that your mic just turned on too. It just lit up.
I am here.
All right. Let me go ahead and make you presenter. I can hear you. Yes.
So we are going to work from Brian's PowerPoint. I'm going to do a brief introduction, a little bit of history and psychology and philosophy, and then Brian's going to take it over from me. Let's make sure we call it Expansion Contraction by Brian, Lotta, and Jake Bernstein. We don't want to not include Brian because he's really the brains behind developing this beautiful indicator from my work. And again, thanks for the great introduction, Jeff. I really appreciate that. I wonder what you're like when you're drunk.
I don't drink. All right, I'm out of the way. It's your turn.
Okay, good. Thank you so much. So I didn't realize in the summer of 1967, when I made my first trade, that I'd still be trading in my late 70s in 2026. But here I am, not because it's been so much fun, which it has been, not because it's made me so much money, which it has, but because it's been a great challenge and a great learning experience for me. The thousands of traders that I've coached personally over time and the hundreds and thousands of trades that I've made have helped me learn so much. They've helped me learn more about traders than about trading, because traders all over the world are basically the same. They all say they want to win, but then they don't behave in a fashion which is consistent with winning. So I want to talk a little bit about that. I have spoken at practically every major stock or futures exchange in the world. I've traded real money in front of hundreds of people with real time, with my methods that I teach. I've written 45 books. I wrote the 7 best-selling books on day trading for McGraw-Hill. I've done it all. I've traded short-term, I've traded long-term, I've traded day trade, I traded as an investor. It's all about trading. The most important thing I learned is this. Everything has to be clear and consistent, and it has to be based on rules. If it's not based on rules, it's not worth bothering to trade. So we come here, Brian and I, in the hope that we can change people's behavior, because there are many great trading systems and strategies, but there are really very few traders who have the ability, even though it's a simple skill, there are many traders who do not have the ability to implement those incredibly simple strategies. Expansion contraction is one of those simple strategies that will help you make a lot of money if you are dedicated to the strategy. And here's the thing that's so strange about it. As an ex-psychologist, I will tell you this. It's a lot easier to follow the rules than it is to break the rules. If you break the rules, it leads you down a rabbit hole, and you break more rules, and then pretty soon you don't know where you are. If you follow the rules, it's really simple. You know the result. You know why you did what you did. You know when you did it. You know what you expected. You know what you got. It's so incredibly simple. It never ceases to amaze me. So in the 1960s, when I got started trading, we used paper charts. We went for fine, sharp pencils and good, solid rulers and protractors. At that time, we were hoping to get something easier. So we hoped and wished that someday there would be a computer that would do it for us. And then lo and behold, we got computers, we got the 1970s, and then traders would say, the reason we lose money is because we pay too much in commissions. Commissions started to come down, basically went to zero. Traders were still losing money, and they'd say, the reason we're losing money is because we can't get our orders filled fast enough. So we got faster computers, faster internet, lightning fast execution of traders, and people still lost money. And they'd say, we're losing money because the big traders on the floor are taking the money away from us. Well, pretty soon, trading became electronic. The big traders basically disappeared from the floor. There was no trading pit to speak of. Everything was electronic. Everything was streamlined. Everything was quick and fast. And people still lost money. And they'd say, the reason we're losing money is because of inside information. We need better information. Well, along came the internet. We got incredible information. It was faster, it was bigger, it was better, it was incredibly fast. And people would say, the reason we're not making money is everything's too fast now. The professionals are taking over. We can't get the job done. It's all just a bunch of BS, to be honest with you. The bottom line is this. We come here today not because we're so good at what we do, but we're clear and consistent. And the reason we keep on getting invited back is because of the fact that what we do is clear and consistent and prosaic. The term prosaic meaning not poetry, but prose. In other words, specific, clarity, indicators, rules, so that 100 people looking at the same information, looking at our work, without consulting with each other, can reach the same conclusion all the time. There is no looks like, there is no interpretation, there is no geopolitics, there is no fundamentals, there is only what there is, and that's what we do. Totally clear. So one of the reasons we have this big disclaimer at the beginning of every presentation is because of the fact that once you leave this webinar, we have no idea what you're going to do with the information. People will pervert, subvert that information and claim that it's our information when in fact it's not. All you need to do is come back here and look at the expert advisor, which is a fabulous tool for Metastock, and reach the conclusion clearly. And one just brief thing. Metastock is fantastic. It's been my privilege and honor to be associated with Metastock for many years. They keep coming back to me and saying, will you do it again? And Brian and I come back here in the hope, the wish, the dream, the fantasy that somehow people will say, yes, we are listening to you, we're finally making money. Or they'll say, yes, we're listening to you and we're making more money. That's what we really want. They don't pay Brian and I to be here. We don't pay anyone to let us be here. We do this because we want to see the global trading community improve as a whole. But right now, unfortunately, it's a zero-sum game. For every winner, there's a loser. We want to change that. We want you all to be winners, and we know you can do it, because believe me, if I can do it, anybody can. So I will give this over to Brian, who will show you the expansion contraction. I'll jump in from time to time. He's the brains behind the operation. He knows exactly what expansion contraction is, but this is important. We're going to keep it simple. We're not going to dig into the theory, the basics, and all the theory or the advanced version of expansion contraction. For me, expansion contraction is very simple. We go from red light to green light. As long as my light is red, I'm either short or I'm out. When my light changes from red to green, I'm long or I'm trying to buy. It's that simple for me. It's not perfect. We don't claim to be perfect traders, but we do have something that's totally objective. And if you keep it objective, it will work for you. So Brian, I'm going to turn it over to you. And one more thing, Metastock makes this a piece of cake. It makes it very easy for you to do. The only person you're going to have to blame is yourself. Oh, one more thing before I forget. When the session started, Jeff was talking about who makes the best traders. Here's what I found. I found that the best traders are airline pilots. Why airline pilots? Easy. They've got a vehicle, call it a trading system. Before they take off, before they put on a trade, they check out the vehicle and make sure it's working properly. Are all the indicators working? If they are working, they take off. They enter the trade. After they enter the trade, there's only 3 possibilities. Think about it. Number 1, you land safely. You made a profit. Number 2, you crash and kill yourself. Number 3, you control your crash and maybe you lose an arm and a leg, but you still alive to trade some more. So with those 3 possibilities, pilots are uniquely aware of that. And that's what we do when we do our work. Set up, trigger, and follow through. So now I will give it to Brian. Brian, take over with your great, incredible voice. And maybe one day you won't become an old man with an old voice like me.
Thanks for that, Jake. And I am not that far behind you. So, but again, a little bit about my background. You can already have seen this and read through it, but I did get my experience working in Silicon Valley back in the 80s and 90s as an analyst in reliability assurance and implementing a statistical process control program with an engineer. So my background is not from college or degrees, but initially from on the job and then eventually getting with Jake in 2014 and becoming a client of his, and then learning that setup, trigger, follow through, which I also just kind of translate into rules to get in, rules to get out at a loss, rules for taking profit. And also then took a look at Jake's moving average channel and started working towards identifying specific patterns that help us identify clearly whether or not we want to be bullish right now, get bullish on the next buy setup, so to speak. We want to know in advance what our next trigger to get in is. And that's part of the process. And as Jake said, we'll do a brief expansion, contraction review. It is short-term swings and long-term trends. And I'm just going to go ahead and bring up that again briefly. As you see, the indicator's got a green cloud or a cone in the background, which is the longer-term trend filter. Does have a tendency to stay bullish or bearish for significant periods of time on this. And then there's the short-term lines. As you can see, short-term swing lines identify patterns of price that move up or down over a shorter period of time. And the longer-term trend lines are over a longer period of time. We have red or green shading, as Jake was mentioning, are by the tip or all of that. So let's at least pop up just briefly. We can identify support, resistance. We can identify the average and strong up or down, the normal range of pricing. And all of this, as Jake had mentioned, is in previous Metastock recordings on YouTube. So if you're looking for the exact rules on when to get in, where to get out at a gain or a loss on multiple strategies, that was last put back up on the June session. And so go on to YouTube, get onto the Metastock program, go back and look at previous sessions if you want to see the rules on here. But it is, as Jake mentioned, pretty simple. We've got strong up are going to be dark green bars, just coded the pricing on that. If we're weak up, we have light green bars. If we're weak down, currently we have light red bars. And if we're strong down, we have dark red bars on there. And that's, go ahead, Jake.
Oh, I'm sorry to interrupt. Let me say one thing that's very important. There's been a trend in recent years, as you know, away from position trading to short-term trading. Some platforms even support 30-second charts. In other words, a chart that's only 30 seconds long. You can use expansion and contraction in any time frame. You don't have to be a short-term or day trader or investor. So one of the good things about expansion contraction is its applicability to any time frame. Go ahead, Brian, sorry to interrupt.
Oh, no, it's okay. It's just led right into the next slide, because ideally you always know what to do before it happens. And in this case, I like to consider that expansion contraction will always be right at the right edge, and you'll know what the conditions are now, as opposed to in the future, which we don't know. But if we can trade the right edge of reality on charts and just look in anticipation of the next period, this will be fairly clear, as you will start to see on here, where we've got the charts up. And of course, Jake and I both use it a little bit differently, which is the main thing for each of you individually: your risk tolerance, your style of trading, your objectives, your risk tolerance of being conservative or aggressive. Kind of get back to there. Obviously, as I'm kind of dropped into the brutal reality here, I guess if you don't have any kind of triggers to just get in now, don't second guess it. No, yeah, but no, what if? You've just got to have that process. And of course, if you've got a systematic process where you've got a risk that you know is less likely to be stopped out prior to you hitting your profit target on that, right? You have the bakings of a system. So, but literally, I do see this over and over. A lot of people are willing to spend money without knowing the answers to get in now and what are my odds of making money in advance. And unfortunately, that can be a major problem. So I'm going to pop right in here where you're looking at intraday charts today to go through some day trading setups, is mostly certainly what I hear, and I hear from Jake what he hears. Can you show me some day trading? I want to get in today. I want to make some money right now, and I'm going to need a systematic process. So I did pull up a 15-minute chart. Jake, if you want to spend a few minutes commenting on the 15-minute charts here, which not only show the expansion contraction long-term setups with just the trend filter, but also show the analysis of expansion contraction in the commentary window on the left. But I did pull up some 15-minute charts to basically outline the opening range breakout strategy in conjunction with expansion contraction. So Jake, do you have some comments on this chart?
Absolutely, Brian. It would be unusual for me not to comment. So I'm assuming this is the 15-minute day session S&P chart. It's the March S&P. And you've got your pointer, your red arrow there in the first bar of the day. Is that correct?
It's not actually the first bar of the day. If you look down at the time on here, it happened just prior to the open, as this is Central Time on here. But we did have a buy triggered just before the open of the day on here. And this is not just the day session only. Admittedly, I did put up the 24-hour markets. That's what I had access to. But again, expansion contractions, trend filter only, basically showing us the current situation on here is bull only. You're looking to be a buyer. And obviously with Jake's opening range breakout here, that strategy is already coded, and all the rules are clear on that from Jake.
Yeah, so it's very, very simple situation. The thing that's most important is this. After we did get that buy trigger early in the day to go long, you'll notice at the bottom of the screen, the expansion contraction cone, as I call it, has remained green all day. Meaning what? Meaning you're a buyer on drops to support. So where is support? We've got the moving average channel, which Brian is showing you right now. Two lines. The green line is a 10-period simple MA of the highs. The yellow line is an 8-period simple MA of the lows. And as long as you're coming down to those lows, you're swing trading from the bottom of the channel support to the top of the channel resistance. These are all small trades, but it adds up, especially when you have larger positions. There's specific rules for when they get out, specific rules for when they get in. So that's one of the 15-minute charts. And again, as I say, how you use it is entirely up to you, but it is applicable to short-term as well as intermediate term and day trade. And on the left, you've got the expansion contraction expert advisor. Is that right, Brian?
That's correct.
And so what does it tell us?
Well, it's going to show us the setup on this case because I have this marked with the green triangle above the buy trigger on here. The expert advisor here is showing us that it's a trend continuation buy. In other words, the green cone or cloud has already been trending. We did narrow and get weak but in essence, this would have been potentially a buy trigger at or near support, or on a trigger to get in, or on Jake's opening range breakout. We have basically the get in now process, which you want to be clearly defining. And ideally, you've got something like the expert advisor at least continually showing you what the long-term pattern is, the short-term pattern, whether we're in an expanding range or contracting, as expansion is the strongest part of a move up. If you notice that the cloud is expanding consistently during the strongest move. Go ahead, Jake.
Most important of all, we always know our target, our stop, and our risk. So when we get into the trade, we know all the information we need to know about that specific trade. Can we go to the next slide, Brian?
Sure, Jake. And that just in the expert advisor, it's just out of view for the profit target and the stops on there. You just have to just scroll down.
Okay. So here's the opposite situation. We go into sell mode. And again, the most important thing for me is the fact that once the indicator at the bottom of the screen turns red, it stays that way for a long time, relatively speaking. We don't get a bunch of chopping back and forth, which is really what kills most traders, not only their confidence, but their profits as well. So you see you've got the big moves, and when we came up to resistance, which in this case is now the top of the channel, the green line or whatever color that is, that's where we go and go short for a quick trade to the bottom of the channel, which is the target. And the one thing that you want to remember is this: the indicator is free. Take your time, give it a chance, give it an opportunity to work for you. Be honest with yourself, look in the mirror and say, yes, I am following the rules. And if you do that, it will work for you amazingly well. Brian, back to you.
Thanks for that, Jake. And for those that are not familiar with the opening range breakout, Jake, that's available through your site at trade-futures.com. Is that correct? They were interested in finding out more about it.
Correct.
And I would say, if you're day trading, what Jake said before, and I agree with completely, do not trade against the opening range breakout consistently, because it's basically like trading against the trend or trying to paddle upstream in class 5 rapids. You can do it, but you won't do it for long without some pain on that one. So I do like the process of identifying that. Go ahead, Jake.
They call it pissing in the wind.
That's it. And so that's not a good thing. I will at least pop over. I've got some short-term chart examples, again, from individuals asking us for some day trading. I've dropped this down to a 1-minute chart. So bottom right, you're going to see that this is still the ES and at least a 1-minute chart. Although I would say I'm not a fan of recommending people trade 1-minute charts. The idea here, are the setups clear? Can you hit some profit targets? Will you get some bigger winners? When you are wrong, will you be wrong fairly quick and get some small losses? And ideally, you're not chopped up and having consecutive losses drawing down on your gains. But I'm just going to go to the after the open of this day. This is back in December. I'm back a couple of weeks ago when I was putting this together. Wanted to pull up some charts, and then actually you can see in the expert advisor, even on a 1-minute chart, this is about 50 minutes or so after the open of the market. Let's see, that would be 8:30. Oh, sorry, it's an hour and 20 minutes after the open. We get a bull trigger. We got a strong bull candle on here. What I am going to recommend, if you're going to intraday trade the ES, and this will be from some back testing that you're going to use at a minimum of 8-point stops from back testing that showed to be more likely to get to some profit targets before being.
Brian,
Sorry, Jake?
let me jump in here for a second. Okay, notice, very important. Once the indicator turns green and the bars turn green, they stay that way for a fairly long time. That's super important. You know, anybody can go back and pull out examples and say, here's an example of this, here's an example of that. We do that only for the purpose of illustration, so that you can see what the concept looks like. It's not perfect, but it is very consistent. And so I say to you, as I said before, give it time, try it, and see for yourself what it does for you. But most of all, you need to be honest with yourself. Don't look at the chart and say, I would have done this, I would have done that, I would have done this. There is none of that. It's either you did or you didn't. So when you're practicing, make it real, use real money. Don't use the hypothetical approach to what you're doing because it's not going to help you learn anything. It's like living with someone before you get married to them. You learn nothing about it until after it's over. So go ahead, Brian, it's yours.
There you go. I like the comment of shadow boxing compared to real boxing. You're going to take a hit real boxing and you might get knocked out if you're just practicing. You don't have any of that pain potentially. So definitely paper trading if you just want to learn the process briefly, but definitely do live trading because you need to have the capital at risk in order to learn something about yourself. And as Jake was mentioning, sorry, Jake, go ahead.
When you take that hit, you want to feel it. You need to feel that reality. Otherwise, it's not going to help you do anything except practice. Practice is not what it's all about. It's real trading that's important. Even if you lose a few bucks, which is super important, you have to give an opportunity to the methodology to work. Otherwise, don't waste your time.
Yeah, we're back to what would you do to just get in now? And that was something I did learn from you, the get in now, although the acronym is GIN. And I can understand not wanting to have a GIN trade without tonic, but at least in this case, if you're not willing to get in now on a setup and your brain defaults to, yeah, but what if blah, 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 you got a problem. Because literally, if you're on a 1 minute chart, you don't have time to think. And I was recently commenting on this was basically the rules I'm about to put out on the 1 minute were done from a high frequency trading range bar strategy that I coded that actually has over 2,500 trade results on that one. But as you can see, I'm putting up 8-point stops on 2 contracts, means you got $800 risk per trade. Not necessarily cheap, but I would certainly say not expensive for individuals to do. Based on the coding on that and testing 6.5-point stops on the first target and set it to break even. 13 points on the second, as this is a get in, get up, and get out on swings. There's an alternative profit target. If we do get to the price extreme on even on these charts, you'll see the red and green diamonds. You don't want to get out with less than a 3.25-point stop or you're just throwing money away. But the idea is to get up, get to break even, let it play out. Some trades will last a long time and win big. Many trades will have small losses and an alternative exit if expansion contraction gets a sell trigger after a buy, you're out. Or if Williams accumulation reverses, although I'm not showing that on this current chart, I'm still using Larry Williams indicator. Go ahead, Jake.
Let me in for a second here, yes. When you're setting this up, make sure you're using the correct accumulation distribution indicator. Williams accumulation distribution, pardon the voice, is different than traditional accumulation distribution. Williams accumulation distribution is based on price, not volume. So remember, Williams accumulation distribution, named after my good friend of many years, Larry Williams, use the right indicator or you're not going to get the right results. Back to you, Brian.
Thanks for that, Jake. So outside actually the rules, just briefly, I'm going to show a partial picture here of the 2,523 consecutive trades on a testing back goes at least a year ago on that one. But you can see the net gains. These are in percentages, net losses. The system's up 500% on that one. Some notables on here, 234 of the trades were greater than 1-to-1 profit to loss. There were only 10 trades that were stopped out at an 8-point maximum loss on that one. And I even kept track of a little bit on 7 points. But the main thing is you want to go through the data. You want to know what your maximum drawdown is. If this is 11% too big, it's not a system for you. Although ideally we're seeing the max drawdown versus the max run up in this situation to where we can get some big winners. And the drawdown is small and acceptable as long as we're seeing a win rate most of the time on a large sample of trades with an acceptable basic average profit to loss of less than 1-to-1 on this, but at 63% plus. The minimum needed to make money was a 0.57, just round that off, and it is 0.89. Statistical minimums on that are 0.25 edge from all of what we've learned in the past. And of course, this would take a $40,000 account to start on that. And so some of the pros and some of the cons, if we're assuming 2% risk, you have to have a fairly large starting position if necessary. Go ahead, Jake.
in here for a second, okay? Okay, now this is super important. Ask yourself the question, do you know the historical performance of your strategy? Do you know some of the numbers that Brian just talked about? How accurate is it? What's the win-loss ratio? What's the average profit per trade? Most traders don't even know the rules of their strategy, let alone the performance. If you don't know either one of those, or if you don't know one of those, you're not going to make money as a trader, or whatever you do make, you're going to give it all back plus more. Please take this seriously. I've been doing this for a long time. Brian has been doing this for a long time. We know what the hell we're talking about. Back to you, Brian.
Thanks, Jake, and you bet it takes a lot of work. It is absolutely worth it. But on that previous slide, if you don't have a get in now trade, right, what would it take to just get in now? And if you don't know the probabilities prior to taking the trade, you are going to go into that right brain problem of, yeah, but what if? And that is, again, a problem on that. The risk you're willing to take is that you may be wrong this time. Ideally, you'd like to know those probabilities in advance and then say, well, okay, this trade was a win or a loss. That's normal, and move on. I do know that Jake had said it's not about the money, it's about the process. And I know for a lot of us, it's still about the money. Hopefully, it's becoming more about the process. No, go ahead, Jake.
No, Brian, it's a boring process that has no sex appeal. But making a lot of money will buy you plenty of sex appeal. Back to you.
Exactly. It is hard work, right? And I know that those that have helped, I'm sure Jake's had the same results, those that have helped that did the work have reaped the benefits on that, as I do hear back usually around Christmas time on people happy with the results of what they've been doing. And at least on this example, I have pulled up the expert advisor and did scroll down a bit. I wanted to show one of the reasons for going to, say, a fixed stop here rather than using 2 times the moving average channel, as if you look at the maximum loss and the first target are just 8 points. This is a bit too small to use 2 times the moving average channel for a stop. Jake, I believe if I recall, you said at one point you don't want your moving average channel to be much less than 5 points in the ES. Is that correct?
That is correct.
Okay, and so in this case, that's why switching to a fixed risk stop on that. And these calculations on here literally show like the setup to get in is bullish and strong. You're in an upswing. This is happening in a minute. And so you have, if you've got your rules, 1 minute to get in on the trade and everything, as these setups will start to flash as the candle's forming. And you know, at the end of the candle, it's a get in now with 8 point stop. And either here's the 6.5 point target on the second arrow up. And then I marked this one because there's the diamond for the price extreme. So this trade actually at the first profit alternative. And then we'll pass the 6.5 because we got a small gain and gone to break even. And the 13 point target, again, we'll show with the black diagonal line on the candle that gets hit. And so we got short-term buy trigger and strong up in expansion contraction, a strong setup. We'll go up to a price extreme in this case and hit a target and then move on, and you're out in this case using expansion contractions, trend filter only. And here, if you notice, I took the short-term lines off to just go back and say if you're trading a 1 minute chart, ideally you're in a trade for 20, 30, 40 minutes, not 1 or 2. 1 or 2 minute reversals do happen, so you got to be aware of that. But I will show you a few losses here shortly, so let's at least get quickly over to that. 4 points on the first target. I said 3.25 at a minimum and 13 on the second target. If you get that's a 17 point gain on a 16 total point risk, 8 points times 2. So that's a little bit better than a 1-to-1 result. So I'm just going to go to the next setup here. Again, the expert advisor showing on a 1 minute chart. We got a strong sell on the setup candle. After a big run up, we've got a strong sell. And on that instance, if we had taken the trade on here, you can see we're going to get to a price extreme again, get a small target and go to break even, and then run down here. I'm going to mark here. There's the 13 point target with this miss just by a point or 2 on that, and then exiting it out no later on the reversal on the buy setup. So I went over and just marked that one to set up quick hit, small target, go to break even, and hit a second position. And on that second trade on there, made 3.25 at a minimum on that, even though it was a little bit closer than that. We still wait. And because it didn't get to 13, I did pull this one back and just showed that it would have managed to have got the 6.5 after price pulled back and started to show a buy trigger, no, get out on a sell no later than a buy reversal in this case. So let's pop over to the next slide where we've got a trend continuation sell. I did mark the open of the day in this case, and if one were conservative and saying, I need to see what the first 15 minutes does to see if this is an opening range breakout lower or higher, if one were conservative in this case and waited, they could have taken the trade and made money. But if you're conservative and wait for the pullback, we do get a trend continuation sell, which the expert advisor is showing. We're bearish, it's strong, we're in a downswing and all of that, and we're expanding strong to the downside. So this trade will go down, and don't get to the price extreme target on there, but this one will get the 6.5 and eventually 13 on there. I do want to point out, based on what Jake does, that if we were selling at all in this pattern, we could also be selling the upper band on this one and trade the range. But again, that since that MAC channel or the moving average channel is so small, I don't generally recommend trying to trade a point or two, but that is certainly scalping. So I am putting up, made the 6.5 target on the first trade without being stopped out, go to break even. This resistance does not come back above entry pricing, so eventually you're going to go down and hit the second target. And then again, this 18.5 points is more than the 16 points you risked. And I do see that with these strategies, even intraday trading, ideally you can get a position that makes more than you put at risk on those trades. So I'm just going to pop up to the next buy trigger. So you can see that this was the last buy trigger. If we waited and saw this pull back, and we're going all the way over here to a buy trigger at the latest. If you hadn't hit 13 points in this particular case, you'd be out with a buy setup.
And one more thing, Brian.
Oh, sure.
If this methodology was not totally 100% perfectly objective, not subject to interpretation, the expert advisor would not be able to program it. The fact that it can be programmed with specific rules means that it's clear and consistent. So if you lose money because of the system, that's one thing. That's the smart way to lose money. You did what you were supposed to do. But if you lose money because of the trader, that's the stupid way to do things. If you keep on losing money because you didn't do what you're supposed to do, there's very little hope for you unless you change your behavior. So the methodology is clear and consistent. If you don't have a methodology, whether it's this or something else that can be programmed algorithmically, prosaically, then you ain't got nothing. Don't waste your time because you're never going to make money. There's my little sermon, and it's back to you, Brian.
Yeah, thanks, Jake. And I have certainly had a period of time where I was inconsistent and I was not 100% objective and rules-based. You certainly planted that in there over a decade ago. If you want to be consistent and you want to have some proof of probability before you take the trade, you either code it into your system here or you buy services like Seasonal Trader that already does all those calculations for you. But again, if you don't know your probability of winning and you don't have a get in now, you're likely to do whatever. And I always said that whatever is inconsistent, having done it before. So I'm going to pull up another example, I should say, here of an intraday chart, and it just popped ahead to where the expert advisor again says we have another 1 minute strong buy. We're just continuing to work forward. And in this case, you can see price did get a little choppier. We didn't get to a price extreme, so eventually did get up to the price extreme after chopping around a little bit. All bullish here, buy the dip or take the trade setups. So the first trade that we're showing here with an entry and 8-point stop and a 6.5 point target, actually got a 5.5 point target on the first trade. Go to break even, and then when market does slip pretty quick and we do get that sell set up that's back below the previous buy, no second target on the first trade here, and we get a sell trigger here at the price extreme and still strong down on here. So in taking this as a sell trigger, And looking at that, we obviously are going to get stopped out on a reversal. In this case, I did put the stop. This is 69.20, 69.28 is the stop. That was above resistance. So when we sell off here a little bit, not getting quite 3.5 points, and it price reverses, that stop out, although that says 8 points, that's on both contracts. And so that was a 4-point stop on an 8-point risk. 8 points total, because if you start totaling up these points, you'll see what it did. And then we got the buy setup that immediately went nowhere and then fell back down into the range. And so after two setups like this, that are both going to give us stop outs, and we start taking a look at what expansion contraction at the bottom is telling us, when the cone or the cloud, the long-term trend, is inside the small dashed horizontal lines, which are its normal range, we're not strong trending. And ideally, if we've been chopped out with a trade short that fails to go short and a trade higher that fails to go higher, we should realize that we are in some kind of consolidation pattern on that. And ideally, you've got an indicator that just says, wow, until we break out at this point with price trading in a range, failing to trade lower, failing to trade higher, again, it's going to fail to trade lower, fail to trade higher above resistance on these. We want to be careful or conservative here till we see another strong breakout up or down. So ideally, rather than take a series of small losses in here, we'd have a not trending pattern and stand aside. Go ahead, Jake.
One thing you may want to do, take the indicator, put it on a weekly chart or a monthly chart. You will not see anything as beautiful in any indicator that I'm aware of, other than expansion contraction. If you look at it on a weekly chart and talk about easy, it's the easiest thing to do. Requires very little time, and it will catch the big moves almost all the time. So check that out sometime. Forget about the ultra short term. I don't do that anymore. I used to do it a long time. I'd make 20, 30 trades a day, but it's a lot of work, and it's much easier to make a big amount of money on a smaller position over a longer period of time. And expansion contraction is just perfect for that. Go ahead, Brian.
Thanks for that, Jake. And absolutely, I mean, you've got to, anyway, I'll just go on to the next setup in here and saying, if we were choppy and trading inside the range and not really breaking out, and if we waited for expansion contraction to exceed a 2 standard deviation or twice the normal range on here, after chopping around and standing aside for a little while without it really breaking out, we still could have potentially had another small gain that just failed to make the 13 points up at the high. So if we just sat there and waited for it to make a reversal, that trade was also a small gain on that one. And as Jake had mentioned, whether you're on a tick chart or a 1 minute or 15, whether you're on a 1 hour, 4 hour, or a daily or a weekly, this pattern of expansion contractions longer term trend is really a 24 to 32 period on average, which means although it can be 1 or 2, maybe 3 to 5 bars in a reversals, we will get more big moves. And so we're willing to take some small losses in choppy markets, or go to stand aside and wait for a breakout strong up technically with an indication. Then we'll be able to know when to get back in of a choppy market if we have gone to stand aside on that. So let's pop over to the next slide on here, because that just totaled up what that was, the 6.5 points after a sell set up and down to 13. And as Jake was saying here again, we have a long period of time here. This is, well, basically almost 120 for me in West Coast out to about 2 o'clock, 2:30. So, oh, sorry, about 12, I should say, on that. So that is a decent amount of time and all of that. It didn't include the whole thing, just as I was saying, well, if we're taking the setups strong down at this point after being strong up, waiting for a strong down trade sequentially here, ended up providing us with either a decent win, more than we put at risk, or if we were taking continuation trades on that additional positions into the day. I didn't want to go too aggressive and label out everything, but show over a couple of days, clear setups, some choppy conditions, because you're going to get it. And you got to know what to do in advance, or you're just going to break the rules on that one. As we've been doing, I'm going to just go back because we had the November session that we hadn't quite finished out the whole year, but I'm going to pull up at least the Apple buy-sell trades off of expansion contraction and the swing trades and any divergence trades as we plotted before. So had a decent year in Apple. I'm just going to go through this briefly looking at the time. As I will show the total slide here in a second, and I know this is a lot of information, but we've got the beginning of the year on this one and show all the trades on the setups, the net gains, the net losses, the wins, and all of that. So definitely Amazon, although it wasn't really a strong trending year, did look a bit choppy, was still positive. NVIDIA, right, 11.61. It's underperformed the last couple of years. 23, 24 were great. 2025, I'm still going to go as acceptable after all the beginning of the year. We chopped around, got some consecutive losses, drew down, managed to get some winners, pulled back to break even. And then finally, for the second half of the year plus, managed to get back up in the range and finish out positive in NVIDIA. Palantir, same thing on rotating from last August into Palantir when Microsoft went weak. Palantir was strong, and the reason for rotating into this and not showing the full year last year was due to that condition. The basket had included Microsoft. It became a weak trend and rotated into Palantir as a strong trend. And I'm just going to say here, if you're looking at one loss for the year, Palantir last year made me the most. And Jake, I think I heard you said you also made a fair amount of money on Palantir's positions.
It was a great stock. I wish there were.
It's a great stock.
I wish there were more like it.
Exactly. And when is it a strong trend? Jake, your strong trend filters basically the 5 above or 5 below. And if you're looking for something that's strong and you want a high probability setup coming up after the 5 above or 5 below, the next swing trade has a high probability. So if you're not watching, here are the 5s if you're wondering what I'm saying about. We have 5, 5, 5, 5. I'll just label it that as 5 above. Jake's gray moving average channel in here on that. And you can see when we're in a strong trend, we're going to get that. And there's rules of trading around that. That if you want a strong trend definition, that one works quite well to roll or rotate out of something that's become weak into something that is strong. Better year this year out of last year, so the SPY actually did better than the Qs this year, although we did have the sell-off it in itself, where the Qs had some more losses for the year. SPY only one net here, and we're still showing some positive results. So if you take a look at the next Metastock presentation we do, and these results are a bit different. I still have a few floating positions out here on that. After Tesla, we'll just pop in and look at the same basket of results. The basket's not changed except for August of last year, as I said. And when individuals have said, hey, your basket there is kind of tech heavy on many tech stocks and a couple of consumer discretionary. Yeah, that's what's strong trending. And ideally, if you want to see decent gains for the year, you rotate into strong trends, stay in them as long as they're strong trending, and rotate out into something that is strong trending. The risk we might have with expansion, contraction, and trending is if the market starts to consolidate and trades in a narrow range, then obviously expansion, contraction isn't going to see these kind of results. But we do want to be aware that we've got closed positions out and some floating trades on that one. Anything in red is currently down slightly for the year. The one net loss for the whole year was Aussie dollar. It was down over 7% at one point. I managed to pull back. And this year, the currencies are about half the performance of last year. I'd have to go all the way back to 2015 before there was a small loss year net on that basket. So it's been performing quite well for over a decade. When people say, why those retail pairs? If you were futures trading, you could go in and trade the individual futures. I would say that the pound and the yen there have shown the best results historically over decades on these types of systems and everything. But definitely want to show results, because if we're going to talk about clearly defined rules to get in, set up, trigger, follow through, And as I said, rules to get in, A, B, C, D, rules to get out at a loss, A, B, C, D, rules for taking profit, rules for adding to a position, because if you noticed on those previous charts, there might be an expansion contraction buy followed by several swing buys. And in that case, in having one or two, maybe three or four positions in a long-term trend, we can take an individual stock and see it go from a 2 or 3 or 4% gain to a 10 or 20. And last session, when I reported some of the option trades from those same patterns, trades with multiple positions in there making over 1,000% on the risk are also possible on there. So again, we've got the expert advisor, the power console and everything, and the system test I just kind of pulled up. That's the basic stop and reverse program on there. It does show more green in the S&P than red, and the most bearish is less than the most bullish. So we've got some general characteristics in there, very general on a stop and reverse, not necessarily a recommended trade strategy to just do complete stop and reverses, but because we do want to define our risk. But at least you see there, if we were just flat out doing stop and reverses, what that might mean. I am working on, oh, sorry, Jake, go ahead.
Yes, a word of warning. As you all know, and I don't have to tell you, but I'm going to do it anyway. If you look on YouTube, you're going to see all kinds of people offering all kinds of trading strategies, all sorts of guarantees, all sorts of exaggerated performance claims. It's not true. Don't believe it. Please be careful. You're going to get ripped off. I have people calling me every day or sending me emails every day that they've been ripped off by operators on the internet who claim to have fantastic trading systems. All they want is your credit card, so they keep on charging you. Please be very careful. Go ahead, Brian.
Yeah, Jake, there are programs out there that are just sell you more, sell you more, sell you more, right? I'm not working out, things don't seem right. Well, then you need this. Okay, and then that's not working out. Oh, well, you need this. And so be aware of that process of continuing to sell you more. As we mentioned in that slide before, if you don't know the probabilities of taking the trade before you take the trade, why are you risking money on that? And or why are you doing it consistently? I've been there, I've done that a long time ago. Obviously, what we do when we get in here with these is recommend you get control of yourself. You say to yourself, I'm only going to identify systems that have been proven, and I still need to prove it to myself, because literally, if you're not willing to prove what you're doing to yourself is consistently profitable and you should just follow the rules, instead, you're more likely to follow the right brain, yeah, but what if process and still go with blah, 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 because it's just really easy to justify doing something else. I see it as a coach where you give someone clear rules and then they're right in there going, well, this is what you said to do, but. And I always say, well, that's great because you just want to get it down to this is what I will do and no buts on that one. And with that last slide, I was just saying before, I'm working on integrating and artificial intelligence into expansion contraction, because basically I'm not trying to create something from scratch. That's I'm going to say almost near impossible at this time with AI, because it isn't a back testing system only on that, and garbage in, garbage out is still true with AI on that. And I've certainly learned that a few times in inputting some information and getting some answers I didn't expect, and then realizing I hadn't asked the right questions or produced the right process to have AI implement. But ideally, we've got some type of non-lagging indicator system that's based on quantitative technical analysis on that, and integrate either sentiment and or seasonality into those. And Jake's got both sentiment and seasonality. And of course, we've got expansion contraction. So ideally, just looking for a hybrid integration into using AI, as you really don't want to just go to AI and say, it's doing stock picks, I'm going to follow AI, because I have seen in contests that AI is actually using some reasoning. And Jake will know this, psychologist and background more than anything. Human reasoning is flawed or potentially flawed. and to see AI integrate reasoning such as, well, the trends are good and the fundamentals are fine, so into the future this should trade higher, were general comments, and not exactly what we were hoping, at least initially, with AI to create trading systems. But that will get better. I know that certainly working on that, and when you do that and find out what are the pros and the cons, what are the problems on that, but this is all what you got to be willing to do, or know someone that's willing to do it. And this, because there's a fair amount of work to have systems that are consistently positive outcome over time, and then how to make them better without crashing them. So,
Brian,
do you have any? Go ahead.
before we run out of time, I will turn it over to Jeff, who can make some final comments. And go ahead, if you want to do this, just go ahead and talk about this, Brian.
Yeah, we'll put up the coaching special that you and I have been running over the last year or two on this for small group mentoring. This is still available at a fraction of the cost for individual. Yes, as a group, we get together, but we will go through not only futures trading, but stock trading and options trading if you're interested on that. And so we just want to run these specials because they do get filled up pretty quickly on that. But and this is what's available coming up in February for you to make use of. And obviously, here's our final contact information in the last few minutes. If you need to get a hold of Jake or myself, those are the phone numbers and or the sites on that, and be more than willing to help out anybody looking seriously to advance their trading to a systemized process that we can prove and help you prove it to yourself. Okay, so I'm done, Jake.
Thank you, Brian. Thank you, everyone, for listening to us. As I said, we're not paying anyone to be here today. They're not paying us to be here today. We want you to be successful no matter what you do. We try to provide clear and objective rules-based information for you, and we're privileged and honored to be able to do it on a great platform like Metastock. I will turn it back over to you, Jeff. Thank you for the opportunity to speak.
Oh, definitely. Do you guys have time for maybe 2 questions?
Maybe 3.
Okay. I'll have to go quickly though. Kevin wants to know, is XC similar to Bollinger Bands?
No, not a. Go ahead, Brian.
Not at all, right? John Bollinger created the Bollinger Bands using standard deviation. So expansion contraction is completely different. It's price-based and non-lagging. The Bollinger Bands and other indicators predominantly lag behind pricing, needing many periods to plot one. Expansion contraction requires 1 period to plot today.
Brad wants to know if you can kind of talk a little bit more about divergence in your indicator.
Well, price is making new highs and the indicator is not making new highs. One of those 2 things is not like the other, and similar to momentum or other divergence systems that Jake's plotted out. We'll see pricing making new highs and the indicators slowly making smaller highs, in that case, creating potential divergence trades on that. If we're looking to take divergence trades, or preferably bullish divergence trades and uptrends, as those will have a higher probability of being a bigger winner more often than taking bearish divergence and strong uptrends.
If you send me an email to jake@trade-futures.com, I'll send you a webinar I did on divergence, which I think will explain it much more clearly than we can.
All rules-based, absolutely.
Go ahead.
I said, you explained it. You explained it very, very well. Yeah, I've been in the room when you've explained it before. It's really good. All right, that's all. Those are the questions you have. Jake, thank you very much. As always, Brian, that was awesome. Good job.
Take care. Happy New Year.
Thanks, Jeff.
Thank you. Happy New Year to you guys. We go ahead and see make
Happy New Year.
Yeah, I don't know if there's an appropriate time to stop saying that, but I'm going to push you on because I think you should always have a reason.
Choy at this point.
For sure.
Coming Chinese New Year.
There you go. There you go. There's always something to celebrate, right, Brian?
Absolutely.
All right.
Thanks, Jeff.
Again, great indicator. Great job, guys. Appreciate the work you've put into this. Helps you identify that long-term and short-term trend and trend strength. helps you find whether range is expanding or if it's contracting, shows you support and resistance levels, overbought, oversold conditions, divergences, breakouts, all that kind of stuff is built right in. I was so impressed with kind of the materials as we were kind of going through the coding process, which can be kind of, there's some creative stuff to the coding process that I like a lot. But what I kind of decided to do in terms of the way this was structured and put together was, because all of this stuff is very, very easy to identify, and as they said, it's very objective to find, I decided the best way to kind of iterate what it was showing was to put together this dashboard view. So right here, you've got a strong buy, ran an exploration to find the strong buy, but here you can see the long-term trend, the strength, the short-term trend, the strength, what the range was doing, where your breakouts is, whether there's overbought, oversold, what your support and resistance are. All that kind of stuff is just a dashboard view, as you can see in the expert advisor commentary right there. So I like the way that was designed. I think it kind of helps. You know, a lot of times you just want to kind of show me the details. A lot of times you already know kind of what the meanings are. You just want to kind of be reminded what the details are. And it does break down those meanings too, individually, if you go a little bit deeper into that commentary. In terms of the scanning, you can scan for the divergence, the buy and the sell signals, the long-term bullish and bearish trend, breakouts, all those stuffs are explorations that you can run. So it does have a system test. You can go in and test, and actually the system test works really, really well. You can kind of see where we ran it right here. So in terms of this, we also sat down. I think it's important for you to understand why you're trading, what you should do with that when you are trading. And so we did sit down for a two-part training session. Jake and Brian discussed how to use JBXC. They did a lot of really good information about that. And then I kind of got more into the nuts about here's how the scan works. Here's how you can look at the commentary. Here's how you set up your charts. Here's how you do everything you need to do. Some tips, some suggestions, some tricks that you might not even be aware of in Metastock. And so this is available. It's recorded. It's instantly available as soon as you get your order in. So in terms of the offer today, the JBXC is only $5.99. It's been a very, very popular add-on. I think it's underpriced for what it does. Here at the Summit, though, we're going to make it even more underpriced. We're going to sell it for $4.99. We'll give you a money-back guarantee as part of it. So, you know, we stand behind our products. If you try it and it's not helpful for you, you can get your money back. We'll even throw in a free trial to Metastock, so we can really make it a very low risk, high reward offer for you. You can do this. I'm going to go ahead and hit enter right here, which will put this in the chat for you. You can do this at metastock.com/JBXC. You can call us at 800-882-3040 and put it in the YouTube chat as well. Usually Greg's on vacation, but he's usually helps me with this stuff. So, and you can also, if you want to chat with us, you can go to metastock.com/sales-chat. So again, money back guarantee, one-time cost. It's not something you have to pay over and over and over again. Give it a go. 800-882-3040, metastock.com/sales-chat, or 800-882-3040. And you'll be glad you did. And it is also part of the super app of the Traders Action Pack. You can get the Market MRI. You can get Greg Capra's Master Trader, Jake Bernstein, the Rahul Arora Velocity. All the products we're basically going to talk about today. A course from Oscar Carboni that we sat down and recorded on trend lines and technical patterns, and 3 months of Learn Metastock as well. Normally, individually, that's $6,386. Your price today would be $2,788. Give us a call, 800-882-3040 for that one, or metastock.com/sales-chat. So there you go. All right. As we move on to our next speaker, I've talked about stocks and commodities. I still appreciate stocks and commodities. They've done such a great job at supporting us over the year. But right now I want to invite you to join the Traders Forum. So if you go to thetradersforum.com, you can join a community of active traders. We share ideas in terms of what we like, what we don't. Some really good traders up there. Some good conversation about Costco hot dogs for some reason. But you can learn about the markets. Tons of information about different candlestick patterns. We do lessons on indicators. it's something that we've been doing for a couple years now. It's a community that's growing. It's a heck of a lot of fun, and you should join us because it won't cost you anything to do it. thetradersforum.com. So www.thetradersforum.com. You can do that now. All right, we talked about Metastock. We talked about, you can get any of the offers today that we talk about at metastock.com/summit deal. If you have questions, give us a call. We're here to help. 800-882-3040, metastock.com/sales-chat. So I hope you're enjoying it. We are 4 minutes behind schedule, which is not a big deal. Our next guest is another dynamic duo. So I'm going to call it every time we have two guests speaking at the same time. John and Jack Kosar. John actually and Jack had some pretty good ideas right around last year that really helped me in the market in terms of what tariffs meant in the markets and kind of different ways you could rotate money. The reason I like to bring John and Jack on are they're fun to listen to. I really like them. And I always get some good ideas for them. So grab a notepad if you don't have it already. You should. Get ready to take some notes. We're going to go ahead and go over to John and Jack. John and Jack, can you hear me right now?
I can. How are you?
Right.
Happy New Year.
Hey, Happy New Year. Let me go ahead and make you the presenter.
Okay.
There you go. Should ask you if you want to share your screen. I do notice that one of you is out of uniform. Usually your shirts match.
Yeah, we kind of look alike, so we figured we'd mix it up a little bit with the colors today. Yeah, so you could tell us apart.
Yeah. Okay. Yeah. You guys. Well, I would say you guys look very similar. The glasses are very similar, but mostly you're similar because you're so handsome.
No, thank you. Yeah, we hear that all the time.
All right. So you go ahead and get out of the way. It's your turn to go. Go.
Okay. Happy New Year, everybody. What we're going to try to do today is, this is my 43rd year in the business. I spent some time, as you can see by the upper part of the screen, on the Chicago Futures Exchanges. I spent 17 years there in the 80s and 90s. That was my college. And my approach to markets changed after I got off the floor, and I had been in the business about 20 years or so. We launched Asbury in 2005. But what I started doing was trying to rely more on math, more on systematic trading, rather than the kind of trading that I was used to on the trading floor, which was a lot of seat of the pants trading. You listen to the crowd, and a lot of it is very emotionally driven. So we've kind of moved away from your standard RSIs, and I still look at them all, RSIs and stochastics, and we built a bunch of models. So what we're going to do today is kind of blend how we look at markets now with some real-time charts that we're looking at that we think are especially important, and indicate, we think, what the condition of the market is and where it might be headed later on in the first quarter. So this is just a little bit about us. Jack and I have been building models together for 10 years. Yeah.
When Jack was in college. So Jack's got his master's in finance from the Illinois Institute of Technology, Illinois Tech. And so basically, Jack was able to look at what I've learned over 40 years and take the indicators that I had success with. I didn't know the numbers on the indicators. I just knew that they worked for me, but I didn't really have any quantitative proof that what I thought was useful in the markets was actually helping me as much as I thought it was. So when Jack came in, we started back testing everything that I had learned, and that helped us to build models, and we're still building models. We're probably going to be building models, well, as long as I can sit upright in the chair. It's going to be some time from now. So we started to manage money. We launched Asbury Research in 2005 for institutional
money managers only. Fidelity asked me 12 years ago to do an educational webinar for their kind of top shelf investors. They're more active traders. They're traders that had larger trading accounts. And now, you know, that led to us building a research product for individuals. And Jack and I built some model portfolios, which we'll talk about a little bit later. And we're managing money for both individuals and for other RIAs that are giving us some of their assets under management to manage for them. We've been seen a lot over the years. It's good to be seen. And this is what we do. I tried to simplify this. There's so many different ways to look at the markets that the first thing that I did, especially after Jack came on board, was to try to simplify what we're doing. And to me, there's two components to this. The number one is, when is it time to be aggressive? And that is risk on for us. And when is it time to be defensive? And that is risk off for us. We built some indicators to let us know. The stock market inherently goes up most of the time. It's been going up for 100 years. It's probably going to go up for another 100 years. The trick in the stock market is to avoid some of the downturns. And we're going to talk about how important it is, especially for older investors, to be able to avoid drawdowns. If you could avoid half of a drawdown and be able to reallocate your money, you immediately have a lead for the year. And that's really important to us. The second thing is, when you are risk on, what do you buy? Do you just buy a regular S&P 500? Do you pick individual stocks? What criteria do you use to try to be in the right places to where if our metrics tell us to go risk on October the 1st, and between October 1st and Thanksgiving, the S&P is up 8%. What we're trying to do is be in the right places within the S&P 500, so maybe we can be up 12 or 13. I think those, as far as we're concerned, those are the two simplistic ways to look at the market, which we think have a lot of influence on how well you do in the markets. Before I start here, I actually wrote myself a note and I missed it. I just wanted to say that when I started on the CME trading floor in 1980, there was a very short group of guys that I used to follow. And they had books out and they would speak around Chicago, and Jake Bernstein was one of those guys, one of the smartest guys that I have come across. And Jake was kind of who I wanted to be when I was 24 years old. That's who I wanted to be when I grew up. A couple of guys, Jake and some other guys, Larry Williams was another one. So just I just wanted to kind of acknowledge, you know, what an expert he's been over the years and what a great influence he's been on a lot of young traders from the 80s and 90s. How we do it, our models. We have a bunch of models. Our CPM model, which we're going to look at, that's the risk on and risk off model that helps us to avoid downturns, drawdowns. The Asbury 6 model is our daily metric that tells us what the internal health of the market is. I built this 5-6 years ago, something like that, because it got harder and harder to try to determine day to day what the condition of the S&P 500 was, because it was up 70 one day and it was down 70 the next day. You know, and you've seen that now. We go through these periods. It's been really quiet for the past couple of weeks. We're coming out of the holidays, but when the market's up 50 today and down 50 tomorrow, it's very easy for you to get thrown off of track. You might have a really good understanding of where the markets are, and the market's down 50 one day and it's down 70 the next, and all of a sudden you're questioning your work and you're getting out of your long position, and then you're buying it back at fresh highs 3 days later. The A6 is a tool that we use to try to keep us from doing that. I'm going to show you the 6 metrics, how we use them, and hopefully some of this you'll be able to take to Metastock and be able to maybe create your own Asbury 6, with 6 indicators that work really well for you. Our SEAF model is our sector rotation model. That tells us where to be invested. It's not the risk on and risk off, but rather what parts of the market should I be in? And we're looking to outperform the S&P 500. SEAF has been able to do that pretty well over the past 8 years. Our CARP model, cross asset relative performance, CARP just tells us quantitatively where the outperformance is. We look at, I think there's 9 different equity driven. We're not going to be able to look at CARP today. We're not going to have enough time, but what CARP does is tells us, like the SEAF model, what's outperforming. If you can get the direction of the broad market right and then outperform, that's kind of nirvana. That's having your cake and eating it too. Our US versus the world model, we're not going to get to either today, but all that does is it looks at the S&P 500 versus 25 foreign equity markets all over the world, 5 different regions around the globe, and tells us where the outperformance is. This year, from August to October, we got a big, strong trend of relative outperformance in South America, Chile, Peru, and Brazil, and they're still outperforming today. Actually, Peru is outperforming since then by, 35 or 40%. So that's another thing we do here is it doesn't happen all the time, but when there is an opportunity overseas, we want to know about it, and we do that quantitatively. We're going to look at our ETF trade ideas, give you some ideas, hopefully, on how to build your own metric that will quantitatively tell you where to find value in 6,600 ETFs that we scan every day. We filter that down by 3 criteria. We're going to share those with you. And again, hopefully you'll be able to bring these over to Metastock and start to build your own tools that you're comfortable with. And then I had mentioned that we have 4 model portfolios. That's for the managed account portion of our business. And we'll just kind of show you what we did with those. Here's where to find us. And by the way, this PDF is available to you. We're going to go through this kind of quickly. So if you would like the PDF, all you need to do is go to asburyresearch.com and go to the contact tab, ask for the PDF. We'll be happy to send it to you. I'm going to turn it over to Jack and let him talk for a little bit. These are some of the criteria that we use to determine what's a good idea and what's not.
Yeah, so just some terms that we're going to kind of throw around haphazardly over the next 30 minutes or so, and just to throw some context to them. So max drawdown, really it's kind of your peak to trough. So how much loss does a particular stock or ETF or trading strategy have over a period of time? And again, it's going to be that maximum loss from the top to the bottom. So we like to use maximum drawdown to kind of indicate really what the range of what you could lose is, as a metric of understanding, what are you comfortable with? How much risk are you willing to take on? Standard deviation is really just going to be kind of how much wiggle there is in your daily return set. So, higher standard deviation, you're going to see a lot more wiggle in your P&L. A lower standard deviation, it should be a little bit more of a flatter line, hopefully trending upward. Beta, it's really the volatility of an investment relative to the market. So a higher beta stock is going to move higher on a move up in the market. Lower beta stock is going to have that less volatility relative to what the overall stock market has. Risk-adjusted return, we find this really important. A lot of hedge fund traders and traders in general will tell you how much money they can make, what's their upside return. Very rarely are they going to then tell you how much you're risking, because they're going to end up a lot of times to get some of these excise large crazy returns, they're going to need to really jack up that risk. So we like to talk about a risk-adjusted return, more specifically the Sharpe ratio. We use Sharpe ratio quite a bit. to understand exactly how much we're risking. So what's the Sharpe ratio? It's the return of the stock or the portfolio minus the risk-free rate divided by your standard deviation. So you want to know how much extra return you are getting based on the risk that you are taking via standard deviation. A good Sharpe ratio tends to be around 1. We got a couple of portfolios and strategies that hover around that 1 Sharpe ratio. And then annualized total return, just the average yearly growth of an investment over a specific period of time. So just understanding how much money you're making per year, not on a total return basis. CPM. So our CPM model is our dynamic stock, we call it a dynamic stock bond portfolio. The reason being so is it's meant to replace a traditional 60-40 portfolio. We want the market to tell us when to be invested in bonds and stocks and not necessarily a long-term buy and hold type strategy. So what we do with the CPM and what it really means for you guys is we take a series of indicators, we put them together, and then we throw some kind of money management trading strategy on top of them. The reason we go with this approach versus sometimes just trading a single indicator is a lot of times an indicator is not right all the time. So if you have 5 or 6 or 7 indicators that are all trying to give you the same answer, but using different metrics that aren't correlated, you can kind of put these things into a basket and be a little bit more sure on the direction of the market. In this case, we're buying the S&P 500, and the goal is to play the game with less risk. So being in the market when we need to be in the market and then getting out of the way when it's time. How does the CPM work? Average is about 5 round turns a year. Round turn is going to be a buy and a sell for us, but it's not on the quarter. Again, we like to let the statistics and the underlying metrics kind of dictate how we trade, which is the systematic portion of what we're talking about today. We don't want to necessarily just rebalance on the quarter or rebalance on the month, but again, let the market, let the numbers and the indicators tell us what we're doing. This is a pretty simple model in the sense that there's no short positions or derivatives, just simply risk on or risk off, with the goal of returning similar to the S&P 500, but like we mentioned with those statistics earlier, with a lower standard deviation, lower beta, and a lower max drawdown. Ideally, what that does is it bumps up our Sharpe ratio by still having strong returns, but keeping that risk number down. Why are drawdowns important? We like to show this chart pretty frequently, especially just a lot of our money management clients, and understanding, why do you invest in the S&P 5? If you're going to get S&P 500 returns, why not just invest in the S&P 500? What makes your model better? Because we keep our drawdowns low. The importance of drawdowns. If you take a 40% loss, you need 67% back to break even. And that incrementally grows, as you can see here. A 70% loss needs you to gain 233% back. So as you take larger and larger drawdowns, the amount you need to get back is higher, which is time. And if you're an older investor or you're in need of that principal, you could be in a lot of hurt, especially for those people taking minimum distributions on their accounts. You get a compounding effect. Not only is the drawdown, but you're also pulling out money prior to even getting back to even.
Yeah, here's a pretty good example. During the COVID period, which was February through March of 2020, S&P 500 drew down 34%. It's right here. Took 43% to get back to where you were at the top. So this might be close to 50% the other way. So this is just kind of a real-time situation that happened not too long ago, just to try to put it into perspective.
Yeah, and this is our CPM model. Like we mentioned, 33.9% drawdown during COVID. Our CPM model, due to the fact that, again, we were able to take multiple disparate indicators, point them in a direction, ask them the question, should we be in the market or out, allowed us to get out of the market and avoid these massive drawdowns. The CPM overall does a really great job of having a lower drawdown than the S&P 500 does. Last year during April, we had an 18.9% drawdown. CPM model was able to maintain only a 9.3% drawdown. And we can do so. This is an inception chart with returns. Green is CPM, blue is the S&P 500, and we do so with having pretty much lockstep with the S&P 500 during that time. We are market perform on going back from inception. This number is not a fancy number. We're not playing with it, but that is actually just going back to the full data set that we have. So we don't like to play games. We like to be fully transparent. So our data for this particular model goes back to the 9/28 of 2017. So we start that number on that next potential day. This last year we trailed a little bit on the S&P 500. Now these are hypothetically back tested, so there's some complications in terms of exactly matching one-to-one in terms of what we do live versus how we trade hypothetically. But again, in general, the goal here is to keep those drawdowns low while maintaining somewhere close to the S&P 500.
Right. And again, for older investors, if you're 35, you could dollar cost average for the next 15 or 20 years and be just fine. When you're older, I'm in my 60s, game changes. It's like football. In the fourth quarter, you play the game different than you do in the first half, especially if you have a lead. So that's when how much of a drawdown you're taking starts to make a difference. This is the defensive numbers that we like to look at. So the S&P since Q4 of 2017, maximum drawdown of 33.9. That was the COVID period again. Biggest drawdown that we had in CPM was 20.2. Last year, 18.9%. We had that drawdown into the April 7th low. We only drew down 9.3%. Standard deviation from inception from 2017, 16.2 for the S&P, only 11.9. That in like real time, what that means is your P&L is going to be less bumpy. It's going to look like it's a little calmer than the S&P 500. Beta only 0.62, almost 40% less than the S&P. So what does that mean? That means you're going to be trading the S&P, but your account is going to feel like you're trading Procter & Gamble or some really stodgy stock that has less day-to-day volatility. So those are the advantages. This is Ultra. When you're building a model, the most important thing to have is that spread between how much you risk to how much you're making. And that's really what the Sharpe ratio shows. And what this shows is that by trading, this was 50-50, correct?
Yes.
Instead of trading SPY with this, you're trading half SPY and half SSO. SSO is a 2 times leveraged S&P 500. It's a ProShares product. And you can see since inception, now we're outperforming the S&P 16.27% annualized since Q4 of 2017 versus 12.91. We outperformed by a little bit over 1% with a five-year look back, 3-year look back. And keep in mind, this past 3 years has been spectacular for the S&P 500. Basically, we're relative performers for the past 3 years, and we trail just a little bit this year. But that's how you can take a defensive model. If the model is good, you should be able to change the characteristics of it, how it performs by changing the vehicle that you're trading it with. Here's how we look with the defensive numbers. Again, trading CPM Ultra is what we call it. Let's say if you were trading a $100,000 increment, it would be half SPY, $50,000 SPY, and $50,000 with the SSO. About the same here with maximum drawdown. Still a little less than the S&P, 33.9 for the S&P, 31 for the model. Our Sharpe ratio is about the same, and our standard deviation is a touch higher, but not a lot. So again, if you have a good idea and you're trading for yourself, that idea should be able to be used in multiple time frames, because to us, the essence of a good idea is making more than you're risking. And that's what something like a Sharpe ratio or a Sortino ratio is going to show you. This is the Asbury 6. This is the metric that we put together to keep us from not getting faked out when the S&P is up 100 today and down 70 tomorrow. What we did is we took all of the tactical metrics that I'd used throughout my career, and we started putting them together in sets of 4, sets of 6, sets of 5, trying to kind of like building a team, building a sports team. You're putting different players on the field at the same time to see if one's strong characteristics can overcome the weak characteristics of somebody else. It's basically building a sports team out of different indicators. That's how we look at it. Both of my kids were athletes in college. So everything that we look at has kind of a sports bent to it. But what we did is we took we found 6 indicators that worked really well because they're so different from each other. Asbury 6 has the rate of change in the S&P 500. So that's measuring price momentum. We looked at the relative performance of equity prices, stock prices versus high yield bond prices, because when stocks are going up, they're typically outperforming bonds. And when stocks are going down, they're typically underperforming bonds. So we were able to use that particular relationship to give us some information. We're looking at investor flows that are going into the ETFs. If you take the shares outstanding and the NAV of an ETF and multiply those, it tells you in dollar terms how much money is in that ETF. That shows us conviction in the direction of a price trend, very much like open interest. I was on the futures trading floor for 17 years, and I really relied heavily on open interest. This is kind of like open interest for ETFs, and we use it a lot. Volatility. We're looking at VIX or a surrogate for the VIX, which we're going to show you here in just a moment. I want to see if the market's scared or if the market's calm, because it makes a big difference in if the market's going to go up or down. Trading volume. Volume shows urgency to buy. If there's a lot of volume, it means there's urgency to act. There's urgency to get in there and participate. Volume is very quiet during the Christmas period because a lot of people are done trading. So volume has a big part, has an influence on what we do. And market breadth is basically how much participation is in the move. We had an odd year last year because for a lot of the year, market breadth was pretty narrow. It was pretty weak because you had the Magnificent Seven that were driving the overall market higher. They had so much market cap between those 7 that they were able to drag the rest of the market up with it. So those are the 6 that we look at. You can see the indicator's noisy. It's supposed to be. We have I think it averages 10 round turns a year looking back to 2017. This past year, most of those 10 were isolated up here after October when the market started to go flat. Basically, since the latter part of October up until a couple of days ago, the market was kind of locked in a rectangular range. Since 2017, the A6 has been a relative performer versus the S&P, meaning that they tracked side by side most of the time. But the difference was the drawdown in the S&P was 33.9, and drawdown here was only 13.6. So 60% less drawdown. How you pay for that? There's a lot more activity. This has got averages about 10 round turns a year. Let's look at them individually and see what we're looking at. And just as an idea builder, this has been a really strong influence on how accurate we are in interpreting what the condition of the market is. When all 6 of these are green, that's as strong as you can get. It means it's basically clicking on all 6 cylinders, 4 or more for the Asbury 6. It indicates a positive bias, 4 or more green, I should say. If 4 or more of these turn to red, that indicates the market is starting to lose its internal strength, and this often leads to some kind of a correction. So you can see right now, you see the numbers in the cell. These are all the dates. So you can see basically since January 2nd through yesterday, or through Friday, I should say, is when all this new strength came in the market. It coincided with the S&P 500 breaking out to new highs. Here's what they look like individually. The first one, excuse me, is the monthly rate of change. This is showing you price momentum in the S&P 500. You can see it had been down since December the 22nd. All of these, I should back up a step. All of these are measured through the same lens. If you're building models, if you're trying to become a systematic trader, you need to look at different metrics, we believe anyways, through the same lens. If I want to get a certain outcome, all I have to do is change the look back on a stochastic or a RSI or something simple. If I'm bullish and I want the indicator to show me bullish, if I play around with the time frame long enough, it's going to give me the answer that I want. In that way, technical analysis can be really deceiving if you don't have the discipline to understand what your time frames are. For us, our tactical time frame is 21 business days or a business month. Our strategic time frame is 63 days or a business quarter. We use the tactical time frame to navigate in and out of the strategic time frame. So here you see we turn back up through the 21-day moving average in the MACD. So this indicator turned back to positive as of Jan the 9th. Just as an aside, if you're looking at the MACD and you want a little bit bigger, a little broader interpretation, above the zero line is generally strategically bullish. You could see we had a little period here right before Thanksgiving where the MACD fell through the zero line, and this was the weakest period through this chart time, which started back in July. So right now the momentum's positive, and note that it's becoming positive off of that zero line. When it became positive off of the zero line here back in October, that was a bottom. When it turned back off the zero line in the latter part and the beginning part of August, they were both bottoms. So just kind of an aside on how you might look at the MACD, there's different ways to look at it. For our purposes in the A6, we look at the 21-day moving average. For your purposes, when you're looking for opportunities to buy into an existing trend, the zero line is a very good tool. Next, relative performance. This is a relative performance of SPY versus junk, which is stocks versus high yield bond prices. JNK measures the price of high yield bonds, and junk bonds tend to trade more like stocks actually than they do like a bond. So when the S&P is outperforming high yield bond prices, the stock market goes higher. As you can see here, up until right around Thanksgiving time. And then since then, it's gotten back above the 21-day moving average and stayed there. This last turned back up on January the 5th. So this is our second of Asbury 6 constituents that has turned back to bullish. These are ETF asset flows. This is the AUM, the asset under management. Now, the way that we look at this is a little different. Rather than using SPY, SPY is to stocks like the 10-year note is to bonds. That is, it's often used as a hedge. So what we do to get a little cleaner signal as to whether it's telling us either bullish or bearish is we use the AUMs, the aggregated AUM in the 9 sectors, in the 11, I should say, sector spiders. And what that's showing us is since right after Thanksgiving, it turned back above the 21-day moving average right up here, and it stayed there. So this is also positive. Volatility. The VIX is at times difficult to read because it's so volatile. It's like looking at a raw volume. Sometimes it looks like a man having a heart attack on the EKG machine. The VXX is it's a futures, it's a derivative of the VIX by using futures. It smooths it out quite a bit. So you can see VXX drop down below the 21-day moving average on November the 25th, has stayed there, which has given us a pretty nice move higher. So according to volatility, we're also positive. Here's volume. Same with volume. Raw volume is really difficult to read. It's very noisy. So we use cumulative volume here. Cumulative volume had a little one-day flip underneath the 21-day moving average on New Year's Eve. But otherwise, it's been above the 21-day moving average, indicating a steady urgency to buy. And that's also positive. And this is market breadth. This is the NYSE Composites AD line, the advanced decline line. A little bit noisy here, but it moved back above the 21-day moving average as of January the 5th. So again, for your own purposes, you can take the indicators that you are most comfortable with and start to blend them, and you get a much more lucid and calm and logical indication of what the condition is of the stock market than trying to determine that from the S&P 500 during a period where the market is more volatile. Turn it back over to Jack for the sort report.
Yeah, so we have our sort report. This is for our Substack offering, asburyresearch.substack.com, and it's a top-down, three-legged stool investing approach. So what we try to provide for our research subscribers is a quick glance at the overall market with this table. So we have emerging markets, we have equities ex-US, we have big tech, we have some bonds, Bitcoin, commodities, oil, the dollar. And this is a quick way for a investor to see, hey, where should I be focusing my attention? There are so many stocks out there, so many ETFs out there, so many different products you can trade, in so many different ways. So this is just kind of a sorting effect to be able to get down to the nitty gritty of where should my money be going. We do so, like I said, with our three core pillars of trend, relative performance, and asset flows. They're actually built in that order. In trend-wise, we want to make sure that the trend of the price of the individual ETF or the sector is up and to the right, in order to try to know that something is making money. Relative performance-wise, we want to make sure that it's outperforming the S&P 500. We're in the true belief that if something is underperforming the market, it's not really a place that we want to be. And then lastly, money flows. So making sure that the assets under management are trending in that upward direction to know that we have some wind at our back, so to speak, in terms of the managers putting money into those assets.
Before we flip the slide, we have a free version of the Substack. So if you like our approach to markets and you want to learn more about it, asburyresearch.substack.com. There's a free version there. What do we do for the free? Once a week?
They get a chart of the week, they get our podcast, and then we occasionally throw in a short report as well.
So just another place for free information.
Next is our sector ETF asset flow model. At a high level, what this is doing is it's tracking the velocity of money from the 11 sector spotters through 3 time periods. For this particular audience, we have a handful of research clients that are more active traders, which I know this audience comprises a little bit more of. And the way they use this table is, to try to figure out not only where to put their money, but where to avoid putting their money. So this is our latest table, traded effective actually today. And it shows that right now we see assets flowing aggressively into healthcare, industrials, and financials. The way this ranking score is, it's kind of like golf. The lower the ranking, the better. The higher the ranking, obviously, the worse. So right now, our worst sector is technology. The idea here is that money is flowing out of technology. So if you are trading, again, more of a top-down approach. If you're trading tech or you're interested in trading tech, right now might be a time to avoid it or to pare down some of your winners that you have accumulated over the last couple of months. If you're looking to buy into healthcare or you're super interested in industrials at the moment, it might be a good time to take a look at some of your ancillary indicators on those particular stocks or ETFs, as we can kind of track money flowing into those over the last 3 time periods, which is the trading week, tactical month, and strategic quarter. Right here is a rainbow chart. It's kind of a proof point for us to show that our ranking score seems to correlate with relative outperformance. Over the summer here, from April 24th through August 17th, XLK rose by 17%, which outperformed the market by almost 9%. What do we have here? Up top is our rainbow chart. So we got favored in green, yellow and neutral, and avoid in red. And this is a daily CEIF score going back a year. As we can see here, the more time we spend in that upper favored territory toward the top of that chart, we tend to get some nice relative outperformance in that particular asset versus the S&P 500. And in times that we're sitting in this avoid, which technology currently is, we tend to have downtrending relative underperformance versus SPY. So is it a 1-to-1 ratio? Every time we're in favored, we're outperforming? No, but we trend in that general direction. And again, for those of you that are trading, knowing that you either have some wind at your back or know you're up against some resistance in your face could really help you understand. By having the CEIF model could really help you understand when to put positions on, when to take them off, things of that nature. Proving out our point, I'm going to go back to our total sector spider, total AUM. We saw that a little bit in the A6. I use this kind of show why asset flows matter. So what we have here is the 11 sector spiders total AUM up at top with a nice simple 21-day moving average, and down below we have the S&P 500 price chart. As you can see here, as we spend time above that 21-day moving average, we tend to have price appreciation in the S&P 500. We had a nice section here from April to end of July, early August, where the market was up 16%, all during that time when it was sitting above that 21-day moving average, meaning assets were flowing into the market. We've obviously crossed down a little bit, been a little bit more sideways here toward the recent times, but again, in general, when we've been above that 21-day moving average, the market seems to have some room to run. Why is that? Because there's assets coming in, there's assets at the back, and at the end of the day, people's money coming into the market buying assets is what's going to push those markets higher. Just in general, how the CEIF model has done as a model, the way it's traded is we rebalance on the weekends and always trade in the top 3 for the scores. So CEIF in general, going back to 2018, has outperformed the market quite well. We have done so through up markets and down markets. 2022 was a bear market, and the CEIF model outperformed by, I think it was 29 or 30%. We do so because a lot of investors have to be invested in the market at all times. So even in bear markets, they got to put their money somewhere, and sometimes that's in cyclical markets. In that case, we picked up energy, did really well in 2022, and we were able to kind of ride an energy trade through most of that. If you go, like I said, going back to June of 2018, outperformed, again, these are hypothetically back tested, but outperformed by roughly 6%. And we've been a little bit more of a market performer as of late, but if you're in the sector rotation space or you're familiar with it, we really haven't had a runaway sector over the last couple of years, not to mention with the market uncharacteristically returning over 20%, I think, for the last 3 years, when I think the historical average is closer to 10. Right now we do a really good job of keeping with those sectors. Out of the last 8 years, the CEIF model has quote unquote predicted the top sector in the US market all 8 times. We've been where the money is going, and we've been where the outperformance is. Statistically, how do we do? We stay a little bit under the in terms of the our maximum drawdown is a little bit less than the S&P 500, doing so with a similar standard deviation, which makes sense. We're trading in S&P 500 equities, so we should have a similar standard deviation for this particular model, but we do so with a nice sharp 1.02 going back historically, meaning that we're keeping our risk relatively low versus the returns that we're able to pick up.
Now let's look at some of the charts that one of the many great things about the Metastock software is I think I've been using it since the 90s. I should get a gold watch, from Mr. Gibby. Been using it for 30 years. I love being able to build my template. So if I want to see a relative performance chart, all I got to do is show the data that I want. I press a button, it pops up, and all of the annotations are there. So we use these over and over and over again, and it's a really useful tool for us. This is just showing kind of where we are in the S&P 500 right now. Back here, well, I don't go back quite far enough. You can actually see it here up on the right on the weekly chart. At the end of June, the S&P 500 made a fresh all-time high, the end of June of last year. That breakout, just simple technical analysis, it pointed to 69.50 as an upside target. We got the 69.20 here on October the 29th. And as is often the case, once you hit a technical target, there's some distribution that goes on in the market, and that's what happened here. But this breakout that we're making, as long as we can stay up above 69.20, the similar but smaller measured move like the one that we had back in June, it suggests we could go to 7,300. But we need to stay up above 69.20 to hold the breakout. Danger zone here near term tactically is below 68.24 to 68.18. That's the Jan 2 low and the 50-day moving average. That would put us into the start of a correction, and that would be confirmed if we have 4 or more red in the Asbury 6. This is just the weekly chart here that shows, should we go into a correction between now and the next time we see you here, 62.44 to 61.47. It's about 10% below the market. That's the major support level that we really need to hold without going into what would look like the beginning of a longer term bear market. So long term, 62.44 to 61.47 is a big deal. This is something I wanted to point out. MAGS, the MAG 7 has been a primary driver of the uptrend that we had last year. Look what's happened here since December the 30th, right there. We're underperforming now. MAGS is underperforming SPY on a 21-day basis, but the point is it's underperforming. It's no longer leading. That means either something else has to come in and pick up the baton to drive us higher, or the uptrend's going to fade. I don't know that something like energy is going to be able to hold the market up by itself. It's usually one of the normal leaders. Semiconductors is one of those normal leaders. Look what's going on in the SOX index. It broke out of this sideways investor indecision pattern that we started to develop at the end of October. Targets have moved to 86. If we get to 86, that's 12 to 13% higher than where we are now. We must hold 73.93 in order for this breakout that we had last week to remain valid and the upside implications to remain valid. This is what I like. This relative performance on a 63-day quarterly basis. This actually goes back to June or July, I believe. A nice strong trend. So again, we lost the MAG 7 temporarily, but we still have the SOX, and the SOX is driving the bus now. So make sure you keep an eye on the SOX. Use our trading ideas. We do this quantitatively also. What we do is look at 3 main criteria. We look at trend, we look at relative performance, and we look at asset flows. We want to see those expanding asset flows. Jack has built a scan that scans 6,600 ETFs every morning, and they come to our desktops. And out of those 6,600, we may have 10 or 12 that are meeting those 3 criteria for us. The next thing I do is look at them individually and look at those that offer the best risk reward characteristics. Ideally, something that just maybe broke out to a brand new high or broke a trend line or might be sitting on a support level, something that we can use to lean on to keep our risk low. And so gold miners is the oldest current one that we have going here. We put the idea out on 11/26. This yellow cell means that we just raised the stop up to 75. We got a 14% outright lead while outperforming the S&P by 12%. Note down here, these are our previous ones. Down here, we put this trade on earlier, ring right down here on 8/6, August 6th. We got out on October the 21st. we captured 31% of outright gain and outperforming the S&P by the same 31%. Here's what that chart looks like, just to give you a sense of what we look at. Trend up. Again, and this is ring. So this is a daily price trend. So we put the trade on right here on November the 26th. This is the current one, obviously. Here's our AUM in ring. We put the trade on when it was expanding above its 21-day moving average. So we have a monthly trend of expansion. And here is ring versus SPY. I don't like to buy anything that is not outperforming the S&P 500. So all three of the criteria we're clicking here. As long as they do, we're going to ride this until it drops, until the wheels fall off. But right now, we've got a nice lead at 22%, amid 17% of relative outperformance. It's actually had a pretty good day today, so we added that in. This is how we see if we're doing any good over time. We want to see if what we're doing is working. We've had 120 trades. It's about 4 trades a month. Percentage of winning trades is 54%. Average winning trade is 5.5%. It encompasses on average about 20 days, just about a business month. Average losing trades are significantly less than half of that, 2.4%, and they only last about 8 days. So what that basically means over the 34-month period that we're showing here is we can, based on the maximum drawdown of only 3.7 here, maximum drawdown on the S&P during this period was 18.9%. What that basically means is we can trade 15 times the size of a buy and hold S&P 500 with the same maximum drawdown, but the average performance is 4.2 times the buy and hold S&P. So this is what we do to calculate if we've got a winning situation here. And again, this is how we pick our ETFs. I'm sure you could do something similar to pick stocks.
Yeah, we're close on time, but the point of this though is, with our systematic trading, with our series of models, what we did is we combined them together in various increments to create different risk profiles. So we have our Asbury Aggressive, which uses our CPM Ultra with a little bit of leverage, and that's going to try to outperform the market while still keeping our relative risk numbers low, all the way through our ultra conservative model, which again, historically back tested, has had a drawdown of less than 10% going back the last 8 years, which includes COVID and the April lows of last year. So that's all to say that once you start to build these, kind of a ground up approach, you come up with your indicators that you like, you start to put some systematic trading rules around them. You can then blend your own models to come up with, risk profiles that you're looking for. And again, this makes things just a little bit easier in the sense that you also get some model diversification. We found that, the parts the sum are greater than the parts when it comes to putting some of these systematic trading models together. And then just in general, this is how we've done. Our ultra conservative model, like I said, is down here. It has outperformed. AOR is the equivalent of the 60-40 bond stock bond portfolio. So not only are we able to kind of outperform using our models to outperform a traditional 60-40, but we tend to do so with better risk-adjusted returns and defensive statistics.
So just a little about us. We have a premium research product that we launched the business on in 2005. 3 and 12-month online premium subscriptions. The 3-month is $499 for 3 months. The annual is $17.99. Again, Substack. AsburyResearch.substack.com. We've got a free subscription there. If you like our approach to markets, that's just a way to see more. We have a YouTube channel with a lot of videos on there. Twice a month we have a podcast. Thank you, that we do. We just did one yesterday. And then we manage money using our own tools. I use all of these for all of my own money with all of the equity exposure that I have. It's all based on our models. We have a 250K minimum investment. 1% annual management fee up to $1 million. Our custodian is Charles Schwab. And here's our disclaimer to make the lawyers happy. And again, if you want a copy of the PDF, I know we kind of whipped through this and we're about out of time. I would be more than happy to send that to you. Here's how you get a hold of us. And Jeff, I'm going to pass it back to you. I don't know if you have time for questions or if there are any questions.
We do have one. We have a question on, do you guys trade Tesla?
Tesla?
Tesla, yeah.
We don't buy individual stocks. We've been watching Tesla gyrate up and down with the latest tweet. Yeah, so the way that we would tend, we do pick individual stocks out for some hedge funds we work with, but we generally stay in the ETF realm. So the answer is Tesla sometimes is part of an ETF that we're invested in, but we aren't avid traders specifically of Tesla.
All right. Let's see. Stephen would like to know what the return on an aggressive account with a 250K minimum would be, like last year.
Return.
The average on Asbury aggressive, what is it, outperforms by 4 or 5% annually?
Yeah, we tend to outperform the S&P on average, outperform the S&P 500 by 4 or 5%. You know, we do so also with that drawdown number being 22% versus
34.
34%. So roughly on average 4 to 5% outsized returns. Again, hypothetically back tested is, you know, and for the lawyers, previous returns do not equate to future returns in any way, shape, or form, but on average, that's what we've done.
All right, those are the 2 questions. Great job, guys.
Thanks, Jeff. Thanks for having us. Happy New Year, everybody. We'll see you next time.
All right, very cool. Let me go ahead and do this. I'll make myself the presenter. Go ahead and show my screen. And here, turn on the camera for a second anyway. I do want to say thanks to John and Jack. They always come in and actually kind of talk a little bit about a different angle of things. I do want to remind you all of the offers that we're doing here at the event can be obtained if you go to metastock.com/saleschat. You can give us a call, 800-882-3040. We have a number of presenters. Greg is the next one. They have really, really cool products that have been designed for Metastock. They have a money-back guarantee. You can try them without risk. But we put together an extra special package that we call the Trader's Action Package. And you can get that at a very basement level price. So you can get Jeffrey Scott's brand new market MRI. You get Greg Capra. He's going to come in and talk about his math patterns setups that he set up. You can get the JBXC complete. Jake talked just before the last session about that. You can get a trendline course from Oscar Carboni that we put together in 3 months of Learn Metastock. The retail cost on all of those would be $6,386. As I said, they all have a money-back guarantee on them. If you want to just get a package deal that includes everything at a rock bottom price, it's only $2,788. And you can do that. But you have to call in. It's 800-882-3040. You don't have to call in. You can also chat metastock.com/saleschat. I'm going to go ahead and put those in the chat right now. I want to also, put those in the YouTube chat as well. Okay. Oh, it's too. Oh, okay. Hold on. The Brownie says, Greg Capra is so excited. He's my mentor. The man is insane. He's excited. So without one further ado, I do want to say thanks to Stocks and Commodities Magazine for sponsoring the event that we're doing. They've been so supportive of all of the Metastock conferences and events and summits that we've done over the years. If you're not familiar with Stocks and Commodities Magazine, they've been publishing since 1982. They've done 17,000 plus articles over the years. And if you're a subscriber, you actually get access to all of those articles in a nice searchable indexed database that you can look through. You can get a free issue. If you haven't registered yet, you can go to metastock.com/traders-summit. If you're on YouTube, you might want to do this. You can, not only can you get a free copy of the magazine, you can also sign up for a whole bunch of other trainings and stuff that's put together and available for the presenters. So I'd encourage you to do that. And without further ado, the Brownie 1214, let's go ahead. Stephen, you're welcome. Always happy to answer questions. Thanks for your question. Greg's a good friend of mine. He's been a friend of mine for a number of years. I remember some time ago, we were at the Gateway, so it's been some time. We sat down with Greg and we kind of developed patterns. We've just we've polished them up and kind of updated them and made them look really good. But the thing that really kind of was surprising to me is like, he's been trading with the same methodologies that have been working with him for decades. And he's going to talk to you about them right now. Greg, let's go ahead and get you started. How are you doing today?
Good, Jeff. How are you doing?
I'm
See if I
good.
can get my camera working. I don't know if it's on. Looks like it's pointing up in the air.
See your curtains and
Oh, it's on the wrong camera. Hold on.
I can
I
walk
got
you
a couple of cameras there. Webcam. Hold on. Webcams. Sharing.
There we go.
I'm trying to find the webcam to where to use. There we go. All right. So get that a little better arrangement. So since you started the introduction with Metastock and our relationship for the last, I guess it's about 30 years or so, and I've been trading the same method, teaching that method for the last 30 years, since about, 1994 started. And yeah, I don't know if am I showing my screen yet?
I don't see your screen, and also I don't see your camera either. But now I see your screen. So, no, yeah, I see your screen now. I see a big, I just see your icons. I don't see anything actually loaded, but I do see it.
Okay.
Okay, now I see exactly the screen that I think you want me to see. The art of multiple time frames.
Yes. So again, the webcam.
There we go.
Okay.
Perfect.
All right, cool. All right, we're all set there.
Great, I can see it. I
So
can hear.
the Metastock add-on, and I'm going to get into what a bunch of that is about, but it is you could use it for market timing because it's trend analysis, which the majority of market timing is, of course. But you can apply that trend analysis to the S&P, the NASDAQ 100, any ETF, or your favorite stock, and it'll give you buy and sell signals. And it's relatively simple. Some bunch of code there. Nonetheless, it works. I've been doing this thing since 1994. There's been some tweaks along the way, but relatively minor. And, besides having a product that'll tell you what to do, I like to teach traders and investors and even day traders how to think and how to do it yourself. The Metastock product can help as a add-on to that, of course. And, how will you call it? It's not a black box, but it will tell you if you're on the right side of things or not, or whether you should be rethinking what you're thinking, right? But I'm a price pattern trader using multiple time frames, a trend analysis. I'm going to tell you all about that in great detail. So a little bit about myself. As I said, I started out back in the mid to later 80s. I didn't know a damn thing. Dangerous. There wasn't any education. There wasn't any internet. Basically, it was phone lines and modems and 286 computers, kind of the dark ages as from where we are today. The truth. And as this continues with the AI evolution, which we're just beginning in, is just amazing where all of this is going and what we can do with this technology and education. But I said, it started out was a fax service. We used to send out that thermal paper, had fax machines going all night, we had 800 hotlines. The first chat room on the ever that was available for active traders. And so I did lots of seminars, used to do them online. Today, I mean, that's really the old way of doing it and not very good. And I'll tell you why it's not that good. Because once you get inundated with that education, that information, which is all good, you need reinforcement. It's like anything else. You get education and you need reinforcement, then you need experience and you need to do it. So with a recorded course, you can watch it 24/7, half hour, 5 hours, 10 hours, as much as you want. And that's what's great about it. Master Trader used to be a brokerage firm, was one of the first, if not the first, online brokerage firms for retail traders. I had an old company. It was called Pristine. I sold it. The old adage, an offer you can't refuse. You want it so bad, here it is. There's a lot of old recordings, which I refined since then. I used to do trading challenges, used to go to the trade shows, and I educated lots of people over the years, hedge fund managers, specialists. And when I met these hedge fund managers and specialists from the New York Stock Exchange, I thought I was in the presence of gods. And what I found out was they didn't know very much. They had order flow, and their basic understanding of technical analysis was pretty rudimentary. And of course, why they contacted me. And today, primarily, it's people like yourselves that just want to learn how to do it yourself. And so that's what I'm here to show you. And again, it says retail traders, prop traders, and so on. And I got a lot of students that are out there in the industry that are teaching what they learned from me back in the 90s. You can check them out. You can go to my website and check it out. This is me, right? Over 25 years ago, 1994, at the first Day Traders Expo. And the theme was Training, Trading, and Technology, or T3. That's me in the middle. That's the booth at the time. And you can see that's the old company. Master Trader was the brokerage firm. And I kept the domain. I wouldn't sell that. And reinvented what I do and made it better and better. So this is the essence of my approach. I mean, you break this all down and it creates a thought process. And within that, I say price is king because everything else is secondary. It's irrelevant. And I'm not an indicator person. I started out that way, I think, as many people do, the indicator-based methodology. And there's a lot of them out there, and you can change lots of settings. And for me, it just didn't work. For others, it does. But I just couldn't get a grasp for it because there was just too many variables and differences. And as you changed from whether you're trading, S&P 500 futures or IBM or a gold stock, those settings didn't really necessarily work when you changed instruments. So that was confusing. But what doesn't change is the patterns and the basics of supply and demand and support and resistance and trends. It doesn't change. It doesn't matter what you're trading. So price is king. Look at it in a candlestick formation. Why? It creates pictures, and you're going to hear me say that a bunch of times. As much as we might want to make this more fancy, what we do as technical analysis, we look at pictures. We look at pictures that represent to us the past, the present, and depending on how we interpret it, predict the future to a certain extent. And bar by bar analysis, what this is about, what I'm going to show you. And I'll tell you, this has turned out to be something pretty amazing in how it could guide to you. But it didn't start out that way. How did I come up with this idea of bar by bar analysis? Well, once I defined how to get into a trade, those emotions of fear and greed kicked in. And you can't get away from it, but you need a way of systematically and objectively, I can't even say you can control it, you can't. But you can keep it in check, you can monitor it, you can have a method of changing what's happening, your bias as to what's happening. And so the idea was to look at individual those candles in context of what was happening. So if you're especially an intraday trader and you're riding a trend and you see a red bar, it's like, oh, it's going to go down. Well, maybe, but put it in the context of what preceded it. What's the probability of it going down if you have an uptrend in multiple time frames? It diminishes tremendously. And that brings in the trend analysis and the multiple time frames. How many time frames? Another trap is looking at too many time frames. So we have to pick what time frames we're going to be looking at. Support, resistance, relative strength and weakness. What is outperforming and what's underperforming? The theory is what's outperforming will continue to outperform. That's true. But at some point, money rotates into underperformers, and you need a way of determining that rotation, that you're not too early. Because, you think about someone who's into fundamentals and they say, oh, that's undervalued. Well, a lot of things can become undervalued and then become more undervalued. And they go down and down and down for whatever reason. And as technicians and even as fundamentalists, you might say that doesn't make sense. But if you want to fight the trend, that's theoretically not a very smart thing to do because you're going to be losing money. Volume, secondary, I don't make a big deal about it. I look at the broader markets because most stocks will gravitate to what's happening in the direction of the broader markets, either up or down. Market internals and intermarket analysis. I have a few market internals, breadth and sentiment. I've looked at many different market internals over the years and narrowed it down to two simple ones that I use to determine what's the probability. And even where the markets are today, and if they look like they're going to continue to go higher, especially they gapped down this morning on all of this news, Trump's going to ask for tariffs to be, not tariffs, besides the tariffs situation and the oil situation, and now forcing credit card companies to lower their fees to 10% versus 20%. I don't know if he can actually do that, but all of these different news items that are coming out, and pre-market, I spoke about that and I said, you know what, this is just noise. And while you have to take it seriously to a certain extent, you got to put it in the context of all of this that I'm showing you. And until the trend breaks, it's noise. And today, everything got bought. Well, not everything, but most things got bought. And they're up near the high of the day and up near Friday's high, where things on Friday made new all-time highs. The transports, the S&Ps, the Dow, semiconductors, and a few others. Now, position and money management, you might find this really interesting. This is what investors and traders are least interested in. And I've been doing this 30 plus years. And have courses, and I have an extensive course on position and money management. What do they buy the most? Not that one. Not until they start losing money. And then it's like, oh, it just makes no sense. You wouldn't run a business without a position in money management. And that's all tied into trader psychology. Right? And if you don't think that's the truth, go buy 1,000 shares of whatever it is that's over your limit, and you will see how the psychology starts to kick in. So these are all concepts. One concept is not a strategy. We got to put this together, and I'm going to do that for you. So here's my way of looking at technical analysis. I said it's not about indicators. It's about price patterns. Why? Because price patterns are a representation of what institutions and what traders believe, and it's a representation of how they're acting on those beliefs, and they're using their money on it. So it's very valid information. Now, the interesting thing is, over time, as long as I've been doing this, these institutions have started acting more like day traders and hedge funds. They're quite active, and they'll, as you know, willing to buy the dip as long as the trend is in their favor and the Fed is in their favor. But sometimes these corrections are pretty sharp, and at times breakouts tend to fail, not tend, but they fail, and they right away they're dumping, and they're much more aggressive, to get in and get out than they used to be, especially in the current environment where news is driving the markets. So these candles, they provide us pictures of those expectations, and they do it on a continuous basis. So they tell us what others are thinking. You think, well, that sounds kind of amazing, which it is. But you got to put it together. As I said, one concept is not a strategy. One candlestick is not a strategy to act on, but we're going to put that together. And I like to call it candle language. You're going to see what I mean. Now, we have to understand multiple time frames. It's about aligning pictures of the time frames you want to use. You get to choose what they are. Now, if you look at too many, you're going to get confused. And candlestick patterns or pictures and candles, when you start looking at them that way, without being in the context of multiple time frames, you're going to be a tendency to be all over the place. So you got to control your thoughts, and we got to do that in a constructive way. Okay? And you got to pick those time frames. And as it says here, if you want to hold for weeks, you're a swing trader or an investor, don't look at 5-minute charts. You've probably done that. Most of us have, and you've given up good positions because of a 5-minute trend break. It's just a losing thing to do. And if you're a day trader, why look at a monthly chart? It's irrelevant. You can look at a daily chart. We do that. We start with the daily chart and we see, is it on support or resistance, and what's the trend, and look for turning points. And then we can go and day trade those patterns and trends in smaller time frames, doing it objectively and intelligently. So now we have to gain a bias. And are you a swing trader or a day trader? You got to keep those two points of view separated from each other for a great extent. As I said, there's no advantages looking at 5-minute charts and 15-minute charts if you're a swing trader. You might look at it and think there's greater detail there and you're going to get in at a better price. Money management will take care of the better price, because you're going to share size it accordingly. Big money management person, because psychology and your success is tied to the money, or you're after the money, but you got to have the money management lined up. So what's your focus? What's the direction? Is it up, down, or sideways? You got to determine that in a relatively easy way. Where's support? Where's resistance? And now we begin to create a bias. With that bias, we can go down to the smaller time frame. Simple stuff. And what this slide is showing you is this, the lighter blue line that's just trending up. Obviously, it's in an uptrend. Sometimes it's in a downtrend, or if it was whipping up and down, it could be in a sideways trend, but you're going to determine that. And so we're not all that interested. We're going to look at the price patterns on the higher time frame, but we're primarily interested in the direction and having that direction aligned with the micro time frame. 2 time frames in alignment with each other, the greater probability that it's going to continue. So your job and my job is to get in at the appropriate time where the reward to risk makes sense. So as a swing trader, we're going to use the weekly and daily time frame. Now, as a day trader, you've got choices. Now, my choice, well, I look at the daily because I want to see, is it in an uptrend? Is it pulling back to support? And I'll look at the 65-minute chart, especially for bottoming patterns. If something is bottoming, I like to use the word that they tend to be treacherous, because when something is bottoming, by definition, it's coming out of a downtrend. And there's a lot of people that are holding losers. So bottoming patterns, which look attractive because they're oversold, you want to call it that, or undervalued, and they start to be accumulated, that's why they're bottoming. They pop back up, they look great, they look like they're going to go much higher, and they get knocked right back down again. So as a day trader, I like to use the 65-minute chart to see something that has been basing out for a while in alignment with that bias, and it's got room to go up. And once I have that bias, I can then go down. My primary is going to be the 5-minute chart, but at times I'm going to look at the 15-minute chart. Again, as a day trader, if there's momentum, and as I said, these institutions and these algos are really aggressive. At times, I will go down to a 2-minute chart. And if you're a swing trader, don't even go there. Don't even think about it. As it says, it requires a lot of focus. So that's not your playground, so to speak. So now let's simplify candlesticks. I'm not going to tell you about dark cloud covers and piercing patterns and morning stars and all of that. For me, that's all irrelevant. And this is the power of bar by bar analysis. I don't care what the pattern is. We can have names for patterns because we can communicate that way. But when you look at it from this point of view, is this a big bar? Is it a little bar? Is it a bottoming tail? Is it a topping tail? What's a big bar? And you probably will give me a measurement. It's just big. You look at it and it jumps out at you, and it's a big candle compared to the ones that preceded it. So if you're looking at a penny stock, a dollar bar could be big. If you're looking at Google, it could be a $10 or $15 bar, but you recognize it as a wide range bar. Now, topping tail bars, it went up and it came back down again. It got rejected. But again, where did it happen? What's the trend? We have to put it in the context of the trend, support, and resistance. Big red bars, well, obviously it went up, and then it went back down again, right? So today, prices could have gapped down and kept going, could have been a big red bar down, but now it's turned into a green bar back up. So the gap down got bought. At times, prices will sell off, and then they come right back up again and form a bottoming tail bar. And that tells us that demand increased and it pushed it all the way back up again. And buyers stepped in, and that's valid information. But while it happened on that individual bar in the time frame that you were looking at, what was the location and what was the trend? So we can see, as I said, momentum increasing, whether it slows down and whether it's reversing. So we don't need names. All we need is put those candles together in a formation. So the arrangement of candles is endless. And that's not what we want. We want to find patterns that we can recognize, but we also have to accept that there's an endless arrangement of candle patterns. So while we can call something a morning star or all the other names that are available, and all of those names, when you give something names, it creates beliefs about the future. Sometimes it's true and sometimes it's not. But as you look at it from the point of view of bar by bar analysis, the way I'm going to explain it to you, who cares what the name is? So as we look at these, and what do these bars communicate to? These arrangement of a few bars here. The one lower right has 3 bars. The one in the middle there has 4, 5, 6 bars. Look at all of those candles. Do they communicate to you that maybe buyers are stepping up and in control at the moment? I think that they should. Let me see this, this drawing tool here. Look at this. All right, look at what happened here. It was going sideways and it gapped down. One of the most powerful things that I learned or taught myself was failure patterns. Why? Did Greg sell the gap down under the base only to see prices go right back up again? Did Greg sell the low of the bottoming tail bar or this reversal or down here? And as I recognized all of those patterns, I discovered for myself what was happening. The forces of supply and demand were in action. And who that is, who cares? Right? This went down and it gapped up and it closed near the high. This one is, we give it a name, we call it a 1, 2, 3, one up bar, wide range bar, an inside bar, and then it triggers above the highs. 1, 2, 3. Well, what if we took this candle and we dragged it over here and then it triggered? We'd call it a 1, 2, 3, 4. But even if I purposely didn't put names on here, because I want you to think about this from the point of view of just looking at these candles and what they communicate. This opened lower and it went up. It rested. It opened lower and it went up. This was down and it went up. This was pulling back. It went down and it came up. All of these pictures communicate to you that buyers were in control. At a moment in time, they lost control and then regained it. And that's the power of what we're looking at here. And to put that in the context of those trends, I just explained to you what they all suggest. Now, as new candles form, they form groups. They're grouping. Candle grouping reveals the power of multiple confirmations. Gap up and it went down. Buyer stepped up again. Well, if it gapped up and went down, somebody bought that gap up and they might want their money back. That's a thought. It's not a fact. When it comes up to that area, I will assume that there's going to be sellers there. Now, if this bar closes at the high of the bar, whoever was selling, there were buyers there that took their shares and they didn't knock it down. But if it becomes a topping tail bar, and I've given it a name, a topping tail bar, because it was rejected up there, sellers took control. Well, if it happens again, is that becoming extremely convincing that sellers keep coming in at the same spot? Now, if you want to give that a name, go right ahead. Go right ahead. But if you apply this bar by bar analysis concept, you know what's going on. You can call it a flying cloud, dark cloud, or who knows, call it whatever you want. Down here, it gapped down, it went up. It went down, it came back up again. It went down and it came back up again. It's plain and it's simple. It's not proprietary and it's there for anybody to see. All you got to do is look. And now we have to put it in the context of multiple time frames. It says multiple candles showing buyers or sellers control at the same levels of strong signal. Yeah, right? You don't have to be a genius to figure that out. You just have to look at things in a relatively simple way. And it just accept that whatever you're looking at, whatever you're thinking, whatever the news is, there are more institutions and more traders, and they're acting as a group. Some are buying and some are selling, but what are the majority doing? And the more we can see what the majorities are doing over a period of time in the context of support and resistance zones, the greater the odds are in our favor. And the simplicity of this is the power of it. Simple. So, what do the pictures communicate about buyers and sellers? The top one, sellers are taking control. The bottom one, buyers are taking control. And that leads you to thinking that things, the trend, the price action is getting to a point of action. That's what we're after here. Not just looking at charts. We're looking at a point where the probabilities are in our favor, where we're going to take action. That's what we're after. Now, multiple time frames to understand what's happening here. We have to put this in the context of what you're interested in. We don't have to look at all these time frames, but you need to understand what's happening here. Now, on the outer edges, I'm showing you a big red candle and a big green candle. Now, depending on how we break up the data, expand the data, because that's what you're doing when you're looking at lower time frames. You're expanding data. You're taking something that's a chunk and you're breaking it up into little pieces. That could be a weekly, monthly chart, a weekly chart, or a daily chart. It could be a 65-minute chart. It could be a 5-minute chart or a 2-minute chart. How much do you want to expand that data, or how much do you want to contract that data? I've given you time frames that I use, whether it's day trading or swing trading. Again, they're choices. The thing is to understand what's happening. So as prices pull back, momentum eventually slows down. So this big red candle could turn into a big green candle. And what you're looking at is a red candle and a green candle next to each other. But something went on in between that gap. The thing is, do you want to look inside there? There's a danger to looking inside and what the danger is, the more you look at, the more it can become confusing. Whereas if you look at the candles, the ones you choose to look at in the context of the trend, support, and resistance, the easier it's going to be for you to make a decision. Now, you might say, well, what if it goes back down to the red candle, Greg, and it goes under it? Well, you got a stop loss, and you're going to share size it according to that. And because sometimes timeframes are not in alignment with each other, there's going to be jiggles and noise. So as a swing trader, the lower intraday timeframes may not be in alignment with that. But eventually they'll come into alignment, and as they do, multiple timeframes or a look at what others are doing in those timeframes, meaning, is it a weekly chart and a monthly chart where you have investors looking at that and they're taking action? Now, as you go down to the daily chart, swing traders start to see patterns and start to take action. And that, as we look into smaller timeframes like down here, you can have day traders that now start to take action. And now the more timeframes that are in alignment, which is ideal, the more we're all working together with the same bias, and prices start to move either up or down. That's the goal with multiple timeframes. But we have to make that decision as to which ones we're going to look at. And if you try and look at too many of them, it's going to work against you. And I did that to myself many years ago because I didn't understand these candlestick patterns and bar by bar analysis the way I do today. And so I would, especially intraday, I'd be looking at an hourly chart, a 15-minute chart, a 5-minute chart, an 8-minute chart, and I'd be looking for that bottoming tail bar. And it's like, this is insane. Analysis paralysis. And so again, choices, less is more. Heikin-Ashi is a type of way of formulating the data. The theory is to remove some of the noise. It's a valid thing, but you know what? I want to see the noise. I do in the time frames that I'm viewing. So these patterns that we see, these bottoming tail bars, these rejections, you may not see. Probably won't see them in a Heikin-Ashi thing. So you're missing that. But if you choose to look at that, you need to have the discipline to follow it, because it's a way of taking the data and trying to formulate it within a trend. So I can look at the trend. Is it making higher highs and higher lows, or lower highs and lower lows? If the candles are overlapping each other, like it has been, Friday and today and some of the other days, that's noise. But what's the bigger picture? And we're going to take a look at that. There's so many ways of looking at the raw data, and every one of them sounds good. And then what you find is that you start looking at so many things that eventually you start to whittle things down. And it's like, you know what, I don't need that. You might think, oh, I've got a fib level with an Ichikumi cloud with a MACD crossover, and eventually you say, you know what, it's just overkill. So let's continue to simplify what we do here. Right? So what we're looking for, again, reinforcing beliefs and expectations created with money. What we're looking for are these reference points. Are they pivots? What's a pivot? We have to define things. And I define it as just 3 bars adjacent to both sides of a bar. Why 3? Because I've looked at 2, I've looked at 1, I've looked at 1 on one side, 2 on one side, 3 and 4 on the other. Keep it simple, stupid. All right? It went up and it got rejected. And it went down 3 more bars. Software puts a dot on there. Most platforms will do that. Just set whatever they call it to 3. It went down, bottoming tail bar. It went down, it popped back up 3 bars later, puts a dot there. It's created support. It's created resistance. We're not even talking about entry points yet. All I'm referring you to here is that it went down here, and when it comes up there, I assume there's going to be sellers. Now, with that assumption, what happens there? Look at this big green candle that got bought on a gap down. Buyers stepped up in a big way, and it goes all the way back down and then breaks the low. Get the hell out of town. What crazy happens, and you have to protect yourself from crazy, and that's your money management and your stop loss. Now, that doesn't happen every day, thank goodness. But as it goes all the way back down, as it comes down here, I believe that buyers are going to show up there again. Now, what does that look like? Does it look like a couple of bottoming tail bars? Or does it look like an explosive wide range bar? Doesn't that look like a wide range bar? So you might be thinking, that other slide, I said, you'll recognize a wide range bar when you see it. That's a wide range bar compared to those other ones. Now, we're not even talking volume because we're trying to get to other, the essence here. But if there was volume and you saw a volume spike on that bar, that would suggest institutional commitment to that. And that would support a bias that it's going to go up. Now, how would you make money from that? You could just buy it with a stop under the low. You could do credit spreads. You could sell a put spread if there's premium. That's a whole nother conversation. But the idea is it's going to go up based on the power of that bar. Now, it could have formed one of those other patterns that I showed you, where when an inside bar or a bottoming tail bar by bar analysis will tell you what to do and what's happening. Now, when it gets up here, we know there's going to be sellers. That's why I put a question mark here. What's going to happen next? What would you want to see happen there? That's what I think. When I see this pattern and I see the power of this movement up, it's at resistance. The eyeballs there, it's at resistance. I know there's going to be sellers there. Now I'm looking for an action pattern. I'm looking for an action bar at this point. What would you like to see? There's not a definitive one right answer here. So I'll cut to the chase. It could be a bottoming tail bar, right? Where it dipped down and it came back up again. I could take this bar here and drag it over here where it gapped down and it came back up again. And what that would communicate to me is that buyers were lurking down here, even though it gapped down, they didn't care. And they drove it all the way back up again. And your wide range bar scan would find that. Or you could be watching it and that would tell you to buy it above the highs and look for it to go up. Go up to where? You look to the left and see where's the next stopping point and share size it accordingly. I hope this is starting to sink in because it's not. It's a lot to think about initially, but eventually it just becomes second nature. Believe me, it's just the way your brain begins to work. So let's do a little review. What is technical analysis? It's the picture of others' beliefs and expectations created with money. That's what we're after. Looking at pictures of what other people believe and what are they doing and what are their expectations. So we determine a bias based on the trend, support, resistance, macro and micro timeframes. I look to the left. Prior turning points. Those turning points signal an area, in quotes, area. It's not an exact point. Too many traders, people into technical analysis, are too bent on precision. Markets don't work that way. You can get close. You can get the area. Eventually, you're not going to have everything lined up perfectly. Money management will take care of it. When you share size things accordingly, and you know you're not going to lose all your money, it frees you. Believe me. That's why most people can't do this, because they can't get their head around the money management part, which sounds crazy, but it's true. Master Trader bar by bar analysis is going to tell you how others are acting and determine when you should act or not. Right? We're looking for that action bar. All right. So let's look at a few examples here. So based on bar by bar analysis, what's your bias on this chart? What do you think it's going to do? You can think about what's the trend, what do the current candles communicate, I know it's difficult to type. You're sitting there soaking this all in. And then I'm asking you to type. And it's like, this Capra guy's crazy. He wants me to type while I'm listening to this. But think about it. Right? This was a strong move up. It's pulling back. We look for pivots or areas of congestion. This is a small area of congestion. Once it gets down there, my belief is, which is an assumption, that buyers are going to be interested. Now I need to apply the candles. Now, here's a wide range bar, right back up again. You don't really care for the way this came down. It's pretty aggressive selling. Now, if you're interested what that little E is, that means that it reported earnings on that day. How it gapped up and came back in again. And they could have been good, but anyway, it went down. So now here's an up bar, an inside bar, and it trades above the highs. Let's assume we bought it above the highs because it's in an area of support in the way it came down. Well, we're going to share size it down here because once this pivots 3 bars, now it's created a new support area. And if it goes down there, I believe buyers are going to go down there. Now, as a day trader, you could be looking down there looking to buy with one of those patterns that I showed you multiple time frames. But we're focused on this time frame. So this bar here, let's call it a range expansion bottoming tail bar or a correction bar. It traded under those lows and it came back up. That tells me that buyers are lurking below. I didn't need any indicators to determine that. I didn't need any Fibonacci's. I didn't need any VWAPs. All they needed to do was look at that candle and it told me that buyers stepped up. Now the question is, can it go back up again? That's really the unknown. But if you press the button, if it trades above these highs and share size it down here, the odds are in your favor. That's what actually happened. And so now as it starts moving up, we can start trail stopping. We could sell part of the position. Now, the position and money management part kicks in where we have to make some decisions there. But without any indicators, and I could have put a moving average on here to maybe even been more convincing, meaning what if this pulled back to a rising 50-day moving average, which I know institutions look at? That could give me a greater level of confidence. Didn't need it, but it would tell me that that could be one of the reasons why they stepped up there in addition to coming down to that support level. Okay, let's look at another example. What's happening here? Well, whatever this stock was, I don't remember what it is, it was going sideways. It pivoted, it went up, it came down, it went up to the resistance, it pulled back again. None of these pullbacks are violent. They're more controlled. So when I see controlled pullbacks, that tells me that while sellers are taking control, buyers aren't just saying, I need to get the heck out of this thing like they did here. Well, why did they do that? Because they reported earnings there and reported earnings there. Something must have been happening. Sometimes prices just move too far too fast and people take their money, especially if something's been bottoming for a while. And it collapsed. There's the next earnings report, by the way, in an area of these pivots. And buyers begin to step up. I'm not so interested over here because that came down like the proverbial rock off the roof. Right? But once it pivots, I now have a valid reference point where buyers are going to show up again. I believe that. It's not a fact until I actually see the candles beginning to form. So on this retest pattern, my bias is this has the potential to move back up again. How are you going to make money from that? If you're a credit spread trader, I know at a $10 stock, there probably wouldn't be enough premium to do a credit spread sometimes. It can happen. You could do a debit spread, right? Where you could buy and sell a call. Your bias is going to go up, or you can just buy the stock. I believe it's going to go up. And you then wait to see what's going to happen. Now, as we look at different charts and we look to cherry pick the ones that have the greatest odds, we'd say, well, this one is in a transition. this similar picture of a retest and reversal with a bottoming tail would have a greater probability in an uptrend, granted, but this is a tradable pattern as well. So you got choices. Nothing wrong with this. It's just, I know there's some resistance here, but because of the way it came down and turning back up, I believe it could get through that resistance area. And so again, these patterns, they tell us what others are believe and what they're doing, but it also creates our own beliefs. And what I would say to you, depending on what you're looking at on your charts, MACD, Ichikumi Cloud, Fibonacci's, whatever it might be, what are you creating your belief with? Are you using things that are derivatives of price, or do you just want to use the price itself? I prefer to just use the price. All right, so here's the same chart that we looked at before. Right? And we're looking for, right, highs, lows. Is it time to act or not? And we already explained that. Now, here's this chart. Again, what's happening here? And this is what was happening, that other chart, this is what was happening on a higher time frame. So as prices pull back into this area, right, it pulls back here. And I look to the left, it's like, there's nothing there. Well, this was something that really threw me for a loop years ago. And what we need to do, of course, is create a trading plan. And a trading plan is a blueprint of how you're going to create your beliefs. Now, if I believe that there are buyers in a prior low area, I believe there's buyers down here. And the time frame I'm looking at, and I see prices coming down, and there's no congestion and no pivots. Well, how do you deal with that? Well, if it creates a pivot, how does it do that? 3 bars to the right is now created an area of support. And now it'll either retest that or it's going to continue to go higher. How do I determine if it's going to continue to go higher? Bar by bar analysis. Wide range bar up, red bar. So when the red bar formed, I'm thinking it's going to come down there and test that low. And that's where buyers are going to show up. And if it forms some kind of reversal bar, I'm going to want to buy that. Well, sometimes it can create support. And if buyers are aggressive, it's not going to go down there. So how does it communicate to me buyers are aggressive? Well, look at this bar. It took out the low of the red bar. In some smaller time frame, which we're not going to look at, when this went up, it got sold into and it fell. So let's assume this is a daily chart and it fell all the way back down. Pick your time frame of choice, right? One big, ugly, nasty red bar on a 90-minute chart, or a couple of 6-hourly bars, or a 5-minute bar that was in a terrible downtrend all day long. Well, the next day, buyers stepped up and they drove it all the way back up again. At that point, I'm thinking buy it above the high. If not, bottoming tail bar. I'm saying you could buy it above the high. You're going to share size it down here. But the bottoming tail bar communicates to me that buyer showed up again. It went down and buyer showed up again. So trading within this time frame, there will be times where we're going to sit through these bars that are going up and going down. Noise, just like today was noise on the broader markets compared to what happened on Friday and what happened on the preceding days as we came into the new year, where prices went up. This morning, the news was, let's call it a diversion. Was it on purpose? Who the heck knows? And anyway, pre-market, I explained, because we do a pre-market review every day. I said, you know what? I don't know what's going to happen today. I'm not a guru with a crystal ball that's going to tell you what's going to happen tomorrow or next week. What I do know is if what preceded that gap down, if buyers are willing to step up again, that's just noise. And that's exactly what happened. They stepped up again and pushed it back up to the high of the day. That's what should happen. It could have gapped down and kept going down, and that would have communicated something different. So every bar communicates something to you about that day, if it's a daily chart, or on any other time frame, and your job is to put that into context of the time frames that you're looking at. So assuming that the markets are still near the high of the day, we're getting toward the close, should go up tomorrow. Now, it's an options expiration, there's core inflation tomorrow, that might be all noise again. All right, so we're looking at another example here. And the same thing that we go through as prices were coming down, what's happening, where's support and resistance, you look for the pivots, strong move up into resistance, pull back higher low. Okay, red bar. And look how it breaks the lows and flips right back up again, followed by a bottoming tail bar. That's a buy right there. Why? Because it looked like it was coming down here. And someone else with a different opinion said, you know what? That's down far enough. And those that are sitting there on the bid, if you're looking at a level 2, I'm not a level 2 guy. If you're looking at that, some of them decided, hey, I'm not going to get filled. I better take the offer. And they drove it back up. And on the next day, when it went down, it went back up again. Bar by bar analysis is telling you what others are doing. And that communicates it should go up. How do you know it's going to go up, Greg? I believe it'll go up. That's not a fact. Well, what if it doesn't work? Well, I'm going to put a stop loss. I'm going to share size it down here. I'm going to lose a little bit of money. That's trading. Bottoming tail bar, red bar, rejection bar. It should go up. And you wash, repeat, wash, repeat. This is getting a little messy. So I put the star here. This is what I call a correction bar. And when correction bars tell us that buyers continue to buy the dip, and they keep buying the dip for one reason, because they think it's going to go higher. Higher to where? Well, there's an unfilled gap. There's a pivot over here. That's why you're looking to the left. Just going to continue to do the same things over and over and over again. So as I said, we do a pre-market review every day at 9 o'clock. You can go to YouTube, we're on Facebook, we're on X. That's getting streamed, or you could be in the green room with us, live trading room. But every day at 9 o'clock, this is the YouTube channel /C/Master Trader. And you could watch that pre-market review where I'll be talking about, the futures, zero DTE credit spreads, different strikes, our open positions, things that we're interested in. And every other Wednesday at 12 o'clock, we do what we call is MT Live. And on options, trend analysis, bar by bar analysis, some topic that we're going to cover on Wednesdays. So, and that's free. And obviously the pre-market is free. You can get to know us. You can go to YouTube and you can watch the other pre-market reviews. You could watch what I said this morning. So validate what I'm telling you right now. All right. So higher time frame, lower time frame. What time frames are they? It doesn't matter. Your choice. Is this a 65-minute time frame? Well, if it was, we can then go look at the 5-minute time frame and look for patterns that are tradable. Big. This bar is black because I've colored it based on a wide range bar, a big down bar, and it comes all the way back up. And again, look at the bottoming tail bar. That suggests it's going to go up. So define the structure, pivots, support, resistance, major support. Major support is the low prior to a higher high. Define the trend. And this is the essence of what the Metastock add-on is doing behind the scenes. Right? It'll mark candle patterns, but it's looking at the trend based on pivots, and there's a nice, beautiful band along the bottom that it tells you whether the trend is bullish, bearish, or neutral as it begins to change. And I created that many years ago. It's still it's great because why change what works, right? Your job to judge the trend quality, I've explained to you, is, you know, there's a bunch of overlapping bars, but are there bottoming tail bars there? Or is it, this is a trend where buyers are in control and they buy the dip, even though it moves lower and come back up again, and there's a pivot and then a pivot, and so on and so forth. Told you, anticipating turning points. Capitulation is where prices run up and they get extended. They find extended. Well, let's say something went up, you know, 8 bars in a row vertically. Maybe some of that, maybe it's in the cards for this week. We'll see. You know, tops and bottoms, retest bottoms. I didn't talk about voids. What's a void? A lot of people get hung up on that. A void is just, think about what the void means. There's no support or resistance to the left. New all-time highs. There's nothing to the left. Something gaps down. There's a void above. Your job is to look at what we just talked about here for the last hour or so, right? Support, resistance, and trend, and bar by bar analysis. Just got to get your head wrapped around this, and you know, how do you do that? Well, first thing, if you're new to Master Trader, go to the site and look around. But if you go to the site and you can scan this code right here, and it's going to take you to this page, Why Master Trader, and you can read about Master Trader, and there's a lot of, I don't know, less reputable sales, call them snake oil salesmen. You know, there's just salespeople out there. I've been doing this for 30 plus years, and bear markets, bull markets, garbage markets, you know, through the test of time, what I do works. And I've educated a lot of people. So go there and read that. Now, the next step, right? What am I going to offer you today? Well, all of this is what I have to put together to form strategies in multiple time frames. Bar by bar, candles, multiple time frames, support, resistance, everything we talked about, plus money management and your psychology. This is a big deal for me down here, because without this, this stuff don't work. As good as you can be at it, if you don't have this down, it doesn't work. Right? So the course I'm offering you today is one that I recorded near the end of last year that I promised to do for a couple of years and just was too busy to do it. You can go, you know, mastertrader.com/best course. And it's mastering candlesticks, bar by bar precision, day trading or swing trading. And if you're an investor, just change the time frames. That's all you need to do. Right? So if you're new to trading, from the foundation all the way to advanced bar by bar in alignment with all of the concepts that I spoke about, it's on the site for $9.97. If you use the coupon code CANDLES, it'll be $5.97. It's an incredible offer. In addition, at the checkout, if you click that you'd like to get our advisory letter for swing and options trader, which gets into a nice explanation of what happened in the markets, sector analysis, market analysis, our trades, and I think there was like, 15 trades, which is a lot, a swing and options trades. They don't all trigger, but we monitor them throughout the day. You get text messages, updates for those, and in the member area, everything is tracked, and you can see current trades and past trades. So you can click on that and you can get that for free. And other than that, I am finished, I think on time. And if you have questions, you're certainly welcome to email me, Greg@MasterTrader.
We do have two quick ones, if that's all right.
Yep.
Can you hear me?
Yeah, I do.
Oh, okay. Michael wants to know, do you have any thoughts on Heikin-Ashi to reduce noise and identify trend?
Well, I mentioned that is the goal of Heikin-Ashi. Is supposed to be looking at what's happening on individual bars and putting in the context of a trend. And the goal there is theoretically to take away the noise. And My idea is I want to see the noise because that's valid information for me. But for those that cannot look at that noise in the context of, the trend and what to recognize it as noise, something like Heikin-Ashi could be a valuable tool to use to follow the trend. And again, if you utilize proper money management in alignment with that, it can work.
One more question.
Yeah.
Pooley wants to know when you say higher time frame and lower time frame, what does that mean to you?
Well, as I explained, that depends on your goal as to whether you're a swing trader or a day trader or an investor. So what you don't want to do is mix them up. I also mentioned that looking at 5 and 15-minute charts, if you're a swing trader, is going to work against you because you're going to see trend breaks on a 5-minute chart that are totally meaningless on a daily time frame. Like this morning's gap down, granted, in the broader markets, could have resulted in something ugly. That's the unknown. You have to accept the unknown as a trader or investor using technical analysis or if fundamentals. I don't care if you got the best fundamentals in the world. That the sales are great and all of that. Things change. So you have to allow things to breathe, so to speak, allow that noise to play out because you can't react to every little nuance that's happening because you'll just be all over the place. And I like to call you'll be a commission generator. Another analogy that I use is you'll be a frog in a blender. You'll just be chopping yourself to death. So there are choices to be made. If you're a swing trader, don't go into those little time frames on the intraday time frame. It's not to your benefit.
Okay. Thank you, Greg. Really appreciate it. That was great. Good class.
Thank you. Welcome.
All right.
All right.
I do want to spend we are kind of running a little bit slow on time right now, a little bit late, I guess would be a better way to phrase that. But I do want to talk a little bit about the methodologies that you've got, Greg. Thank you so much for joining us.
Yeah, I'm glad you put the picture up there because, I have been talking about, and I talked about that band at the bottom. And so if you want a great market timing tool, that is it. Because all of that I talked about is incorporated into that. And, if you want to time the market, just put that add-on on the S&P 500, the NASDAQ 100. You can put it on with semiconductors or the healthcare sector or what have you. And it's going to tell you, whether the odds are in your favor or not. And it's going to mark the entry points and so on. So, it's a great add-on. I'm proud of it. And if you want to add that to whatever you're doing right now, you will be extremely happy with it to incorporate that into your goal. As to, of course, which is making money, but apply it to the time frame that. And when I created this, it was primarily for swing trading, right? Daily, weekly time frame. So, while you could apply it to an intraday time frame, that wasn't the goal when this was created. But this will create a bias for you to utilize in your intraday time frame. So it's a fantastic tool to put in your toolbox, 100%.
Thank you so much, Greg.
Welcome.
Okay. All right.
Until the next time. Thank you, Jeff.
All right. Thank you, Greg. I do want to talk a little bit about what's in that toolbox, and I'll do that quickly. There are a number of different setups that we've created with Greg that you can scan for, you can look at. They have expert advice here, they have commentary. They really fall into two different categories. That would be your trend following setups, as well as your gorilla or your reversal setups. And I do have a matrix that I'm not going to read out loud to you. Certainly, if you want to, you can pause and kind of look at these. Definitely different conditions to take advantage of different trends. All of these systems would kind of be the trend following or the trend reversal methodologies that are in here. And then here's a list of the counter trend or the market reversal ones. And so they'll kind of fit in those two different baskets or those two different categories. With all of those different setups, you get clear entry triggers, defined stop loss placements, target setups, and a trade management plan as well. And just like we showed earlier with the commentary and how it can kind of help spell different conditions out, this does a really, really good job of helping you understand what the pattern is, what it means, how you could kind of take that as a trading plan and trade with it. There you go. We have the explorations here. You've got the trend ribbon. It's either green, bullish, yellow, neutral, or red, bearish. What we're going to do as part of the add-on is, if you purchase the add-on, Greg is going to throw in 2 months of his advisory service, which is $149 per month value. That includes his letter, his options trading and intraday updates, premium videos, a Facebook group access, monthly market review, live text messages. So this is actually a recorded boot camp. We've already recorded it. Greg did a really good job. I do a second part where I kind of walk through how to run all the scans and how to organize everything and how to get everything ready. All in all, it's 16 value-based setups. It includes the documentation on all of them, how to trade them, implementation strategies, the training videos, the training setups. Normally it's $19.97, but at the Trader Summit today, you can get it at $9.97. To do that, you can go to metastock.com/mastertrader. You can also call us at 800-882-3040 and metastock.com/saleschat. As we've talked about all day, this comes with a 30-day money-back guarantee. You can try it. You can evaluate it. If it's helpful for you, you're going to want to keep it. It's a one-time cost. And if you don't have access to the 32-year winning Metastock platform, we'll even give you access to that for a month. So you have really a low risk, high reward type of a scenario there. Metastock.com/mastertrader, 800-882-3040, or metastock.com/saleschat. So it is also part of our, there's stuff that doesn't go in here. Summit Traders Pack. Sorry, that was some bad editing of slides there. It is part of our Traders Action Pack, where you can get the MRA, Greg Capra, the JBXC, the velocity. We're going to talk about that after Oscar. Oscar is going to come in. You're going to learn about how good of a teacher he is as he talks about the markets. Very animated guy. We have a training course that he put together, 3 months of Learn Metastock. Individually, $6,386 is what you would pay retail if you just bought everything individually on the website. We put together a special price for 2026 if you want to get started with 2026 with some really, really good tools. This is called the Traders Toolbox. It's $2,788. To get that, you can call us at 800-882-3040, metastock.com/saleschat. And I do want to thank very quickly Stocks and Commodities Magazine and the tradersforum.com and, well, us, I guess. Let's go ahead and get to Oscar, who you're waiting for. Oscar Carboni is a huge friend of mine. Some people have called him a force of nature. I wouldn't argue with that. Some people would call him a very, very good speaker. He's always so animated, so much fun. Always fun to have in the room. We're gonna have some fun with him. Oscar, let's get you started.
You hear me now?
I can hear you now. Yes.
And can you see me?
I can. Yeah.
Right. I think we can get this thing rocking, baby.
Heck yeah. Let me go ahead and make you the presenter here. I'm good.
I love the pictures of you and your family and the kids. I've been liking all of them.
Thanks. I appreciate the endorphin hit.
Of course.
All right. I can see your screen. I'm going to get out of the way. Everybody's here to see you. William says, I love Oscar. He says, stops are out. Are stops out?
Are stops out? Yeah, stops are out. Emotions are in. That's the way this works. We don't use...
I'm going to get out of the way, Oscar. It's your turn. Go.
All right. Well, let's do this. First of all, Metastock, thank you so much for what you did. What a fantastic presentation today. You traders around the world are getting educated. You're getting to see great products, and that's all because of Metastock. I've been working with Metastock since literally 1982. I think I was customer number 11 without even exaggerating when I started. I might have been 3, but by the time I decided I liked Metastock and flew out to, I think, Provo, Utah at the time, as an 18-year-old kid to go visit them. I've been using Metastock ever since. And I'll tell you right now, it's helped me create the best programs I've ever ran in my life. You'll see a bunch of that here. So my name is Oscar Carboni. If you don't know me, you'll get to know me today. Stops are in, emotions are out, and one of the things I like to tell people all the time. But when I start off, I usually start like this. Good morning, good afternoon, and of course, good evening, traders from across the globe. We even hit the bell. You ready? We got the bell. Now you guys got it all. So I have been analyzing and studying markets since the early 80s. 18-year-old kid down on the trading floor. I wear this jacket because I wore it for 40 years. It is mine. I deserve it. I've been trading there since I'm a kid. I started out with point and figure. There were no computers at the time. The computer revolution didn't start yet. And I literally started with point and figure charts, X's and O's on a piece of graph paper. And I'm from back then. And I've morphed with the whole gamut, straight through to where we are today. And the Omni has been working, Oscar's market navigational indicator, the entire time, and you'll get to see some of that now. Here's what I'll tell you. I promise you not to sell you anything. Today, I'm going to educate you. I'll show you where you can find me at the end of the day. I'll show you what we did today as a group of Omniacs around the world, but I promise I will not spend time selling you anything. This is to educate you. So, Metastock had approached me. I've been doing webinars for Metastock for many years now, but they approached me in 2023 and said, Oscar, we've got a webinar planned. Would you like to be part of it? And I thought, this is the moment that I've got to show the world that there's an AI revolution taking place and how they can make money, capture the entire AI revolution. So I'm going to start this presentation with a portfolio that we put together literally in October of 23 for Metastock. Did this presentation, started with this exact chart and showed you a bunch of different stocks that will go up with the AI revolution, and you can participate in those stocks. Why? Because when I was looking at NVIDIA in 23, it was over $1,050 a share. What mere mortal can afford to buy thousands of those, right? So I decided that I would come together, put together a portfolio and show it to Omniacs and Metastock users around the world in 2023. Now, every time I refer back to this webinar, I put a little dot or a diamond, if you will, and the word webinar. So since Omni got interested in NVIDIA and the AI revolution, webinar, 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 all of these were for Metastock and Traders Corner. So every time I present this same portfolio, I make sure that there's a W and a diamond so that you know where we were last. You are looking at NVIDIA. NVIDIA was the leader of the AI revolution when it started, but I'm going to tell you something about the AI revolution. I have been part of this gamut since before computers were desktop, when you couldn't get the VIC-20 or the Commodore 64. There were no computers on the trading floor that we had access to, and we wrote things down on pencil and paper when I started. And I'll tell you right now that when the computer rally hit, we went up for about 7 years. Nothing goes straight up. The markets went up for about 7 years. Then we finally had a bit of a pullback, which became like a little bear market for a while, but you got about 7 years. You know what happened after that? The internet revolution came out. And you know what happened after the internet revolution? These markets went up for about 7 years. Nothing goes straight up. As you can see looking at this chart, nothing goes straight up. But overall, you started this chart on the bottom left of the screen, you ended up at the top right. That's bullish, right? That's going up overall. Now we've got the AI revolution. This is what started this portfolio I created for Metastock and Omniacs around the world in 2023. So we started this in October of 23. They released AI to us in November of 22. So let's just call it January of 23. 23, all of 24, all of 25. It's been 3 years, not 7. This is only year 3 of what should be a 7-year revolution. So I'll tell you right now, of all the questions that came to me in the last few weeks and all the stuff I studied reading the newspapers this weekend, AI was all over the place. But one of the themes I was catching is that so many articles are about AI reaching its pinnacle. and maybe now it's become a bubble. And I am here to tell you absolutely, positively, no way, no way are we there yet. The other question that came to me was, there's a double top in the S&P Oscar. Will we get through that double top? Now, had I been able to present for Metastock for you this morning at 9 a.m., I would have been able to show you what's going to happen today. But instead, I'll be able to show you what we had planned, what we did today, how we took advantage of it, and what the Omni recognized. We'll do that towards the end of the webinar. For now, let's go back to this AI revolution. So the computer rally went for 7 years. The internet rally went for 7 years. AI is only on year 3. It's got time. I hope these cheaper alternatives to NVIDIA, especially when NVIDIA was $1,050 at the time, will allow you to participate in the AI revolution, as NVIDIA is too expensive. This all happened in 23, starting with this chart. Now, on this chart itself, I'm going to show you something that works great if you're an NVIDIA trader. This is your 150 bar moving average. Remember, kids, I grew up on Wall Street since 18 years old. Many people will speak to you today. Most of them will never have the experience that I have gained. So watch what I'm going to show you. So this is the 150 bar moving average. You might note, or you didn't notice it yet, but Wall Street and the 150 bar moving average love each other on NVIDIA. How do you know? You bounce off the 150, you come back to it, bounce, come back to it, bounce, come back to it. The only way you got through this in NVIDIA was during Trump's tariffs in April. That was it. You got back above. Look what happened recently. You bounced off of it and started a rally again. So just going back to the chart in 2023, there's still a great lesson on this chart alone. If you are an NVIDIA trader, a gift for you, work the 150 bar simple moving average. Wall Street loves this on NVIDIA. Why do they love it on NVIDIA? It's a question I'll never try to answer. It's almost like you being a race car driver and you being so worried about how they make a tire. Who cares? Get me a good tire, slap it on my car, let me win this race. That's the way I look at all the indicators and everything that's ever been invented on Wall Street. I don't care why. Who cares why? How is what I'm about. How do you use it to your advantage? So we have this NVIDIA chart. Told everybody that, you know, you can't afford NVIDIA, but this is what you can afford. So follow me and let me set you up with a whole portfolio of AI stocks back in 2023. We're now in 2026, and we're going to see how this portfolio is doing. So remember, traders, that this is a risky game. Trading futures, trading options, trading stocks, trading ETFs, trading crypto. It's very risky. You need to plan a trade, trade that plan. But you know what needs to be in that plan? Stops first. Always place your protective stops first. You'll live a lot longer in this game if you do not enter into a live position till you have placed a protective stop. Take that from me 44 years later. If it wasn't for stops, I wouldn't be sitting here speaking to you right now. So what are these AI revolutionary stocks that Oscar says we should all be part of? Let's find out. And remember, I've been doing this webinar over and over again. Every time you see the word webinar, this is me updating you cats on where we are on the portfolio. So let's go look at the group of stocks in this portfolio. We've got the AIQ.Q. It's a global ETF. Omni loves it down here. In fact, right here, Omni gets interested. We do a webinar about that to tell you we're interested in these stocks you're about to see back in 23. And every time you see a W, we did it again. It rallies up all the way to here, but look what it's doing now. After it made its low for the tariffs, look at the new channel that's being formed, which is much steeper than the green channel. Now, I mentioned many times, I like to teach Omniacs little tricks that will help them. One of the things that you need to know is that Wall Street and geometry, they work hand in hand with one another. These markets are geometric. That's how they move, in geometric movements. And Wall Street knows this. And how does Wall Street know this? I'm going to show you an example right now. Check this out. This is a simple trend line that goes from here. Let's cut that down so that you can see exactly what I want to show you here. Watch this. It's an amazing thing. So we are going to now make this trend line nice and dark so you can see what Oscar's getting at here. And we're going to get rid of the extension. All right, we're just going to make this a simple trend line and watch what happens. I have a trend line that simply goes from point A to point B. This is example number 1 of geometry on Wall Street, something you need to know. Now watch what happens when I extend. It hits this low. Only time you got through was tariffs. And look at this. Now, that's the bottom of this channel that Wall Street rode the whole way up. Watch example number 2. Check this out. Let's get rid of this for a moment. You've got a trend line, green. It goes from point A to point B. Does Wall Street use geometry to figure out where they're going next? Watch this. Boom. What happens? You hit here, 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 here. Can't get above. When it finally does, what does it do? Comes back and it tests the geometry and holds and creates a new, now this blue channel moving up is the new channel. So the AIQ looks fantastic, and Wall Street obviously loves it, because I wouldn't be able to show you these examples if Wall Street wasn't jumping all over this. So resistance line, it worked on your resistance line, it worked on your support line. Simplistic analysis, I promise you, is so much better than getting complicated. When you bring complication into a complicated business like trading, you're overcomplicating yourself. You know what I mean? You got to get to a simple spot to figure out what these cats are doing out there. This is simple, easy. Let's look at more stuff. Next portfolio, next stock in our portfolio was the AI play called bots.o, B-O-T-Z.o. Now, so much respect is being paid to this orange average in this stock. I mean, look at the way it hovers around the average. It loves this average. All right, whatever Wall Street likes, I don't care. I just like to use it. So Omni likes it about here, and it takes off. And as you can see, it is just exploding. Now, we liked it at the price of around, let's see what we got here. We liked it at the price of around $22.50. We're at $38.44 now. Every one of these stocks in the portfolio has done well since 2023. You'll see. Now, I've given these out to my Omniacs around the world and my Metastock fans, and many of you are in these, which is why I keep bringing this up at every one of my webinars, because a lot of traders around the world actually took my advice and bought these stocks. And I'll tell you when to get out, kids. We're nowhere near it yet. Let's go to the next one. The AI play called Buzz.K. It's a Van Eck ETF, a fantastic looking ETF. Once again, look at the way it works inside the geometry of this channel. OmniStock's liking it back here. We do a video, or I should say a webinar about it and videos, and it just hovers inside of this channel, breaks out for a little while, tariff lows, gets above the channel, and just keeps going. What's it do? It comes back to test that channel, holds well, away we go. I promise you, Wall Street uses these channels. It is impossible for me to be able to illustrate this to you unless Wall Street is using this. Now, there's a new, bigger direction taking place. Now, I wouldn't call it quite a channel because of how wide it is, but look at the direction taking place now. Right now, we're starting to move up in a lot steeper fashion, and just about every one of these ETFs or AI stocks are doing exactly that. They started slowly inside of a big channel and then just exploded out. So if you're riding these, stay with them. The only ones that are going to be removed are the ones we'll show you that we have removed in each of our webinars together. What else do we have? AQM, it's the Franklin Intelligent Machines ETF. Now, ugly chart, right? Ugly chart. Wonderful looking ETF and amazing usage around the 25-bar moving average that Wall Street seems to have adopted. So you can see that it held this green support, held, broke through for tariffs, got back above it, and now we're in the blue channel, holding trend lines, holding averages, rallying out. There is no way the top of this AI bubble It's not even a bubble. I promise you, it's a revolution. There is no way we're there yet. It's just no way. Watch, there's so many more. LOUP, look at this one. It's an innovative deep water ETF. Another one that's just fantastic. Look at the growth taking place now. Look at how this is just starting to go. And it's very geometrical, just like the other stocks, just like you'll find in ETFs and stocks, and even the S&P, NASDAQ, Russ, very symmetrical. They love to work with this geometry. So, loving this. Deep water stays with us. Let me show you the next one, because after this portfolio, I got a whole webinar to go through. Got to get the portfolio out of the way first. All right. So LRNZ.K, if you recall, in one of the 5 webinars ago, we got rid of LRNZ because it broke down through our channel and we took it out of the portfolio. Here's what's interesting. Even the laggards have caught up. Even the ones we removed, there's like 3 we took out because they were starting to go down. They all exploded too. Look at how high it is now. So even though we got out down here by this flag is where we exited, it still ended up a year and a half later, much higher. But let's keep going because we have more stocks in our AI portfolio. This one was removed from the portfolio back here during a webinar. I told everyone that one's gone too. Look at how high that's gone. Even the ones I didn't like after a while have gone. This revolution is not over yet, I promise. Let's look at another one. This guy was removed, and look at how high that went. So I mentioned we will remove this as soon as it fails this area, which it did way back 5-7 seminars ago. We removed it, but look, it's still doing well. Traders, I've got a live trading room. It's absolutely free. I'm always in it, by the way. I haven't mentioned that to you. I'm in it right now. In fact, even though I'm live doing a presentation for you, I'm still broadcasting to my OmniAcs around the world. I am always in this chat room as well as people from all over the world. You can find me here. It's very, very easy to find. It's absolutely free. No credit cards are even required. Make sure if you like what you see here, you come hang out with me at my trading room, okay? I'll give you some info at the end on how to get there. What else is in our portfolio? Okay, look at this guy. Look at how strong this one is. It's the Robo Global AI, I call AI ETF, Think or ThinkQ.K, however you want to call that. Omni starts liking it here, goes into the usual, into a nice channel, breaks out during the tariffs. It had to go down, right? It's what always happens when something major news comes out like that. But look at this insane breakout. Look at how well it's rallying. There is no way this revolution is over unless all of these stocks turn around tomorrow and just crack. But we're not there yet. I also host a 4-day boot camp in Vegas. And this one, next one's going to be in Europe, by the way. We're coming to Europe in the spring where I'll be doing a 4-day extravaganza, if you will, teaching Omniacs around the world that show up in Europe how to do the Omni and come up with their own trade recommendations. If you want to be part of that, you go to omnibootcamp.com and we'll talk about that. Let's just continue showing you this portfolio. Things happen to be on my chart, so I'm reading them to you, but I didn't actually plan for that. Next, the Defiance Quantum ETF. Look at this. This is probably the best one of all of them. Look at how solid and strong. Omni liked it back here when it was in the 40s. It is in the 117 area. It is doing great. Another one of our AI portfolio. It just looks fantastic. It's a very nice ETF. It's a very strong looking chart. It's very symmetrical. It's geometric. It just looks fantastic, kids. So keep that one as well. We would not be removing it. This guy, we had to ixnay him back here. So we added MSTR long after we started this portfolio. We added MSTR back here in 24. We had a target of 277. We added it in at 184 at 277. Then we just held it. What the hell? But when it got back down below these lows, see here, when we finally got back down below those lows, we pulled it from the portfolio. So We got in at 184. We got out at like 233, and we're out. That's out of the portfolio. This is no longer part of our strategy. So that was the AI portfolio I put together for us right when AI came out. And so far, it is doing really well. I hope many of you are still holding these stocks. What else are we going to find out there? Let me show you something new now. Let's get away from the AI portfolio and let's go look at some other stuff. Check this out. The Dow Jones Transportation Average. Now, where's the whole market going to go? Where is it going? What's going on? Well, a lot of things in this chart. First thing right here, the Dow Jones Transportation Average is deemed the leader of U.S. indices, S&P, NASDAQ, Russell, you name it. Does it lead every day? Absolutely not. That's not the way we view this. It does lead overall. It absolutely tells us many things that are happening in markets. So why do we call it the leader? Well, first off, before we even, if there's any argument about that, go argue with Charles Dow. The transportation average has been the leader since Charles Dow named it the leader. The market is called the Dow Jones. This person is Charles Dow. You must believe in him. If you don't believe in him, you shouldn't be trading. So Charles Dow says the Dow theory is one of the Dow theories, barring us looking at the tides and how he compares markets to tide movement, is that the transportation average is our leader overall. Why is the transportation average the leader? I'll tell you why, and it's very simple. If you are going to make anything, you're making cell phones, you're going to need raw materials shipped to build that phone. Once you build the phone, you're going to need transportation to ship that to a distribution center. Once it gets there, you need transportation to get it out to clients, or to get clients to you, they're going to need transportation. That means if future orders are being logged right now, hi, next week or next year or next summer, I'm going to need X amount of these phones. If a lot of that is starting to happen before the phones are even built, the transportation average lets you know. Now, I'm sorry I'm using phones. It's anything. Call it a cowbell, pair of glasses. It doesn't matter. It's a product that's being made. If more of that product is being asked for, a lot of transportation is going to have to come into play to get that product out to market. Your transportation average will do something like this: explode, go into a bull flag, and explode out of that bull flag. What else is on this chart? When I put this chart out a few weeks ago in a video, it was because we were at this thing called a triple top. Now, you can take out just about any book that's ever been written from Wall Street, from any other trader but me, and ask them what a triple top means. Open up that book. I'll promise you right now that triple top's going to tell you it's the top of the market. Oscar's version of a triple top is different. A triple top means you get a brief dip, then new highs are made. Top one gets hit right here. Let's get this out of the way. Top one hit, drops. Top two gets hit, spends a long time. Top three gets hit. Everyone in the world calls the top of the market. Oscar comes out and goes, no. I promise you the books are wrong. This is what, then you should write this down. This is what triple tops do. 90% of the time, you get a brief dip. Where's the brief dip? Right here. What happens next? New highs are made. Now that's the Oscarism version. I would take all the books you've ever read about a triple top and burn them. Incorrect, I promise you. How have I gotten to a point where I can tell you if these techniques work or not? I used to trade in a pit. You know what trading in a pit is like? Buy them, buy 2, sold 10, buy 8, sold 15, buy 7, buy 8. You had to just trade all day long, right? You traded all day long. I would open up a book, read about a technique, and go, okay, this guy says you're supposed to do this. I would do it 5,000 times in a week and a half. 5,000 times. And I'd go, well, that didn't work. And I'd shove it. Well, the next thing you know, years later, I had a whole book of rules that do work and don't work. And I promise you the triple top is not the top of the market. You get the pullback I just showed you, and a new high will get made. What else happened here? A bull flag was formed. We broke out of the bull flag. What else happened here? It did not stop for any double top. That's going to be important in a few moments. It did not stop for a double top. It just kept going. A lot of good stuff on this chart. What else can we show you? Let's go look. I got some stuff set up. Let's start here. This is a chart of the Dow. Is the AI revolution over? No. This is during the tariffs. We made a tariff low, which I call the shoulder, head, shoulder, an inverted head and shoulders. Your head's down here, left shoulder, right shoulder, and look what has happened since. Look where we are now. Does that look like the AI revolution is ending anytime soon to you? If your answer is yes, do me a favor, flip yourself over, stand on your head, and look in the mirror, and everything will look better to you. Because that's not bearish. What else is out there? Let's see. Let's go look at this. Okay, you're looking at the NASDAQ. This is a testament to the power of technical analysis. We're using this chart. I do videos just about every night, YouTube video. Those videos tell my OmniX around the world what's going to happen tomorrow. Then we get into this live trading room, which is open 24 hours a day, and I act out those very same trades that the OmniX have been told about. Okay, so here we are using a NASDAQ chart, and I tell them, look, something crazy happened. The market rallied, and Omni went red. Right here, Oscar's market navigational indicator goes red while it's rallying. All right, we don't argue with Omni ever. What happens next? Look, smash, smash, smash. But where does it go? Omni average, OTAPMA, Omni Trading Academy's proprietary moving average. Held it last time, held it this time, held it this time. Away we went. What else happened here? Better than the Omni average. Let's forget about that for now. Forget Omni average. Something everyone knows about. Wall Street was keying off of the geometry. Boom, boom, boom. Where? Here too. Boom, boom, boom. Catches. Now look where we're going. Breaking out. Fantastic work using simple analysis to show us where it's going to go. Now the Omni is a system that gives you an arrow, whether you should buy or sell for the day. And then there's Omni analysis that we do that helps us come up with fantastic trades every day. We don't win every day, but we always come up with great trades. Sometimes they get stopped, but they're always great trades. Even a stopped out trade is a great trade if you had a plan, you followed the plan, you bought it when you were supposed to buy it, you had your stop in first, the stop got hit, you did nothing wrong. That's a great trade. That means you are very professional at what you did that day. Because losing is an integral component to winning. We don't always win. You've got to be as much of a good loser as you are a good winner. How are you a good loser? When you follow your trading plan and do not deviate. That makes you a good trader. Do you know how to plan a trade? Well, that I can teach you if you ever come to one of my camps. You should know how to plan a trade. You're looking at the very same trade we used to trade today's NASDAQ for OmniX around the world. Where to get in, where to place your stop, and where all our profit objectives are. We did that trade, and we did an E-mini S&P trade, which is already predetermined before the markets ever open. And then I act out the trades for my traders in my trading room, and you'll get to see them a little bit later. So plan a trade. It's been planned. Trade your plan. That's the important part of doing what we do. You cannot guess every day. You cannot use seat of the pants decisions. You cannot feel it. My gut says this, and forget about calling somebody. None of that works. You know what works? The chart. It's the best roadmap on this planet to future pricing. What else do we have out there? Let's keep looking. I think the next chart I wanted to show you was this. Here's the big question on top of, is AI going to come to an end? No, not a chance. Here was the next big question I had. Oscar, are we going to go through the double top? Big question. I even did a video about it. Are we going to go through the double top? My answer was yes. How do we know my answer was yes? Because today we did a trade. I had a double top. I'm sorry, let me go back to the trade. We did a trade today. Even though we had a double top in the S&P, I'm going to show you why I would have done this trade today as soon as we get to the next chart. Traders, you're looking at the NASDAQ daily bar. This is a live trade that was sent out to my OmniX all over the world today before we got in. The Omni says to get long NASDAQ at 25,665. Bingo, we get long. Tells us where to place our stop. Stop goes in first. And then we've got our profit objectives. That is exactly what you're seeing right here, by the way. This very trade we used today is live. It happened. We got in and we got out. Omni gets us long NASDAQ at 25,665. Gets us out at 25,849. A profit of $3,680 if you traded one lot. If you traded Omni with me today before this webinar, that happened for you. We also made 6 points in the S&P. The only reason why we got out of the S&P and didn't ride it all the way up today, A, we're up 200 plus points or 184 points in NASDAQ. B, we still had the double top looming. We don't know if we're going to get through it or not yet. So we took our profits. This was just one of the Omni trades. A whole year's worth of Omni trading was paid for with just today's trading alone. If you traded with me before this webinar, you made a small fortune today. If you like what you see at the end of this, you will join my platinum membership at Live with Oscar. But let's continue to look at what's going on out there. So we were looking at 16. Will the S&P go through the double top? My answer was yes, and I got us long for it, which is not like me. Oscar says, when we see a double top, we sell a double top. But guess what? That already took place. And I did a video about this when it happened. See this bar here? Let's get rid of this. Let's get rid of this. This already hit and paid its respect. That happened. Done. Double top was hit. Respect was already paid. One of the reasons why I thought we're done. We're going up from here. Then we add the bars in, and we're just about there now, right? Why would I say it's going to go through when Oscar is the master of when we see a double top, we sell a double top? So what would make me come out and tell my Omniacs this morning to get long? I'll show you. So we didn't know if it's going to go through, but we have other markets to gauge it off of, right? Like this. Did the YM, which is the Dow itself, did the Dow go through the double top or did it stop for it? Through. Goodbye. In fact, it came down to test the double top and kept going. Did not stop for the double top. Okay, well, ES stopped for the double top. Well, that guy didn't. Who else can we look at? Did the Russell stop for the double top? I'm going to have to say no to that one too. 2 full bars above the double top, I'm going to have to say no, unless somehow magically we end up settling down here today and come all the way back down here. If that happens and we end up with a settlement, then the double top didn't get broken through, but that's not what we see. What we see is 2 full days bars above the double top. Russell did not break through. YM did not break through. Back here, nor did, they broke through. YM broke through. RTY broke through. Dow Jones Transportation Average broke through. Why on earth should this guy not? This guy should break through. It will break through. I got us long, so it can break through. Okay, so yes, we're going through. That double top already had respect paid. So that's the answer as well. Yes, we're going through the double top. We put our money behind it this morning. No way is the AI revolution over, but we're not done looking at stuff yet, kids. Now let's move to another sector. Let's go here. Gold, a little lesson about gold, about metals themselves. In several videos, I've been trying to explain to my Omniacs that are doing analysis and trying to stay long metals that gold and metals themselves are creatures of the channel formation. What does that mean? Well, if you look, they love to find the channel and stay with it. Let me see, look, channel top, channel bottom, channel top, channel top, channel bottom, channel top, finally gets out. What's it do? Starts to create a new channel immediately. Bottom, top, bottom. Then it goes into a steeper channel. Bottom, top, gets to the bottom here. Now I say we're out of the green channel. We're out of the blue channel. We're in this one now, a new channel developing, moving much higher. Gold is a creature of channels. It's not just gold. Silver, another creature of channels. And I promise you, simple trend line analysis, in most cases, simple approach is the best approach. I showed this in a video and said at this spot, in fact, you can see this in 3 different videos. At this spot, I told you if we hold here, we're good. At this spot, I mentioned the same thing. At this spot, I did a video and said the same thing. If we hold here, we're good. Now, at this point, I put out a target for 94. The shame of it is we've already gone up to 85 before I got to do this webinar for you. I couldn't show this to you when we were trading 80. I had to wait till 4 o'clock. I had to wait till 4:09 today to present, actually. So I wasn't able to give this target to you today, this morning, but it was conjured up waiting for this webinar to tell you silver's got an 84 target based on where it held right here. Holding here with golden, simple approach works well, but did you notice channel? Look at the channel, 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 then the new channel. Metals are creatures of riding channels. It's not just silver and gold. Watch this. Look at platinum. Platinum, another creature, if you will, of channels. How do you know? Well, take a look. This is a creature. Metals are creatures of channels. Remember where I grew up, kids? I grew up in the metals pits, by the way, to the point that till this day, I still hold, from when I started, a gold Krugerrand and a silver dollar in my pocket every day of my life. When I started holding these, this was $275, and this was about $13. Now it's almost $5 grand, baby. This guy's pushing 80. So this went up thousands and thousands and thousands, and this only went up a little bit, but it's finally starting to catch up. Anyway, I am a creature of metals, just like metals are a creature of channels. Once we broke out of this channel, look, there's a new steeper approach taking place. You can buy off that line until it breaks it. Buy off that line until it breaks it. Every time you rally up and come back down, you can buy that line until it breaks. Then we'll see what else is going on. So it's platinum, it's silver, it's gold. They're all kind of the same. If you want to join my platinum recommendations, by the way, this is a great time to get started because it's the beginning of the year and Omni is just killing it so far this year. Omni killed it last year too. If I went and showed you what we did each month last year on our Omni recommendations, you'd fall over. I won't waste your time on that though. Let's keep moving. So we did platinum. Now let's roll to another sector. Let's roll out to Bitcoin. Traders, using the Omni analysis, I was able to identify when Bitcoin was trading at $88, 88,000, I was able to identify 126 chart, which was left on my whiteboard in every video for 4 months till we got there. Do you know what Bitcoin did? It raced up and hit exactly my 126 target. Using the Omni methods, I then identified that we would drop to 80,200. Look what happened next. We dropped to 80,450. It almost hit my 80,200. Well, while I did this call and this call, I also calculated that crypto winter would come to an end right about here. You guys have heard me say this in many videos, right? Crypto winter would end right about the last week of December. Look at what we're seeing. Right there, it looks like crypto winter is starting to come to an end. I mean, come on, is that not all good calls? Who can do that? This is an amazing thing using technical analysis. It tells me what to tell you, and it's right so often I'm embarrassed. It's just insanity. Please like, share, and subscribe to Live with Oscar if you like what you're seeing, because that's where you'll find me in that live trading room. What else is out there? So you've got Bitcoin. We've got this guy out there. Look, Ethereum, another creature, by the way, of channels. Ethereum likes channels. Why? Because Wall Street trades Ethereum and Bitcoin. They both like channels. Check it out. First, you had a bull flag, a channel really, with a straight up line as a bull flag. Breaks out, goes into the next channel, which is another bull flag, and this big green channel. Breaks away from that, creates the red channel, follows it straight down. Look right here. As we start coming out of the winter, we get the blue channel, and now you're getting this channel even steeper. So not bad. Our calculations on our Omni calculations on Bitcoin have been really, really solid. In fact, I don't know anyone that's ever made such calls on Bitcoin and Ethereum as the Omni since it came out, but you guys can go back and see that for yourselves. We won't go over any of the old trades. Then there's this, traders. You know, one of the things I try to do is help traders around this world. I've got a free live trading room. I do free videos every night. I am here to help people. I charge them $0 to help them. I am at your disposal. I sell 2 products. One, if you really are seriously trading and you want to trade the same trades me and my son are trading, I have a membership and I send those out to you. The only other thing I offer is a 4-day boot camp, which is hosted here in my home office. And I'll tell you right now, if you've got something to offer somebody that doesn't work, you know what you don't do? You don't invite them to your home office for 4 days where your wife and family live. You fly to another city, you rent out some stupid room, you meet them in that room, you sell your software to 1,000 people, you fly to another city, whether it works for them or not doesn't matter. Well, that doesn't happen here. You come out to one of my Omni camps, you come to my home and you spend 4 days with me. And I promise you, you know where to find me if what I showed you didn't work. So be careful what you pay for out there. Anyway, so let me show you what else. So I help people all over the world. Well, thank you to a buddy named Crypto Kelly. I've been able to help people around the world in a bigger way. I never dreamed it would happen. A friend of mine convinced me that my crowd has been pleading with me for the longest time to create something, a crypto, and I finally did. Well, let me tell you, that crypto has helped more people around this world. I've got more letters from people that tell me I've been able to retire. Oscar, I love you. I was able to afford to buy my family Christmas gifts this year. You have changed my life. We're helping people around this world in a big way. We're leaving a dent on this planet, people. And my Omniacs around the world are helping me leave that dent. How? This is how. They are participating in this Omni token with me. They know I am there to help them buy it every time it goes down. When a trader needs to get out, my Omniac army around the world goes in and buys a couple each, and we push it right back up. It's organically growing. But the one thing about this chart I want to explain to you, the Omni trading token. This has helped more people around the world. I love the fact I'm helping them. I haven't sold one single token for myself. I haven't made a dime on this. You guys are making money. Congratulations. But let me show this to you. We started this token back here in September. This token was built on Solana. I had to buy zillions of dollars worth of Solana, convert that into my token. It is built on Solana. Every single dime in that token was created with Solana. Every time somebody buys an Omni token, they first purchase Solana, then they bought the Omni token. It's real. It's not a fake coin that was built out of thin air. And if it goes up, I make zillions of dollars. This is a coin that I paid to have built out of Solana so my Omniacs around the world could do well. And guess what? We started the coin right here, built on Solana, right? And our coin has basically gone up, bull flag, up, bull flag. We're expecting up higher. Now watch this. There's a good reason for this. Here's your Solana chart. When I created my Omni, we were right here. Solana has gone down the entire time. There's a smart thing happening here. Solana's gone down the entire time. My Omni token has gone up, but Omni's built in Solana. So guess what? If we're right about the crypto winter ending in Solana, which is already bottoming out, it's starting to go up. As Solana goes up, the Omni token has to go up, even if no one bought it. It's built in Solana. We've got this nailed down. The whole time Solana went down, my token went up. That means when Solana goes up, my token has to go up inherently. It doesn't even need a buyer. This is a great time for you to get in. Omniacs around the world, if you do not own the Omni trading token at Pump.Fund, I don't know what you're waiting for. This is your moment, I promise you. And I back it 1,000%. I hold it for you guys. And when sellers come in, I take them from them. I do the buybacks. You guys are safe. Go in there and buy your Omni token. Because when this continues to go up, this has to go up on its own. It's a wonderful spot we're at right now. What else is out there for you? As a gift, I want to give you guys a gift. Check this out. This is my gift to everyone that watched this webinar today. I have been showing traders around the world in videos and my Omniacs here in my home office, and the Omniacs who follow me in this trading room from all over the planet, and there's many of them that gather. And I've been showing them this chart. Here's what I've been telling them. You want to see the most giveaway Wall Street play on the planet? Here's how you can make money, and here's what I showed them. Wall Street loves Tesla and the Omni Trading Academy's proprietary moving average, or Tesla. Loves my average. Watch this. Gets under it, gets above, rallies up, drops to it. What's it do? Holds and rallies. Drops to it, 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 holds and rallies. And drops to it, holds and rallies. What's it do? It goes to a double top. Boom! When we see a double top, we sell a double top. Here's what I told my OmniX. Here's what will happen for you. This will drop to my average, and when it does, go and buy it at the average. Now check this out. If I could remove this little box, I would. There we go. Check this out. It literally dropped right to my average and is running. My gift to you, go buy yourself some Tesla. It's at least going back to the double top. Go in, grab some Tesla. Omni already told us it's going to hold. Now, the other thing I had mentioned, because I never believe anything is going to happen until it does happen, I told my OmniX this should drop to the average and hold. Nothing is 100% because technical analysis is a fine art, not a science. So I had to put the word should in this, but I told them it should get down to my average and hold. When it does, you can go long and expect a rally. That is my gift to you for watching this webinar today. You should be safe in Tesla for any time it's above that average. When it hits that average, get in. You settle for 3 days below that average, maybe you think about getting out. You should get out. That hasn't happened in months and months. It won't be happening anytime soon. I hope that will help you. Now, traders, as I mentioned, if you were trading with me this morning, before I even bothered getting involved in this, I was able to make tons of money for my OmniX using the Platinum membership. If you want to join us, it is the simplest thing in the world. It is absolutely free. You would just go to livewithoscar.com. If you don't have a login, you would click the register button. All it's going to do is ask you for a few bits of information. Fill that out, no credit cards, no anything. You will get an email. That email will go to your spam most likely. In fact, let me write that for you because this does happen from time to time. The odds are good that if you join my site, when you get the first email from us, your email will go to spam. So I want you to check your spam, unspam it, click what you need to click, and come join us, because as soon as you get past this gauntlet, you get here. Here is where you get to see all the trades that we do. In fact, below here is a calendar. This calendar, if you click on any day of the year, it'll bring you to the Omni trade that happened that day. The trade idea is on the left. The trade recommendation, how we got in and out of the trades, are on the right. Every day since Omni started way back, when I started posting this site was maybe 2008, every single trade Omni's ever done is sitting here for you to go peruse for yourselves. So you simply join the Omni, you'll get an email, make sure you unspam it, come to Live with Oscar, you can see our trades, or you just literally click Oscar's chat room, boom. When that goes through, you'll end up in this chat room with me. It would not have cost you a single dime to have done that. And you can do what other traders do, spend your life looking over the shoulder of a 44-year, really, really good analyst and trader who allows you to spend your lives with him. That would be me. I welcome all of you. I hope all of you show up at livewithoscar.com. I wish Metastock a great, successful presentation today, and I hope this helped all of you. OmniX, that's what I had for you. Remember, stops are in. Emotions are out. That's the truth, traders, and that's my sermon from the mount. I hope I helped you today.
Thank you, Oscar. Appreciate it.
Of course. That was fun.
Yeah. We did have a question from Kevin. He wanted to know what the Omni coin was. And is the ticker Omni?
The Omni, it's Omni Trading, actually. Here, let me pull it up for you. The ticker is Omni Trading right here, Omni Trading. Now, I will tell you this. I'm going to do it for you just so that you can see it for yourself. There's some stuff that happens here that you need to be careful of if you're going to come by my Omni. Watch this. I have a lot of imposters. All right, so people have seen how well we do, and look at all the fake Omni Trading tokens there are. None of them are real. None of them are worth any money except for mine. It's the only one that's real. BVDR. Make sure that you only click this one, and it'll take you to the Omni, the correct Omni with Omni Trading. Be careful out there, kids. Don't be fooled. You got to watch the imposters. But if you go here to my Omni Trading site, there's another place you can go, by the way. You go to Deck Screener. Deck Screener will show you every trade that anyone's doing, plus my Omni. Plus, the beauty of Deck Screener is if you scroll here on the right, you can click this, which helps the world realize that the Omni Trading token is doing really well. You can only click it once every 24 hours. They watch your IP address. So you can't just keep clicking, but that would help us Omniacs around the world with our Omni token. That's on Dex Screener. We are, of course, at pump.fun. We're on a bunch of places, but look at that drop in Solana. And as it's coming up, you know that our token has to go up. So this has been a wonderful thing, kids. I hope that helps all of you. Make sure you get long that token. Believe me, I'm backing it for you.
Tracy says, thank you, Oscar. Maverick says, thanks, Oscar. Neurotic or Arctic says, oh, it's the best. Good job, Oscar. Appreciate
Thank you. Have a great evening, traders. Come to livewithoscar.com and join me. I'm not sending you emails. If you don't do it on your own, it's never going to happen. Oh, look, pull Metastock data. That's for me to run my programs on Metastock. How cool is that?
I guess we better let you go. Thanks, Oscar.
All right. Thank you very much. Have a great day, everybody.
All right. Very good. We also do offer, let me go ahead and kind of just do this. We'll go ahead and kind of get things moving along. Really appreciate Oscar. He does such a good job. We did sit down, and as part of our Traders Action Pack, we are offering training that we did with Oscar on how to properly drop a chart, how to put trend lines, support and resistance, technical formation. All in all, it was about 3 hours of formation. Very, very well done. I remember we sat down, I think, on a Saturday, and we sat down and recorded it. It was live in front of an audience. There was a lot of questions. He did a fantastic job. Here at the summit, you can get it for $349. You can do that by giving us a call, 800-882-3040. You go to metastock.com/sales-chat, or you can also get it at metastock.com/summit deal. It is also part of the Traders Action Pack. You can start 2026 off right by getting Jeffrey Scott's MRI, Greg Capra's Master Trader Method, the JBXC Complete Toolkit, Rahul Aurora's Velocity, that technical patterns course, and the 3 months of Learn Metastock. All that would normally be $6,386 here at the summit. If you do it today, $2,788. So give us a call, 800-882-3040, or go to metastock.com/sales-chat. And there we go. I do want to say a big thanks to Stocks and Commodities Magazine. I also want to invite you again to join the Traders Forum. The Traders Forum, we do a lot of really cool interviews. We do technical analysis. We look at charts. We share ideas. There's a vibrant market chat. It's all available. It's all for free, and you can go do it at tradersforum.com. So I'll see you there. All right. Our last presenter is another good friend of mine. Seems like I brought all my friends today. Rahul Arora has been a partner of Metastock. He's a partner over at tradingwins.com. He's worked with Metastock for a number of years. He's wearing his Better Call Saul shirt right here. He's going to talk a little bit about a methodology that he's been using that has really kind of just beat the markets in 2025. It's simple, it's straightforward, it's easy to understand, and so is he. Rahul, let's get you started.
Thank you, Jeff.
All right, you're welcome. I can hear you.
All right, let me turn on the camera. Now, I don't know what I'm more envious of, Oscar's energy or Oscar's lighting setup.
Okay. Well, I think it's the energy.
Yeah, the energy is going to be hard to read, especially.
Lights.
Yeah. Let me know if you can see. Let me know if you can see my screen as well, the velocity screen on the PDF here.
Yep, I can see it.
You can. How are you?
I'm good. How are you?
You must be exhausted. Full day today?
No, it's only 8 hours.
Yeah.
I could do this all week.
You're used to doing the 5-day sessions, 6-day sessions, right? Monday to Saturday.
Sometimes, yeah. Like, no, this feels like it's just a little bit of a busy day, but not too bad.
Yeah, I'm always. This is one of my favorite things to do, and you invited me to this January one, and I said you can invite me to anyone, and I will just show up.
Right on. Well, we'd love to have you, and you're invited to all of them from now on.
Thank you. So we're going to do Velocity 2.0 in the spring. we're going to add a few things to it. Jeff, thank you. This is velocity that Jeff had programmed for us. I want to say May of 2025, and over that time, we always wanted to create something that we could make adjustments to as the market was changing. So we designed this over the course of about 3 years or so, and Jeff came into that process at the beginning of 2025 and really did a wonderful job with him and his team to program it. And we're grateful to him, and I really like the way it's turned out. I'm going to show you all about it today. I generally don't like to talk about how great I am or how great your life will be. I will show you the system. If you like it, Jeff already has a couple of offers. We'd love for you to try it. If you don't like it, that's okay. But I think with what I'm going to show you today, I think you will like it. My name is Rahul Arora. Let's move on and get into the session here. Creator of the Velocity System. We talked about this. I've been trading since the year 2000. Prior to that, and I still am, a CPA. So I look at trading from a completely different lens than a typical trader or a typical retail trader specifically. The benefit of having a CPA and looking at companies, or having the benefit of looking at companies from a very, very early stage. I was in my early 20s when I joined a Big Four accounting firm back in 1998. The benefit of that, and I didn't realize it at the time, I was actually learning the specific things that make companies tick. You all know what a balance sheet looks like. You all know what an income statement looks like. But I got to see what the notes look like, and I got to see how the notes were built, because I built some of those footnotes and notes at the end of the statements, and that's really where all the bodies are buried and where all the secrets are kept. So it gave me a really interesting lens through which I could view financial statements and the health of a company, the potential growth opportunities, everything that's different. You're never going to see a CFO or a chief investment officer come on CNBC or CNN or Bloomberg and say, yeah, we're just not doing great. I don't know what to tell you. They're all going to say, we're doing amazing. But it's your job as investors and traders who are looking at these investments from the lens of somebody who's critically thinking about it to say, is this the right investment for me? Does this fit in with my plan? Is this the right strategy that I'm looking at? And more, especially since 2020, the market is no longer about being long or short, buying and selling. The market is more about, there's so many different products out there that the market is now more about looking at a distribution probability chart and seeing, okay, I want to be here in the top left quadrant. I want to be here on the bottom right quadrant. So it's your job to figure out what it is that works for you. And your risk tolerance is going to be completely different than my risk tolerance. Remember, I'm raised as a CPA, which means my risk tolerance is pretty low, probably will be lower compared to yours, because in that business, you're taught to be skeptical of everything. If something looks too good to be true, if something looks even mildly too good to be true, you want to look into it. You want to see, okay, what is it that I'm missing? And a lot of the times, the conservatism helps, but a lot of the times the conservatism, I really, when I go back and look at my trades, and if you're not doing that, you really should go back and do postmortems on these trades. There are more times where I say, you know what, I should have been a little bit looser with my risk tolerance. Very rarely do I go back and say, I should have been tighter with the risk tolerance. So it's a system that works for me, and I'm going to show you how you can customize the system that we have, maybe to work exactly the way you want it to work for you. As I mentioned, I'm not going to go through I'm not going to take a lot of time on the slides, so we'll go through those quickly. Let's start with the headline. How has this system done ever since we deployed it back in April, May of 2025? It's hard to say 2025 considering we're in 2026 now. So let me take you to our performance table here. So this is my personal performance log that's based on the velocity system. And you can see we started this in Feb of 2025. Jeff is familiar with this spreadsheet. We've been following this exact spreadsheet since February 12th of 2025. And speaking of skepticism, the first thing that you should ask is, how can I trust these numbers? Just like we talked about, how can I trust numbers that come out from management on financial statements? The reason or the way you can trust these numbers is all of these things are actually documented either in our market chats, where we get together with our group Monday, Wednesday, Friday, and all of these are time-stamped and locked and loaded and documented on our Microsoft Teams channel that all our pro members have access to. So this is the most recent stuff. This is last week. We had a trade on WRBI, trade idea, excuse me, an adjustment on SLV, and SLV by far was our best trade last year. And if I sort this by symbol, do this by B, you'll see we had a lot of trades on SLV, 1, 2, 3, 4, 8, I'm going to say about 10 or so. And these were the wins that we had on each of these trades. So our average win, our total win was 688%. Our average on those SLV trades, let me just get this out of the way here. I'm sorry about that. Our average here was 69% on each of those winning trades. We did not have a losing trade on SLV. Currently, our open trade on SLV is the 70-80 call debit spread. Let's put that in. That is currently active. And SLV closed today, we'll look at it. Closed today, I believe around 76 or so, if I'm not mistaken. We'll get a look on that. So you can see, we did not have a losing trade until July, and even that losing trade was after taking profits on that same trade earlier in the month in June. So how has this system been performing this well? Well, we keep our losses tight and we try to let the winners run. We're not in this. So the way the system is designed, it's designed to catch the bigger move. We're not in this for a point or two. And if you're day trading, I have a great deal of respect for you, because I've tried it and I just find that it does not work well with my personality. It's just too much to think about in very short amounts of time. And if I catch a dollar here, a dollar there, it feels great. But when I look back on that trade, so on SLV, if I was trading it and I made 50 cents or a dollar or 75 cents, $1.50 even on a $30 stock, feels like a win. But I want to catch that from 30 to 75. That's the trade that I'm looking for. And I'm happy to sit in that trade for quite some time to let it work. Now, we buy options generally, and those options, of course, come with an expiry date, best before date. And those options typically get rolled out so that we can continue staying in the trade. So, and it's a mix of what we've done over the last year. So Corsair Mag 7, this is a 5x leveraged stock or ETN that's listed on the London Stock Exchange. And it tracks basically the Mag 7, but it's daily rebalanced at 5x the leverage. So the reason we bought this was, it wasn't that I said now is the time, because I think technically this is the right thing to do. I was bullish on the overall tech market post Liberation Day. So you can see Liberation Day comes around April 10th. I think we hit the lows of the year around April 7th. So we ended up getting this one and this one right near the lows of the year. And it turned out to be great trades. This 41 cents currently trading at about $1.90, taking profits on it along the way. You can see when we closed out these positions, $6.95, currently trading at about $36, $37 or so. Now you're probably wondering, well, this guy says he's risk averse, but look at that 5x leverage trade. No doubt. This was the intention on these trades was buy a little, if the price comes down, buy some more, because over the next year, 2 years, dollar cost averaging on a leverage fund is something that I've tested. You should do the same. Use ChatGPT, Gemini, etc. Get some data, ask it to run back tests on what would happen, because generally these things are not meant for long-term holds. But go back and do the tests. Even if you do it on TQQQ, you'll see that if you had dollar cost averaged into that trade over the course of the last 15 years, your return would be about 30 to 35x right now. In 2022, you would have gotten crushed, but that's something you have to be prepared for. But if you go back and look at the same trade on the NASDAQ, your return would be 3, maybe 4 times from those 2010 levels. So am I willing to take on a little bit more risk for the asymmetric return? Yes, that is exactly what we're looking at. We're looking at this from a lens of a CPA, a mathematician, to see we want to put up 5, we want to put up 10, and we want to come back with 60 or 70. So those are the kind of trades that we're looking at. So if a trade doesn't go on our way, it doesn't go our way, it's fine. We're ready for the next one. You can see this one here. I highlighted everything that was over 100%. That's the VIX trade that we had. We opened this on a Friday, and the following Monday, there was just a big gap down on the VIX, and this trade turned from 35 cents to $1.85. And this was yet another way. Remember I talked about looking at the probability distribution and seeing, I don't want to just go long or short the NASDAQ or the S&P. I want to go long the NASDAQ, but I'm going to do it through shorting the VIX or buying a put on the VIX, because that's where the best risk reward was. So 428% there, 131% on SoFi, 189. SoFi we rode for quite a while as well. So you can see, even if you have losses along the way, our overall return, as I mentioned, was an average of 64%. So I'm not using this year's. This year we're off to a pretty good start as well. UPS is an active trade for us. Google is an active trade on which we've taken profits. UPS has been twice, Google has been once. And SLV, of course, we'll make a decision on this week as we're up, looks like about 7-8% or so. But the options are going to be up likely 20 to 30%. So we're going to watch that for our clients. So that's how we've been doing. A lot of this stuff because a lot of this stuff you're familiar with, and that's likely why you're here. You're worried about finding the right entries, finding out when to exit. I was talking to my dad today, and he was trading, it was a leveraged natural gas fund. And he said, when the price got to 1283, my target was 13, but when the price got to 1283, he said, I got a little scared. And I'm sure all of you know that feeling. You've got a profit, but you don't want to give it back. So you take that early profit, nothing wrong with that. You've heard that old saying, you'll never go broke taking profits. But there's also the other saying, which is you may never get rich taking small profits. So we've got to balance, okay, where are we here? Where do we want to go? And what's the likelihood of us getting to that stage? So that's what we preach in our training sessions, is getting you familiar with our strategies and then helping you apply those strategies to your personal trading style. Okay, I'm going to skip past the other stuff. Let's get right into the demonstration. This is the Metastock charting platform. I'm sure you're quite familiar with it. And let me hide that, and let's go back here. Okay. There we are. So I would love for anyone to guess what that green line is. Can anyone guess what that moving average is? Now, Jeff, I only got the one monitor, so I may not be able to see questions. If you see responses, please let me know. Okay, because I can't see the responses, it's the 150-day simple moving average, and you're wondering, oh, geez, that's not 200, it's not 50. Why is this guy using 150? If you go back and study the teachings of Stan Weinstein, a very famous trader, and especially he had mentioned this in his 1987 book, How to Profit in Bull and Bear Markets, he uses a 30-week simple moving average to do the first assessment on whether he wants to get into a trade that's long or short and when to get in. So volume has a very significant piece, very significant role to play in that decision. But we're going to keep the 150-day simple moving average on just as a guide. Okay, you do not need this. Really what you need is this trend line and the symbols on the chart. Okay. Jeff's team was kind enough to program this so that when you're in a long trade, the bars are all colored green. When you're in a short trade, the bars are all colored red. So it gives you a bit of a visual representation. And the only other indicator I have on here is the volume. So you can see the volume spike here. And then we've got to go a little further to see any further volume spike. So this was right around Liberation Day. This is right around where we started accumulating MAG7 as well as QQQ5. Again, the intention here was that if it goes lower, we dollar cost average down. If it goes higher, we consider scaling out when we hit certain targets. So let's look at our long position here. So when you get this long, I've already drawn in a couple of trend lines. When I get this long, ideally, what I want to do is I want to take a look at three different things. Okay, I want to see if we're above this 150-day simple moving average. Again, nice to have, not important. If we are above it, it's a green light. I'm looking for 3 green lights. So if we're above the 150, that's great. The second thing we want to look at is, are we above a previous pivot high in the direction of the trade? Okay, I'll say that one more time. Are we above a previous pivot high in the direction of the trade? I am okay with missing this long from 480 up to 540 because I don't want to be guessing. I want to be sure that this is the right entry. And in this case, it looks like a regrettable error, but when we ran simulations with this over thousands of stocks and thousands of days, it turned out that waiting for this break of a previous pivot high was actually a more conservative way to approach the trade that resulted in fewer drawdowns. Okay. Now you could use a previous clearly defined pivot high that's not in the direction of the trade. So this was during a short that we had. So there's the previous short. I want to make sure that I have taken out a previous pivot high that's in the direction of the trade. So that is the second green light for me. And the third green light for me is, am I able to tolerate a 10% loss for stocks or a 5% stop loss for ETFs? So when I get to this level here, now I'm going to zoom in a little bit so you can see it a little bit more clearly. Okay, so there's our previous pivot high, which comes in around the 18th of Feb. And the previous high there is 540 exactly. And on this bar here, we get a value of 544. So we have broken that high and we've actually closed in the top half of the bar. In fact, we're near the very, very high of the bar. So that's important to me because a close near the bottom of the bar or in the bottom half of the bar gives me yet another reason to caution. So if we're reading these bars one by one, we want to see not only a close above this area of resistance, but we want to see that close hold. Okay. So what I would typically do in that case is, this is where my trade would be. It's right at this closing price of, oh, where are we here? the close here comes in at 546 approximately. Okay. So at 546, that's my entry. Now, can I tolerate a loss of 5% here? Because this is an ETF, so call it 27 points or so. So if I take my trend line and I go down to 520, okay, so this at 520 is where I place my stop loss. Let's see if I move it down there. And that's really it. After that, I'm establishing targets. So my first target is going to be approximately 3%, then 5%, then 10%. And if I'm using options, I just keep doing that. If I'm using shares, I generally will scale out with 33, 33, and 33% on the moves up. And that last 33%, I will use until we get an exit on the system. And you can see that that entry back here at 546 is still an active trade at 627 and change right now. Okay, so if I was doing this and I was just doing a third, a third, a third, this last trade I would still be holding on to. Okay, so that is how I set up the trades. That is how I set up the stop losses, and that is how I set up the profit take levels. Now let's go back and see what we would have done with SLV. And if you have any symbols that you'd like me to look at, please put them in the chat. I'm happy to do that. So remember what I was saying earlier about I don't want to just catch a point here, 2 points there. This is the move I want to catch. I want to catch this move here. So let's do that same analysis that we did on the Qs. Let's do it on SLV, and let's do this as if we were doing this in a very conservative way, looking through the lens of a CPA, making sure our losses are controlled and making sure our upside is wide open. So here's the entry. Okay, so there's the Weinstein 30-week simple moving average, 150-day to be approximate. So right now, when this entry comes, we're not above that. So we've got a bit of an amber light here, yellow light. The next bar, we actually do have an entry, but what I really want to see is a break above the previous pivot high that's in the direction of the trade. Okay, so we get this sideways pattern. I don't want to be sitting in the sideways pattern if I'm holding long call options, because the theta is just going to continue eating me up. So yeah, we get to 30, then we come back down to 29 and change. We got up to 30 again. We come back to 29 and change. But here is the breakout. Okay, a few different ways, and a lot of people will treat breakouts in different ways. The way I treat a breakout is this. This now gives me the green light on the fact that it's above the 150 and it's above a previous clearly defined pivot high that's in the direction of the trade. So in this case, I'm going to make my stop loss when the bar looks like this, I'm going to make my stop loss even tighter, because I don't want to, when this breakout happens, I don't want to wait for a 5 to 10% drawdown. I'm actually going to put my stop loss right at the bottom of the breakout bar. Okay, so our entry here comes at 31.59, and our stop loss is at 30.72. So it's about 84 cents on a $30 stock. You're looking at less than 3%. So this is how I keep the risk down. Now, in fact, what I ended up doing, this is around April 15th, around the trade that we're looking at. So it was trading at around 30 at the time. And I bought a 30-40 call debit spread for $2.28. So this was a 10 wide for 228. And at the time, silver was not what it is today. Today, silver looks amazing. Here, silver was just breaking out. We've had many breakouts in the past. I didn't think that this would be a situation where we'd break all-time highs from the 1980s and go to levels that are testing the patience of the banks that are heavily shorting this commodity. At that time, it just seemed like a good risk reward to pay 228 for a 10 wide call debit spread. And the call debit spreads, again, going to how risk tolerant or risk averse you are. I've mentioned that I'm not that risk tolerant. So debit spreads for me provide just the right mix or the right balance between risk and reward. I know that even if the price pulls back, I'm not going to lose this entire amount. Yes, in the case of a short-term expiry and there is a gap down, yes, you could lose quite a bit of it. But I know that if this closes below, that breakout bar, which is about 75, 80 cents, as we've discussed, how far down am I going to be on this debit spread? It might come down to $2, maybe even more, $2.10. So I lose 28, 30 cents for an upside of what, $7.82 or so. So I'm okay. That for me is the kind of risk reward that works. So that's the way I look at debit spreads. It's not an all or nothing, especially when you're buying yourself some time. So if you look, this is April 15. Which one did we buy? Look at that. 8 months out. So January of 2026, which is where we currently are. Now, we didn't hold it all the way to expiry. We rolled it. So there was the first roll that we did on the 2nd of June. So this, if we had just had the long call, we actually would have lost money on this because of the theta decay over time. In fact, if we had a really short-term expiry, our options would have expired long before the move happened. And that is, if you take away anything from this presentation, take away the fact that you want to be able to stay in the trade long enough for your theory or for your thesis to play out. So the thesis is, yes, we're going long. But if I had bought a monthly or a weekly expiry on a call option here at 32, 33, 35, even at 31, it's very likely that I would not have been profitable, even though the stock or the ETF here did exactly what I thought it would, which is go up. It just didn't go up in the right amount of time that I had on my option. So I typically look at going out 3 months, 6 months. Now there are situations where you'll get something like a GameStop or AMC, Open Door, etc., where it doesn't make sense to go out that long because it's a play where it's going to go up and come right back down. So much more risk in those cases. I actually like to sell the call options against the stock because of the implied volatility and the premium spike. As soon as there's any kind of lull in the action, boy, do those call options lose money quickly. So this was SLV. So we take the entry there, put a stop loss here at the bottom. I don't want to go 5%, 10%. For me, this bar actually tells me quite a bit of the story of where I want to put my stop loss. Okay, and if you look at gold, if you look at any of the metals this past year, you'll be able to do that. So there's our entry, the official entry that comes on velocity. So this is all calculated using a combination of indicators. So this is saying, okay, hey, let's put this on your watch list. Maybe you don't want to take this trade right now. If you're a little bit more risk tolerant, this is a trade. If I was a little bit more risk tolerant, this is the trade that I would start right here. But as I mentioned, in the simulations that I've run, I found that a lot of these trades fail just as often as they succeed. In this case, of course, it works. But for me, I want the confirmation. Okay, I want that third green light of making sure it's broken a previous pivot high that's in the direction of the trade. And you can see, even at that trade here on the close at $30, excuse me, $31.59, you would still be in that trade today. And today's closing price was $77.23. Wow, $77.23. So going back to, I don't want to catch just a point or two. I want to catch 36 points or 46 points in this case. And I'm okay to sit in this trade. So from 30, and I'm rolling out these options on every target that we reach. So let's find the next SLV. So here, recall that we had the 30-40 call debit spread. We just simply moved it up to a 32.42. Okay, bought that for $2, sold that for $2.47. SLV again, the 32.42 that was remaining from this trade here, sold that for $3. That's a 50% gain. And from 32.42, we eventually moved it up to, where's the next SLV that we moved it up to? 37.47. I think there's 35.45 in between, and maybe I'm not saying it, but 37.47. Remember, we had started at 30.40. So we're rolling these options out because the thesis has not changed. In fact, it's actually much more favorable. We're now breaking new levels, getting towards all-time highs. From 37.47, we eventually got to 45.55, 50.60, 60.70, and I think currently we're at 70.80. So this has been a long and wonderful journey starting in April of 2025, because the thesis was we're bullish on metals, dollar debasement. It's a longer term trade, hence the reason for the January 2026 calls or call debit spreads when we were in April of 2025. If we look at gold, I'm going to look at the ETF. Our entry on gold, you have to go much further back than we did on silver or SLV, because gold, I believe, was sometime in 2023. So the system alerted us to, you know what, this is actually a really good example of why I like to have that third green light of breaking a previous pivot high. Okay, so let's get to 2023. I want to show you this area here. So a lot of the times, what traders will, the trap that traders will fall into is they're following a moving average, whether it's a 20, an 8, a 9, 50. And a lot of the times you'll see the price will oscillate right around that moving average. And here's a perfect example. This is a 150-day simple moving average. Yet we've got this cluster here where we've got these ins and outs. So how do we treat this area here? And with that one simple rule of just drawing a trend line, as I said, you're only going to need these trend lines to make a decision on whether this trade is high probability or not. So let's look at this first short here. This short comes in on the 14th of September. And if I go back and I look at the previous pivot low, it is right there, okay? So in this case, the short works for a little bit until it doesn't. So in this case, what I would do is the entry here, because it's quite far from the previous pivot low, is I would set my stop loss very tight at the top of this bar here. Okay, so there's the stop loss at the top of the bar. We've done that on a previous session. And as soon as it breaks that, we're out of that trade. The next one, a little bit more interesting, or previous one. There's the long. Remember our rule. We got to break a previous pivot high. This is the clearly defined previous pivot high right here. Okay, we never break it. So this becomes a non-trade. We don't break a previous pivot low there, so this becomes a non-trade. So we've stayed out of one bad trade, we've stayed out of two bad trades, we've stayed out of a third bad trade, as we never break those previous lows there. We stay out of a fourth bad trade as we've now established a new pivot high there. Okay. Do we break that here? We do not. So we stayed out of 1, 2, 3, 4 bad trades. We do get into this one. This one gets closed out early. So stayed out of 4 bad trades. We have 1 loss. And now we get to this long. Same analysis. The analysis does not change. There's the signal for the long. And there on the, where are we here? The 20th of September is our previous pivot high. So if I can move that bar, that's okay. You guys have an idea of what I'm looking at here. So here comes our entry. There's the break of the previous pivot high. Now I would say, okay, this bar closed. This was not an emphatic close above that level of resistance. I'm going to see if there's follow through. I'm going to see if there's a break of the high of this bar. It certainly does happen the next day. And Jeff, the R2s, R3s, and some of the other indicators. So these are market maker pivots, and sometimes they can actually be quite close to the entry. So you can certainly use those. I do, but if it's that close and I'm not getting out of a third of my position when we get a move from 177.60 to 178.29. And certainly, I mean, this one's better. I would consider taking profits here, but my entry is actually here. So the entry comes on this bar here, and I'm going to put a very tight stop loss here. Okay. Or I'm going to use a 5% stop loss target, which is about $9 here. So if we go down to from 180 down to 171, can I tolerate the pain down to 171, which is right around here? It's a little higher. And the answer for me is, yeah, I kind of like this, failed breakouts, and this is a legitimate breakout here. So if you were playing this with a tight stop loss, you'd get up to a high of about 183 or so, come right back down here. You get closed out here at just a little bit less than break even. And then you get the re-entry right here above the 150-day simple moving average. And from there, you're kind of flying free. And that trade is still active today. We have not had an exit that has come out of that trade just yet. And Jeff and his team were kind enough to program exits for us as well. So if you don't want to do the work of saying this is how much pain I can tolerate for a stop loss, the exit certainly will do the work for you. So I'm going to keep scrolling here, January 2026. So from 180, where we got in, to where we are currently, 422 and change. That's the no sweat trade that you would have been in back from 2023 in September. So that's what we're looking at here. We're looking to catch the longer trends. In between, yes, we'll have some re-entries and stuff. My business partner Vince has a wonderful system called Victory. So I've combined some of that stuff with the velocity system here for re-entries. But I'm looking at the bigger trades. If we look at some of the rare earth stuff that has been in the news recently, you can see on Quad U, this is that same 150-day simple moving average, just looks a little different. We do the same analysis here on the Qs, on the Us, okay? There comes our entry. We get we're right at that, we're straddling that 150-day. But what happens if we can't find a previous pivot high that's in the direction of the trade? Is we look for the establishment of a new pivot high. So the previous pivot high will come, just look for a green one way up here at around 7 and change. So in this case, when we get this entry here, And we get this 3-bar pivot that forms right there on this bar on the 4th of June. This establishes a new pivot high that's in the direction of the trade. And then when we get the definitive breakout, either here or here you're prepared and you're taking on a little bit more risk, in my opinion. But this breakout here with a stop loss that is, even if it's 5% or 10% for stocks, you would take that trade here at 651, and I believe you would still be in that trade today. I think the high on this one was 26 or so, the high on it 27 and change, and sitting currently at around 20. So this was, again, a high conviction trade. On this one, I had actually bought the January 2027 options, and I think it was sometime in June, and it was a 10 and 17 call debit spread for $1.29, $1.30, and I felt that we were right around 10 at the time, and I felt like a 7 wide for $1.30. It's a 5.5 times risk reward. I'm okay with that. So that was the argument, or that was the asymmetric trade that I was looking for. UEC was around the same price, and I chose not to do that because the options were much more expensive. That same spread in the same kind of range was much more richly priced. So, and going back and doing a little bit of fundamental stuff, they'd already had contracts with the US government, and it seemed like if uranium was going to be enriched in this country, that UU would be one of the leaders. And I still think Quad U is going to be one of the leaders. So that's a bit of insight into our analysis, or what we do for our clients, and the way we look at this, not only through the lens of technical analysis, but we add some fundamentals in. We look at unusual options activity. We look at options pricing models. All of this, and we present to you on a silver platter for you to make a decision according to your risk tolerance and what it is that you're trying to achieve. There are some people that, I just want an extra $500 a month. Your strategy is going to be completely different than the retired trader or the retired investor who's working with a $500,000 portfolio who wants to generate $50,000 to $100,000 a year in returns, because that's going to be living expenses. So we've got in the group people that are just starting out in their 20s and 30s, and for the most part, we've actually got a lot. For the most part, it's retired folks or folks that are managing their own money because they just don't feel like it's worth it to pay a financial advisor 1.5%, 2%, regardless of performance. And there's enough information now with certainly the internet, but certainly more now with LLMs, et cetera, so ChatGPT, Gemini, et cetera, where you may not be able to do this stuff right away, but boy, can you learn quickly. And this is what we're doing here. We're trying to empower the retail investor to show them that you can do this and you can learn this stuff. You're not too old to learn this stuff. And if you learn this stuff, it's a great life skill to have. And you can see from our performance throughout the year, which is transparent, all on our Teams channel. And if you'd like a copy of the spreadsheet, we can send it to you. It's open to everybody. The only thing we do is we delay. We don't send you will not get access to the trade ideas as soon as they're posted on the Teams channel, but you'll have access to this sheet, so you can follow along if you want and think maybe now is the time to do it, or later is the time to do it, and performance is different. That's up to you. With that, I'm going to send it back to Jeff. Jeff?
Hey, it took me a minute to find that button to unmute my mic.
That's okay.
Thanks, Rahul. Really appreciate it. We're going I want to talk a little bit about how to get this. It's a great add-on. And let's go ahead and before I let you go, I do want to say thanks for joining us, and thanks for closing us out today.
Thank you, Jeff. Next time, I promise to have better lighting. Did we have any questions that need?
Somebody guessed no, not yet. But if you have a question, let us know. We did have somebody. We did have a comment from Michael. Michael B. You probably know him. He says, TradingWin's an awesome service and a learning group. So, no.
Yeah, I officially have a man crush on Michael. Michael shows up to every presentation that Vince and I do, and we're so grateful to him for his kind words. Michael, thank you. I hope things are well with you.
And then we had some guesses that it was a 50 or a 20, but the one you were showing at that point was 150.
Yeah,
So,
it's the Weinstein average. Jeff, have you played around with it at all?
not on purpose, no.
Yeah, I'm gonna show it to you when we speak next. I think you'll like it.
Okay, sounds
Yeah.
good. Well,
Okay.
I'm going.
Do you need me any longer, or do you want me to?
You're welcome to. I don't, but
I'm here. You just let me know.
okay, sounds good. Let me go ahead and make me the presenter. I'm going to show this picture of you in the Better Call Saul shirt as well again, and then I'm going to talk about velocity. Rahul, thank you so much.
My pleasure, Jeff. Thank you.
All right. And this one, Rahul, I love how he brings his receipts. He shows his trading logs. Obviously, very, very professional. You should keep a trading log. You should know how you're doing, and you should be doing well. So with Rahul, I love the kind of the work that he does, the professionalism that he brings with it. In terms of the add-on itself, it has explorations for a daily system that's kind of it's customized, it's available, it's put together for the daily markets, and then in addition to that, intraday. So if you're using daily, you'll want to use the parameters that kind of are going to match up with the daily scan. If you're using anything intraday, you want to be a little short term. Rahul's just created a specific methodology that's tiered towards the intraday thing. So it's two different methods in one. It'll give you long and short signal detection. And it's scanning. I love scanning. I've talked about how I like scanning all day long. In addition, of course, you get the real-time expert alert, the commentaries, the signals, the definitions in terms of what you should do with those entries, why you're getting the long, what you should do with it, all that kind of stuff. And as you can see, just to kind of take a look here, let's zero in on here. The initial stop loss guidelines for the daily chart are 10% for individual securities and 5% for indices. Adjustments should be considered for volatility and proportionally for shorter term. It's the kind of detail that actually kind of goes into this. It's very specific in terms of what you should do, why you're getting a signal. All that kind of stuff is very, very well spelled out. In addition to there, we automatically put stop losses on the chart. We annotate when you should go long. This is a long plus signal. Here's where you hit the R3 pivot. It's very, very clear. It's very clear with what you should do with it. I personally like the fact that with the way Rahul has you do it is you'll initially get into a trade and you'll very, very quickly take profits off of the table, lock in some profits, and then let your winners run. And I just think the way that he's got that money management put together actually works really well. Michael talked a little bit about how great of a TradingWin service is and the videos and all those kind of things. As part of the initial purchase of the velocity add-on. Oh, let me just hold on. I'm gonna have to remember how to use my English. Just give me a second. As part of the purchase for the add-on, you're gonna get daily trading ideas. You're gonna get a membership to the TradingWin service for a year. That's normally a $97 a month value, $11.64 if you times that out by 12. That includes daily trading ideas, weekly training series, sessions, on-demand technical analysis training, option trading ideas, all of that kind of stuff is included. And the service is great. We have a lot of the staff here actually goes to the training sessions and watches them. You get a lot of things just by kind of talking about trading ideas with people. And Rahul and the TradingWin's team are going to include a year of their premium service as part of your purchase. So if you kind of add that all up, the retail cost for the velocity system would be $19.97. The TradingWin's membership would be $11.64. Oh, we did record a boot camp that you're going to get immediately as soon as you sign up You get a free trial to Metastock if you need it. We're going to get a money back guarantee as part of it. Total cost for that would be $34.26. As part of the summit today, we're going to do $797. We're going to back it with a 30-day money back guarantee. You can do that if you go to metastock.com/velocity. If you have questions, we'd be happy to answer any questions you've had. 800-882-3040 or metastock.com/salespchat. Any of those ways to kind of get that set up for you. Just checking over here to see if we have any more questions. Let me go ahead and practice my ability to talk at the same time. So if you want to take advantage of that, go to metastock.com/velocity. Go ahead and put that over in the YouTube chat as well. As always, if you want to give us a call, you can give us a call 800-882-3040, or you can visit us online at metastock.com/salespchat. This is part of that Traders Action Pack, which offers an even. Oh wow! There we go. This is the same thing, but look how pretty AI made it for me. $797 today. Metastock.com/velocity. 800-882-3040. Metastock.com/salespchat. This is part of the Summit Traders Pack, the Action Pack. It will include every add-on we've talked about. We started off with Jeffrey Scott. He talked about his market MRI methodologies. Greg Capra's Master Trader methodology. You get the JBXC Complete, the Velocity. You get the 4-hour training from Oscar Carboni. You get 3 months of Learn Metastock. We'll even throw in a free trial to Metastock so you can play with it. Almost everything except for the training has a money back guarantee in this package. To get the whole thing, you can call us at 800-882-3040, or you can go to metastock.com/salespchat. So as we close up today, I do want to say thank you to Stocks and Commodities Magazine. They've always been such a great partner of ours. I really appreciate the guys over there. If you are watching us on YouTube and you haven't registered yet, you still have time to take advantage of the free magazine, plus all of the other free offers that the presenters talked about today. Or they didn't talk about them today, but they'll have really good training courses and that kind of stuff. You can do that at metastock.com/tradersummit. If you haven't yet, you should join the Traders Forum. The Traders Forum is absolutely a lot of fun. Very much be enjoyed. It's an always open room. You can come in here, you can exchange trading ideas. You can talk about technical analysis, technical indicators, lots of resources around that. It's a community of traders designed to help other traders. It's completely free, thetradersforum.com. And anything, if you just want to sign up for Metastock, we're doing the Summit special where if you pay for a month, we'll give you 3 months. That brings your cost down to $25 a month. If anything, I'd encourage you to try out Metastock and the products we've got today. There's a reason Metastock's been rated #1 in its price category for 32 years in a row. And that's because I think it helps traders. It helps me. I use it every day. I scanned a couple of times today. I scanned for Friday because I was sick, scanned for today because I wasn't. Anyway, metastock.com/summit deal. You can call us at You can call us at 800-882-3040. You can also chat online with us at metastock.com/salespchat. A big final thanks to all of our sponsors, all of our speakers today, and you who hang out with me all day long. Thanks for coming here. Thanks for being part of the session. Very much appreciated. I'll see you again at the next webinar. Stay healthy, stay well.